Good morning, everyone, and welcome to all of you watching online and on FiOS One News. I'm Alexis Christoforous.
And I'm Brian Sozzi, and this is the first trade for Wednesday, October 16th.
Medicare melee. The Democrats who want to be president pile on Elizabeth Warren over health care, taxes, and Medicare for all. But President Trump wasn't far from their minds what last night's debate means for the markets.
And a banking beat. Bank of America turns in better than expected profits, thanks in part to its investment bank. Now, Warren Buffett wants to boost his stake in the company. We'll dig into it.
And the future of food. We sit down with the CEO of ConAgra about the big changes coming in the grocery aisle and why they're thinking way beyond frozen foods.
Let's get a peek of the futures here ahead of the opening bell. Some red on the screen following that worse than expected retail sales report. Dow futures down 53 points. The S&P 500 and NASDAQ also in the red.
All right, we'll get a full check of the markets for you in just a bit. But first, to today's big story.
Democratic candidates are back on the campaign trail after a fiery debate last night. They talked about the economy, global politics, and of course, health care.
Medicare for all is the gold standard. It is the way we get health care coverage for every single American, including the family whose child's been diagnosed with cancer, including the person who's just gotten an MS diagnosis. That's how we make sure that everyone gets health care.
The candidates went on to talk about a number of different issues, but President Trump apparently didn't think much about any of them. He tweeted, "Our record economy would crash just like in 1929 if any of those clowns became president." Yahoo Finance's Jessica Smith is in our D.C. bureau with more. Jessica, fiery debate last night, fiery tweet from the president. What are some of your takeaways?
Well, the debate covered a lot of ground last night, and it was clear Elizabeth Warren is emerging as the co-frontrunner with former Vice President Joe Biden. We saw a lot of candidates really go after her throughout the debate the entire night, and it was really evident in the piece of the debate focused on big tech. As you know, Senator Warren has called on regulators to break up the big tech companies. Not everyone on the stage was ready to take that stand. Here's Elizabeth Warren talking about Amazon and entrepreneur Andrew Yang addressing Warren's approach.
It runs the platform, gets all the information, and then goes into competition with those little businesses. Look, you get to be the umpire in the baseball game.
There are absolutely excesses in technology, and in some cases, having them divest parts of their business is the right move. But we also have to be realistic that competition doesn't solve all of the problems. It's not like any of us wants to use the fourth best navigation app.
Warren went on to say that you could be the umpire or you can have a team, but you can't do both. We also saw Senator Kamala Harris go after Warren in that segment. She called on Warren to join her in urging Twitter to suspend President Trump's account. Warren kind of brushed that off, saying, "I'm trying to push him out of the White House, not push him off Twitter." She refused to join her in that call, but it was just another moment in that key part of the debate where you saw Harris going after Warren, just like all the other candidates did.
And just, it looks like Amy Klobuchar had a pretty good night as well. And some are saying, while she may not win, the Democratic primary, is she emerging as a possible vice presidential candidate, do you think?
I don't know about that, if she's going to be a vice presidential candidate or not, but she did have a stronger night than we've seen in the past. She had quite a few lines that landed. We've seen her maybe struggle a little bit in past debates. She was actually one of the candidates who spoke the most, and you saw her presenting herself as the kind of the opposite of Elizabeth Warren, just that more moderate approach. So she definitely did get more time in the debate to make that case.
And Jessica, there was a lot to be made about automation right in Andrew Yang's wheelhouse.
Yeah, that was Andrew Yang's real pet issue. It's been his pet issue throughout this campaign. But last night, the other candidates had a chance to talk about it as well. Yang says the best way to prepare for this changing economy and the future of automation is to give a freedom dividend. So universal basic income, $1,000 a month for every adult in America. We heard some other ideas from candidates, too, but Congresswoman Tulsi Gabbard and former HUD Secretary Castro actually said they would consider UBI. They're open to the idea. And then we heard from Senator Sanders saying that his federal jobs guarantee program is the best way to deal with automation. And then Senator Warren said one of the real problems is bad trade policy. So quite a few different approaches on how to deal with that issue going forward.
It was a big debate, right? 12 candidates. What should we expect going forward?
Now we'll be watching to see how these candidates do in the polls, if anyone sees a bump or starts to fall in the polls, and if they are able to make the next debate stage in November. So far, only 8 candidates have qualified. Now they have to hit 3% in the polls. That's up from 2% in previous debates. So we'll see if any more candidates join the ranks, and we'll see if anybody drops out.
Okay, lots to cover. Jessica Smith in D.C., thank you. During Yahoo Finance's All Markets Summit, our Rick Newman sat down with Maryland Governor Larry Hogan, and he explained one aspect of politics that has governors across America upset.
Governors on both sides of the aisle are frustrated that Washington doesn't seem to get anything done. And quite frankly, both parties are to blame. It's not just the president, it's not just the Republicans, it's the Democrats too. And, you know, the fact that there's just divisiveness and dysfunction and nobody fixes anything. It's crazy.
Governor Hogan emphasized that he hasn't thought about running for president, but that both parties need to stop looking at each other as mortal enemies and start fixing things and work together. For the rest of our exclusive interviews with leaders in the business community, just head over to yahoofinanceams.com.
Let's get down to the New York Stock Exchange now and check in with Yahoo Finance's Inez Ferre. Inez?
Yeah, Brian, I was just talking to Tim Anderson from TJM Investments about those retail sales numbers that came out this morning. Retail sales for September fell by 0.3%. That's the first decline in 7 months. Economists had been expecting them to increase by 0.3%. Now, core retail sales, excluding autos, gasoline, building materials, food services, those were unchanged for last month. And also want to point out that the August reading was revised up to show that retail sales increased by 0.6% versus the 0.4% initial reading. Now, Tim is telling me, look, this is a miss, but certainly not too much of a market mover. And we're watching this morning United. This is after the airlines raised their full year profit guidance. Revenue per available seat mile for their latest quarter came in, rose 1.7%. That was in line with what the street had been expecting. The company didn't mention in their press release the extended grounding of the 737 MAX jet, those Boeing jets that are still grounded, but it is something that is expected to be brought up during their earnings call later this morning. And Adobe was downgraded at Citi to neutral from buy with a price target of $313, with the analyst note there citing some concerns over the company's growth and margins, and also the high expectations for their digital experience business. Adobe will be holding an investor day in November. Brian, Alexis.
Okay, Inez, thanks so much. We'll see you in a little bit. As Inez was just talking about those retail sales numbers, we want to dig a little deeper into those now with Greg Dacko, Chief U.S. Economist at Oxford Economics. Great to have you. Thanks for being here. We should mention that if you take out food and energy, retail sales were actually unchanged last month. But should we get too concerned, or do we need to see more consecutive months of a drop-off in retail sales before we worry?
Well, I think we have to be careful with any monthly number. This number wasn't good. A 0.3 decline is never good. But the core retail sales, when you take out some of the volatile factors, were flat. Now, the core retail sales have been trending at nearly 5% year over year, which is a good number. So overall, the state of the consumer remains healthy. We are expecting to see some moderation as income cools, but this report should not be throwing out alarm bells and alarm signals throughout, because I think overall the consumer spending and the U.S. consumer remains the main pillar of the U.S. economy and perhaps even of the global economy.
Is this a sign, though, that President Trump's trade war is starting to hurt the consumer? A lot of price increases have started to hit the retail shelves the past few months.
Yeah, that's correct. We've started to see these tariffs affect U.S. consumer goods, and that's really impactful in terms of you and I spending at a daily store. When you think about the initial tariffs, the initial tranche of tariffs, they were put on intermediate goods. So producers had to eat in part of that margin instead of passing on the higher cost. In this environment where you have tariffs directly imposed on consumer goods, you're going to see a negative effect via higher prices onto consumers.
Will this derail the holiday season, though? If those price increases are coming into effect, I think a lot of people are looking for a pretty strong holiday season, but I'm unsure after this quarter.
I think we'll still get some solid numbers in terms of consumer spending growth, but we're not going to see the 3.5% or 3% that we were seeing 18 months ago.
So we're losing momentum, but not enough to start worrying or thinking that could actually drag us into something deeper here, like a recession.
we're moving into a slow growth environment. We're moving into an environment in which consumer spending growth numbers are going to be in the 1.5% to 2% range, and GDP growth is going to be in that range. It's not quite recessionary, but it is much slower growth than we were accustomed to in 2018.
I have to think it bolsters the case for another Fed rate cut.
I think so. I think an October rate cut is definitely in the books. Whether they proceed with a December rate cut is another story. We'll see what happens on the trade front, on the geopolitical front with Brexit. There's some good news coming out of the UK over the last couple of days. But really what happens in terms of the global picture is going to be key. And if consumer spending slows, then that will be added ammunition for the Fed to actually proceed with a
Greg, when you hear the president come out this morning and tweet that the economy would crash like 1929, as an economist, what are your first thoughts?
No, I mean, I think we have to contrast things. We're not in a 1929 situation. We're not in a great financial crisis type of situation. We may be headed towards a slowdown that is more significant than just a moderate slowdown with growth around 1.5%. There are a number of downside risks from slower global growth, rising trade tensions, lingering uncertainty, which is affecting private sector confidence. All those factors are key, significant downside risks. But in the current environment, what we're expecting is a gradually slower trend for consumer spending, still well supported by employment and wage growth, which together form that income growth pillar.
Does this mean anything to you? 7 of the 13 major categories showed declines. Among those categories, online shopping fell 0.3%. Is that worrisome as we head closer to the holidays?
It's kind of a mirror image to last month. Last month we had the same type of expectation in terms of the retail sales. We had a positive growth number, yet half of the categories were actually in decline. When we look at the broader picture, I think what's usually interesting to watch is online sales. Online sales have been growing at a very fast clip. We're talking double-digit rates, around 15% year over year. So that's very strong. So a one-month blip is not something to write home about, but it is something to pay attention to. Spending at restaurants and bars is another one that usually tends to drop off first when consumers are uncertain. That's still growing at a moderate pace, but still growing. It's another sign that consumers are feeling relatively well.
Greg, hang with us. We'll touch more on this shortly.
Thank you.
Now let's get a look at European markets right now. European markets, you're seeing some mixed action. The FTSE 100 down about 0.2%. The CAC 40 slightly in the red. And the DAX continues to break out to the upside, up about 0.4%. Yahoo Finance's Tom Belger joins us now from London. Tom, some interesting action taken by European regulators regarding Broadcom.
That's right. European regulators have ordered it to stop using exclusivity deals with leading TV set-top and modem makers. It's a pretty unusual and radical intervention precisely because their investigation is still ongoing. It's a sign, really, of how serious the regulators' concerns are about the US chip makers' rivals being squeezed out by these measures that they are taking action now. What this boils down to is the controversial deals Broadcom went into with 6 leading makers, which effectively forced them to buy chips from it if they wanted access to rebates, early access to technology, and various other benefits. They've been ordered to halt that immediately within 30 days, but it could be years, not days, before we see the EU's final decision on whether this breached European rules.
And also, UK regulators have launched a competition probe today over Amazon's move for that food delivery firm Deliveroo. What's the latest there?
That's right. This is Amazon's latest run-in with regulators, but in the UK. This is over their $575 million move for an investment in Deliveroo, which has taken around 200 cities around the world by storm since launching in London. It's about fears for competition. The UK authorities also fear a substantial lessening of competition, but Deliveroo is really keen for this extra cash if they're going to take on the likes of Uber Eats in a fiercely competitive market. That decision could be within a couple of months.
All right, Tom Belger in London, thank you. Let's take a look now at today's News Bites. More explosions along Syria's border with Turkey today as Turkish President Erdogan insists his country will never agree to a ceasefire. He told reporters he will not negotiate with, quote, terrorist organizations. Turkey considers some of the Kurds fighting in Syria to be terrorists, and he says he won't negotiate with Vice President Pence, only President Trump. A senior State Department official who is in charge of Ukraine policy says that he was kept out of decision-making discussions about the country. Deputy Assistant Secretary of State George Kent told impeachment investigators he was closed out of Ukraine deal-making after a May meeting organized by Acting Chief of Staff Mick Mulvaney. A fire that lit up a California fuel terminal has now been contained. The fire near San Francisco affected 2 tanks, which were said to have held low volumes of ethanol, filling only about 1% of its capacity. Operations and shipments at the location have been suspended, and safety precautions have been lifted. NASA has unveiled new gear to prepare astronauts to return to the moon. The moon spacesuit allows for much more movement than old suits and can work in temperatures from 250 degrees all the way down to negative 250 degrees Fahrenheit. The other suit is designed for astronauts' launch and re-entry back to Earth, and it gives protection and oxygen to astronauts in case of an accident. Well, it only took 86 years, but the Washington Nationals are headed to the World Series. The Nationals completed a 4-game sweep against the St. Louis Cardinals last night, winning Game 4 by a score of 7-4 at home. The Nationals' big win means the Seattle Mariners now stand as the only Major League Baseball team to never make it to the Fall Classic. Come on, Mariners, you can do
Yankees.
it.
Come on, Yankees.
Yeah, for sure.
Coming up here on The First Trade, some more heavy-hitting banks are out with earnings today. We'll break down the numbers. Also, we'll sit down with the CEO of Conagra Brands and get his take on why frozen food sales continue to be on fire. Taking a look at the futures here, though, real quickly. Dow futures down 49 points. The S&P 500 and NASDAQ slightly in the red. We'll be right back. Welcome back to The First Trade. Taking another look at the futures here ahead of the opening bell. You're seeing some red across the screen. Dow futures down 52 points. The S&P 500 and NASDAQ also slightly in the red.
The earnings parade marches on this morning with another big bank out with results this morning. That is Bank of America, posting a beat on both earnings and revenue, but only slightly better than analysts were expecting. Julia LaRoche digging into this report for us this morning. So what was the big takeaways for you, Julia?
I think the big takeaway is that the consumer is still looking really strong when you're looking at some of those more consumer-focused banks like Bank of America, like JP Morgan Chase that we saw just yesterday. And a lot of it is, I can just pull up some highlights here. here, but consumer checking accounts are growing. They grew 2.3% to the highest level in the last 10 years. If you think back, what was 10 years ago? It was the financial crisis. New credit cards were up 5%, while consumer investment accounts grew 7%. And then you're also seeing strength in their investment management. Client accounts growing there, more asset inflows in the quarter, and just growth year over year. So what does that signal? That signals to me that the consumer's also looking pretty good. Another thing worth pointing out for Bank of America is a rebound in their investment bank, a nice rebound in their sales and trading business. FICC was flat, but they had a nice rebound for their equities business. That was basically the strength there. And then also the Global Investment Bank, they saw their fees increase 27% year over year, which is nice for them because, you know, we've been talking about investment banking in that business and really a lot of them trying to get a piece of that pie, and Bank of America has really repositioned themselves for growth there.
I thought the IPO market was really slowing down. But you had JP Morgan strong results in investment bank, and to your point, Bank of America up 27%.
Look, when we talk about IPO market, yeah, those are the big names, but investment banking is so much more than just bringing that next tech unicorn to the public markets. There are other areas that they can get these underwriting fees, whether it's debt underwriting, equity underwriting. It's the smaller deals sometimes. It's the smaller mid-market deals that don't always make the headlines that can really be the bread and butter business for them.
Sure.
Would you consider Bank of America one of the most sensitive big banks out there when it comes to interest rates?
Yeah, that's what they say, that Bank of America is one of the more sensitive ones when it comes to rates. I mean, that's something, there's this, the net interest margin is the number that folks often refer to, but they actually saw a modest growth there. But I think one of the other takeaways is diversifying your business so you're not completely rate sensitive.
Julia, you've digested a ton of bank earnings results in the past 2 days. Who's the big winner and who's the big loser?
Well, for now, the big winner is probably JP Morgan. I'd probably put Bank of America in that category as well. Goldman Sachs struggled when it came to their investment banking. So, I mean, guys, it's just a quarter. So they'll say, you know, we're in it for the long term.
That's CEOs should just say, that's just a quarter, don't worry about it.
Invest the next 20 years.
All right, thanks so much. Wi-Fi AM is coming up at the top of the hour. They'll talk about the future of Facebook's Libra. David Marcus, head of the company's digital wallet Calibra, will give insights on the tech giant's plans.
The opening bell is coming up next here on the first trade. Let's get a quick check of the futures here. Continues to be in the red. Dow futures down 50 points. The S&P 500, NASDAQ also in the red. And here's a look at overseas markets before our break.
Welcome back to the first trade. We're about 5 minutes away from the opening bell on this Wednesday, and stock futures have been lower all morning. Dow futures down more than 50, with the S&P futures off 6 and NASDAQ futures down 23. Let's go around the bell with Keith Fitzgerald. He is Chief Investment Strategist at Money Map Press. We also have Greg Dacko back with us, Chief U.S. Economist at Oxford Economics, and Yahoo Finance's Scott Gamm over at the Wi-Fi Interactive Board. Good morning to you all. I want to start with you, Greg. What do we talked earlier about these retail sales. Any bright spot in the fact that retail sales fell for the first time since February?
Well, put that way, no. But yes, there were some interesting numbers. There were some good numbers in terms of spending on clothing stores. That might be people spending before the tariffs hit. There were some encouraging data on the online sales front. People are still also spending at restaurants and bars. So overall, consumers are still spending. They're just going to be spending at a slower clip than they were, say, a year to 18 months ago.
Keith, over to you. Within the retail sales numbers, it looks like the new Apple iPhone didn't help prop up the results. I know you've liked Apple in the past. Are you still bullish on the stock?
Oh, absolutely, without reservation. I think the real pivot is going to be into the medical devices, the medical information sphere. The iPhones that everybody is so preoccupied with are going to be all but irrelevant as anything other than a carrier for that data in a few years.
I want to get over to Scott Gamm now, taking a look at the world and how major indices are performing. Scott?
Hey there, Alexis. Well, we've got stocks up in Asia for the most part across the board. In Europe, it's a little bit more of a mixed picture as we get closer and closer to that October 31st Brexit deadline. And then, of course, U.S. stock futures are down slightly. I think the key thing to watch for today's trading session will be whether or not the euphoria we saw yesterday on the heels of all those strong earnings reports lasts into today's trading session. Because remember, it's not just about the initial reaction when a company reports earnings. It's also about the day 2 and day 3 reaction. So that's why today is so important.
Yeah, Greg, interesting. The IMF came out with their forecast yesterday, 2.1% growth for next year. Yeah. What's your thinking?
Well, I think the IMF is a little hopeful in their forecast.
IMF hopeful?
Wow.
Yes.
I don't hear that too often.
They have 2.4% growth expectations for this year and 2.1 next year. Just as a reference point, Oxford Economics is at 2.2 for this year and 1.6, 1.5 actually perhaps after the latest data for next year. So we're looking at growth in the sub-2 region. I think even in that environment, the risks are tilted to the downside. So I think the forecast that we saw yesterday from the IMF is a little hopeful. They themselves said that the outlook remains precarious.
So, Keith, if economic growth is going to be sub 2%, what is an investor to do?
Well, I think you do the same thing you've always done. You look for those companies that are outperforming that are not dependent on what Washington does next, which political hiccup hits the headlines, what Brexit does or doesn't do. To me, again, that is companies like Apple, that's companies like Raytheon, that's companies like Becton Dickinson. Those are companies that are going to grow because they're backed by trillions of dollars of money that's going to get spent anyway. And so if you're a long-term investor, don't let the short game mess you up, because this is all about the big money playing with lots of leverage, and you don't want to get sucked into that.
Staying on the theme of investing for longer term, Keith, cannabis stocks have been absolutely shredded the past month and a half. Do you still like the space?
Well, I tell you what, to be clear, I've never liked the space. I don't think it's worth the paper that's being used to roll up and smoke that stuff, pardon the pun. I think that if there's going to be a role for cannabinoid stocks, it's not yet been revealed, and I think there's a lot of consolidation that has to happen before those become viable investments. If you want to speculate, that's entirely different.
What about, Greg, the bank earnings that we've seen thus far? What does that sort of tell us about the economy? I guess, a little bit in contrast to the retail sales today, those bank earnings have shown that the consumer is really quite strong.
Yes, I think that's still the picture. The consumer is still quite strong, and it's actually very encouraging to see some positive earnings data. We had been seeing stock markets prices rise quite strongly without profits really rising. And if anything, the profit margins of the companies in general have been declining for 4.5 years. That's never a good sign. So it's encouraging to see some positive earnings data, but I still think we're in an environment in which profit margins are being squeezed, in which there is limited pricing power for businesses, and they will have difficulty passing on higher input costs, whether from wages or from tariffs, onto consumers, because consumers are going to be spending at a slower clip. Not a recession type of environment, but just a slower clip in terms of consumer spending, in which they're more susceptible to price increases.
How do you explain some of the trends so far this earnings season? We're getting a lot of beats, and they're starting to pile up.
Yeah, but we've had a lot of misses in the prior months and the prior quarters. So I think this data is encouraging. It does show some signs of growth in terms of earnings. But overall, we're still in an environment in which I think stock prices are looking quite a bit expensive.
All right, here we have the opening bell at the New York Stock Exchange and the NASDAQ. Nothing to get too excited about this morning in terms of futures. They were modestly lower across the board. Looks like we're going to start the day with the Dow Jones Industrial Average off about 47 points. Keith, what about how are earnings shaping up for you thus far? How would you categorize it?
Well, I'm very excited by what I see because, to the point that we were just making, if you've got the right companies, then the slowdown in earnings is immaterial to your investment portfolio. So, for me, I expected earnings to be a lot stronger than analysts think. They usually come into earnings season overly pessimistic. That's certainly been the case for the last 3, 4, 5 quarters even. And the slowdown has proven to be nothing more than a speed bump. So, again, if you're spreading your money all over the place, you got a problem. If you're picking your bets very carefully, I think you are going to be enjoying this earnings season much like we are.
Keith, well-known hedge fund manager Leon Cooperman made some comments this morning on another network suggesting if Elizabeth Warren does become president, the stock market could crash 25%. Do you agree with that?
I think he's being conservative. I think the stock market, my own figure, is 35, maybe even 50%.
Why is that, Keith? Why wouldn't Wall Street want a Warren presidency?
To traders I've talked to all over the world, she scares them. She introduces uncertainty on a level they have never experienced before. And when you combine that with all of the leverage they have to carry and the unknowns that come with the complete realignment that goes with a war on success, that's totally uncharted territory. So, I think Cooperman is one of the brightest there is, but my own figures are even more aggressive. And we don't have to wait until the election, incidentally. All we have to do is wait for that first poll where it looks like she might have a shot.
But a 50% stock market crash, that borders on crisis. What would happen? What would be happening in corporate America to justify that type of decline?
Well, that's the funny thing, right? Corporate America itself is going to be at battle stations, but the earnings of the major companies that are dependent on the unstoppable trends, not the nice-to-have stuff, they're going to sail through this with prices under pressure, but their business model's not going to get disturbed. On the other hand, you're going to have a complete political knee-jerk reaction that covers everything. There will be no place to hide. So what you want to do as an investor is flip that around. You want to identify ahead of time companies you'll buy if they get put on sale, and that is companies like Apple. And I dare say it, as much as I dislike the company, that's even things like Facebook.
All right, want to get a check now, a deeper dive into the 30 Dow stocks. Scott Gamm has got the heat map up. What have you got, Scott?
Yeah, that's right. We've got the heat map live over here, and I want to walk through some of the names we were watching yesterday on the heels of strong earnings and give you a sense of what they're doing right now. Remember, UNH yesterday was up about 8%. Now it's down a little bit. Of course, UNH reported strong earnings yesterday. And then JP Morgan Chase and Johnson & Johnson also reported strong earnings yesterday. Those two stocks rose yesterday. This morning, they are up again. And then Procter & Gamble, this is also very interesting. The stock didn't report earnings, but yesterday, Procter & Gamble was one of the worst performing Dow components as investors rotated out of Procter & Gamble and into other stocks that did report earnings like UNH, JP Morgan and Johnson & Johnson. Today, we've got Procter & Gamble shares flat. We should mention that Procter & Gamble is one of those companies that's been on an incredible run so far this year. Just a few weeks ago, it was trading at record highs, and now, finally, investors are rotating out of that name and spreading that money into other areas of the market.
Greg, there was the theme last night in the debates that Elizabeth Warren is punitive. What would President Elizabeth Warren mean to the economy?
Well, I think we have to remember that it's not just about the president. The system works with Congress, right? So even if there are proposals to put in place new regulation, if there are proposals to put in place new tax system, then that has to be essentially go through Congress and be approved by Congress. So that has to be vetted in a sense. So I think, yes, there might be some concern about some of the policies that Elizabeth Warren is proposing, especially for financial sector actors. But overall, we're still not in that environment where there's a certainty that a new law will be passed.
Some of her policies do appear very punitive. Can the economy grow under some of those proposals?
Well, I think certainly we've had a bout of deregulation in the U.S. economy over the past 2.5 years. If we see some increased regulation, I think it could perhaps restrict some business investment activity, especially in the financial sector. But we have to consider how this is brought about. You can remember that when she was responsible for consumers in the consumer sector, she did have policies that were aimed at protecting consumers. So I think if the overall final goal and objective and result is one where we have a safer financial system, then perhaps in the short run it hinders growth, but over the longer run it promotes longer term growth.
Keith, let's say we get no trade deal with China in the fourth quarter. What are your predictions for stocks as we head into 2020?
Well, I still think we're going to have a higher run into 2020. That's assuming we don't get tripped up on a headline. That's assuming that we don't have Elizabeth Warren coming to the front. On the other hand, I think that China wants to drag this out as long as possible. So I'm expecting the status quo. There's still a lot of money that has to be put to work. We're getting into tax selling time of year. A lot of high finance is going to come and go. But net, China does not want an agreement. They want to drag this out because it's in their interest to do it.
Would you agree with that, Greg?
Well, I think we had a mini deal, and I think a lot was made about this mini deal on Friday. We were very cautious to say that this was a mini deal. We still have tariffs on 3/4 of our imports from China. So even if there are promises by China to import more and to address intellectual property theft, this is no big trade agreement. This is a mini trade deal. It doesn't change the picture that much, and we still have the tariffs, threatened tariffs, on December 15th. Let's not forget that. That's a big element to focus on as we approach the end of the year.
What does that do to consumer spending if we get that?
That could be a significant hit to consumer spending because those are consumer goods tariffs. Now, the administration was very smart about the way they imposed these tariffs, trying to pass the holiday season in terms of December 15th. You're past the hump. But still, that would have a negative sentiment effect, a negative confidence effect on businesses, and would mean that we would be imposing tariffs on all of our imports from China.
Greg Dacko, Keith Fitzgerald, and Scott Gamm, good to see you all. Thank you. We're a few minutes into the trading day. Now let's see what's moving the markets at the open. Yahoo Finance's Inez Ferrer is down at the New York Stock Exchange. Inez?
Yeah, Brian, we're looking at the Dow that's off about 50 points, with the Dow now below the 27,000 level, slightly below it. We're watching Slack this morning under pressure after Morgan Stanley cut its price target by $10 to $28, maintaining an equal weight rating. The analyst note cites concerns over competition from Microsoft. We're also watching Workday under pressure. Wall Street is starting to weigh in on Workday's Workday Rising conference, which happened yesterday, where they unveiled some machine learning apps and features. RBC cut its price target on Workday to $212, but still maintain its outperform rating. And Macquarie said that they had announced new products which may be difficult to monetize. Macquarie has a neutral rating on the stock and a $196 price target. And then we're watching Sleep Number after a big beat from the company for their latest quarter. Their profit rose 54% compared to the same quarter last year. Sales came in above what the street was expecting. Alexis, Brian?
Okay, Inez, thanks so much. Well, the U.S. is sending out a warning to untraceable Chinese ships hiding Iranian oil shipments. That's according to Reuters. Yahoo Finance's Scott Gamm is back at the Wi-Fi Interactive board with our commodities report today. So, Scott, how is this affecting the price of oil?
Well, we're not seeing a huge reaction in oil prices right now, which are under a little bit of pressure. But the basic story here is that we know that the U.S. has been imposing significant sanctions against Iran. And now the U.S. is telling ships from China not to turn off their transponder because we know that China is still a big buyer of Iranian oil. And of course, the U.S. doesn't want China violating those sanctions. And we know that the sanctions that the U.S. has imposed against Iran have been working, right? Iran is now producing about 400,000 barrels of oil per day compared to about 2.5 million barrels per day. But all of this is just more geopolitical uncertainty for oil, which has been down significantly over the past couple of trading sessions, almost reversing the 3% gain we saw in oil prices last week. So all of this adds to that sort of lid that we're seeing on oil prices over the past month or so. We are still below $53 a barrel.
And Scott, what's the latest on gold prices?
Yeah, I want to bring up gold prices as well today because we're seeing gold fall below $1,500 an ounce. But just about 2 months ago, maybe 6 weeks ago, gold hit a 6-year high, but it's since fallen well below that critical $1,500 level. And that's largely because we've seen some strong U.S. earnings, some strong economic data out of the U.S., and so there's less of a case for investors to scoop up a safe haven asset like gold. We should also point out that the U.S. dollar has remained pretty strong, holding well above 98. That also lessens the case for investors to own gold.
Scott Gant, thanks so much. If shopping the center aisles of grocery stores is dead, it's surely not showing up in Conagra's frozen food and snacking businesses. Conagra Brands CEO Sean Connolly joins us now. Sean, good to see you.
Good to see you.
Decode the obsession or the strong sales in frozen foods, up high single digits for you in the most recent quarter. I thought frozen foods was dead.
Well, we started this journey of our company's 100-year history about 5 years ago. We put our focus on frozen and snacking because they're two food forms that we thought are perfect for today's consumers. In particular, frozen, it's just been about getting the quality back into the food. It's, at the end of the day, it's just a temperature state, but the food quality historically had lagged. We hadn't modernized the brands. We set out to do that. We've made tremendous progress, and you can see it in the numbers.
Speaking of snacking, sales up 7%, better than 7% last quarter. You're actually quoted as saying Americans are snack addicts. I see that you're trying to tap into nostalgia with some of your iconic brands like Slim Jim. How are you doing that sort of, crossing over generations and getting the millennials and who are actually very health conscious? How do you get them to like Slim Jims?
Well, it's undeniable Americans love to snack, and interesting things are happening, like the movement away from carbs. So if you look at that trend, and you then see the explosion of meat snacks. So meat snacks used to just appeal to teenage boys by and large. Now it appeals to a much wider audience because it's squarely on trend with this whole keto, paleo environment.
I remember Macho Man hawking Slim Jim.
Absolutely, and Macho Man's back this year. We've got a relationship with his family, and that's a big part of our in-market activity.
The Savage, right?
The Savage.
Right, you got this.
Correct.
Yeah, I actually think that you should co-brand with the Yankees, and because Aaron Boone says there's Savages in the box, maybe every Yankee should have a Slim Jim Savage.
Didn't expect that one coming in, but
I think it'd work.
Get some over to the stadium today.
Key to your outlook in the second half, you came out very bullish for your guidance for the second half of this year behind some major innovations. Yep. What are you releasing? Because I think Wall Street is a little skeptical on that guidance, so what do you have coming?
Yeah, we always planned this year to be back half centric because we had some fixing to do on some challenges we had in the Pinnacle business, which is a business we acquired a year ago. We knew it would take time for customers to accept those, and it would be focused on the back half of the year. So those innovations, Bird's Eye is a great example, are coming this quarter. They're shipping into market and really will gain traction in the back half of our fiscal year, which is really the start of the calendar year. And then on our traditional legacy Conagra business, all the snack innovations that you talked about, we just introduced a whole new slate at the convenience store show last week, as well as some significant frozen launches that are coming. So this year has been built to be back half loaded. It's largely on the back of a very strong innovation pipe. This will be our third year in a row of very significant innovation, and each year we've raised our game.
Are you still looking for snacking innovations? I think the 10th largest player in the snacking business. You're building a new facility out by your Chicago headquarters. What are your thoughts on growing that business?
Yeah, we've got a really unique snack business. First of all, it is large. It's a $2 billion business, and we don't play in the big potato chip and pretzel space. We play in areas we call neglected coves: meat snacks, popcorn, seeds, sweet treats, and those are all growing categories, and we have the fastest growing business in those categories. So we like it. We just in the last year really began behaving like a snack company, which means you've got to show more agility, more entrepreneurship. You can't run it the way we run our traditional center store canned food businesses, as an example, and we've seen tremendous traction.
It's still in the early going. You bought Pinnacle Foods last year. These are brands like, as you said, Bird's Eye, Wishbone salad dressing. Any plans to perhaps spin off some of the brands within Pinnacle?
Well, really, within the Pinnacle business, what we're trying to do right now is modernize some of the brands, bring some of these modern attributes that consumers are looking for today into those brands in the form of our innovation program. And when we do that, we find the combination of icon brands plus modern attributes translates in store to better velocity. So that's been our core focus. But in terms of our company strategy overall, we've really been reshaping our total portfolio for almost 5 years now. We strengthen the businesses we own. We buy businesses that are complementary to what we already do, and we're open to divesting businesses that don't fit. That's all been part of our playbook, and that will continue to be so.
It's not such a secret that Kraft Heinz is splitting up a good chunk of their business. They have been shopping assets. Anything in that portfolio interest you?
Well, right now we're focused on strengthening our businesses, but we are spinning out some of our own businesses. We recently announced the planned divestiture of a DSD snack business, which means direct store delivery. That's not the kind of snack business we are in. So we've been reshaping our business. Obviously, Pinnacle was inbound. The DSD snack business is outbound. We're focused on executing those with excellence.
Higher tariffs affecting you? I read that you had to raise the price of Hunt's canned tomatoes because of higher steel tariffs, which you wouldn't think.
We have a significant canned food business. Cans are used tin plate. Not all the tin plate comes from the U.S., so we've seen some inflation on tin plate. That has led to some pricing in the marketplace, but it hasn't been a significant piece of the total company.
Okay, great. Sean Connolly, thanks so much.
Thank you.
The IMF is out with a new warning over the state of the global financial system, and Yahoo Finance's Brian Chung is live at IMF headquarters in D.C. with top IMF official Tobias Adrian. Brian.
Hi, Alexis. Yeah, as you mentioned, I'm standing here with Tobias Adrian. He is the financial counselor and director here at the International Monetary Fund, where the annual meetings have kicked off for this week. Tobias, thank you so much for joining me today.
Absolutely. It's my pleasure to be here.
So the Global Financial Stability Report just was released this morning, and it flagged rising corporate debt and also emerging markets that have been piling on debt. And you said partially it's due to some of the trade tensions. Could you elaborate a little bit more on why these are issues that you flagged?
Absolutely. So what we have seen is an increase in downside risks to global activity in recent months. As a result, monetary policy makers have eased monetary policy across the world. So interest rates are lower today than they were a year ago or even 6 months ago. And with the lower interest rates, investors are scrambling to generate yield. So there's a reaching for yield that we observe around the world by asset managers, pension funds, insurance companies. And with this reaching for yield, underwriting standards are deteriorating, particularly in the corporate sector.
Now, when you talk about the corporate sector, the numbers are pretty staggering. You said that it could rise, corporate debt being to $19 trillion, and this is specifically debt at risk, so companies that may not have the sufficient earnings to pay that debt. What should countries do to manage that? You mentioned macroprudential tools might be a way to do that.
Absolutely. We urge policymakers to act now in order to contain the deterioration of underwriting standards. So there are a number of macroprudential and microprudential tools that policymakers could deploy. For example, corporate debt at the underwriting stage is typically done in banks, and at that point, underwriting standards could be contained. What we're seeing is that leverage at the underwriting stage, for example, in the leveraged loan market, continues to rise, and that debt is distributed around the world and is raising concerns.
Another tool that you flagged is countercyclical capital buffer. It's kind of jargony, but for those that might not understand, it's a temporary buffer that would require higher capital being held at the banks to hedge against some of these risks. In the United States, the Federal Reserve has decided not to activate that for the time being, and has actually maybe suggested maybe they should turn it on right now and then turn it off when times are bad, so that actually banks would be able to lend more. Is that the proper way to be thinking about this right now?
Yeah, that's the way to think about it. So the countercyclical capital buffer is a buffer on the banking system that should generally be turned on in the boom phase. And we do see that in many countries, vulnerabilities are rising, and we would advise authorities to turn on the countercyclical capital
including
buffer.
The Fed right now.
And that might include the Fed. Of course, that does not get at the market-based financial system, right? In the US, about half of corporate credit is done through market-based finance, and there are other tools have to be deployed.
Lastly, there's been a lot of focus on the strength of the U.S. dollar, some saying that that's created a large demand for U.S. dollar-denominated assets. You actually flagged dollar funding around the world, especially as emerging markets load up on debt. Is that a worry? I mean, even President Donald Trump has been paying attention to this.
Absolutely. Dollar funding risks are a worry. We document that many non-U.S. banks are exposed to dollar funding risks. And when spreads are rising in the U.S. dollar funding markets, that exposes many borrowers to vulnerabilities. And that, again, can spread shocks and amplify negative shocks. So there, again, we urge that policymakers take action today.
Okay, well, that's Tobias Adrian, the financial counselor and director here at the International Monetary Fund. Thank you so much for joining us here on Yahoo Finance
Wonderful.
today.
Thanks so much for your time.
Thank you. Back to you.
Good stuff, Brian. Thank you. Coming up here on The First Trade, CrowdStrike stock has been hammered in recent weeks. We speak with the Red Hat cybersecurity firm's co-founder and CEO to see what's going on.
And here's another look at how the markets are faring. Stocks trying to make it back into the green. The Dow now off just about 18 points. S&P down 4. We've got the NASDAQ off 26. Stay with us. Companies to watch are coming up next.
Welcome back to The First Trade. You see some red on your screen as investors digest that worse than expected retail sales report. The Dow is down 34 points. The S&P 500 and NASDAQ also in the red.
Now for a look at some of the companies the Yahoo Finance team is watching for you today. A weak quarter at the pharma giant Abbott Labs. The medical device and drug maker reported profits in line with expectations, while sales came up short, and they narrowed guidance for the rest of the year. Still, Abbott Labs CEO says the company is on track for sales growth in the fourth quarter. General Motors and the United Auto Workers Union are reportedly in the final stages of negotiations to end their 30-day strike that has cost the automaker about $2 billion. A deal is likely to be announced at some point today. The strike began on September 16th as union workers sought higher pay, more job security, and protection of health care benefits, among other issues. MGM is making a sale. The global casino giant is selling two of its properties on the Las Vegas Strip, the Bellagio and Circus Circus. The Bellagio will be put into a joint venture controlled by Blackstone Group that MGM will hold a 5% stake in. The company says the sale will free up cash and allow for more flexibility. And Berkshire Hathaway is betting big on Bank of America. The company asked the Fed for permission to raise its stake in the bank to above 10%. Berkshire currently has a 9.96% stake in the bank and promised the Fed that it would not try to force a controlling influence. Berkshire has gotten permission from the Fed in the past to own as much as 25% of American Express's stock. And Intel has reached a $5 million settlement with the Labor Department. Now, this settlement is being paid over allegations of pay discrimination against its female, African American, and Hispanic employees. Included in the settlement is $3.5 million worth of back wages and interest paid out to employees.
It's been a rough ride for CrowdStrike since its IPO in June. The stock has tumbled off its highs after recently going public. I went inside the C-suite with CEO and co-founder George Kurtz to talk about the stock and what he's learned from customers. But I want to touch upon the stock price first. You know, it's trading about $55 a share. Hit a high of 101 in August. Has the business dynamics changed? You know, we saw Citigroup, Goldman Sachs come out here recently, voice some concerns. What does that business environment look like for you right now?
Well, we had a great Q2. We reported on that a while back. Triple-digit growth in ARR, as an example. So from my standpoint, we're excited about the business. We continue to add value to customers. We continue to stop breaches. And there's a reason why people like our technology, and we're one of the leaders in the space.
Is your business, is it fair to say it is growing by triple digits? You know, I went through that last quarter, the annual recurring revenue, triple digits, new subscribers, triple digits. Some of the concerns that we heard on Wall Street, are they just overblown?
Well, you know, I think Warren Buffett said it the best. If somebody bought a stock, would they be happy owning it 5 years later if the stock market shut down? And from our standpoint, we continue to just add value to the company, and we think long term. So there's always going to be ups and downs in the stock market, but as long as we continue to service customers, we think that's the best approach.
Now, if I have it right, you recently completed a 100-day trip visiting 100 customers. Hat tip to you for you. Hat tip to you. That's quite the trip. What'd you learn from those customers?
Well, I just put it in perspective. Last week was about 25,000 miles around the globe. So
a lot of miles.
Miles, yeah. So I learned a lot from those customers, and we were well over the 100 mark. So we overachieved on that one. But what I learned is that customers continue to be frustrated with legacy technologies that are out there. They continue to have challenges in protecting against these adversaries and these breaches, and they're looking for a cloud-based solution like ours that's focused on being able to prevent these breaches and leveraging things like AI to be able to identify things that have never been seen before without signatures. So it was very well received, and we're excited that we were able to do that.
When you talk to these customers, are they worried about a recession?
I haven't heard too many concerns about a recession with these customers, and I think one of the areas that security really provides is in the time of a recession. That's when maybe there's less staff and there's more risk associated with a breach. So from a security perspective, we don't necessarily see the spend going down in the time of recession. In fact, it's one of those times where if you don't have the staff, you may actually be vulnerable, and you need the right level of protection to protect against those breaches.
I'm curious, Brian, what he had to say about the 2020 election, being a security company that also focuses on cybersecurity.
Yeah, and it was CrowdStrike who investigated that DNC hack in 2016. So they are preparing for the 2020 election. My takeaway was that we are not prepared for the 2020 election. I believe that was also his take. We have more on that coming out later in the day.
All right, great interview. Thanks so much, Brian. And that's going to do it for us here at the First Trade for this morning. I'm Alexis Christoforous.
And I'm Brian Sozzi. And before we go, let's get one more check of the markets with Inez Ferrer down at the New York Stock Exchange. Inez?
Brian, Alexis, we're looking at the Dow, the S&P, and the NASDAQ slightly lower. The NASDAQ is down about 0.3% as some tech stocks are under pressure this morning. We're watching United Airlines after the company raised its full-year profit guidance. The revenue per available seat mile was up by 1.7%. That came in line with what the street was expecting for their latest quarter. Now, in their press release, they didn't mention the extended grounding of the Boeing 737 MAX jet, but their conference call will be going on in about half an hour, so you can expect that will be brought up during the conference call. Also, Adobe was downgraded at Citi to neutral from buy with a price target of $313. And Slack is under pressure after Morgan Stanley cut its price target on Slack to $28, maintaining an equal weight rating over concerns from competition from Microsoft. Stay with us. Wi-Fi AM is up next. Don't go anywhere.
morning and welcome to Wi-Fi AM at Yahoo Finance on this Wednesday morning. I'm Dan Roberts. We've got Kristen Myers and Heidi Chung on the couches to go over all the business news of the day. Let's check markets. We are seeing red for the time being. Right now, all three major indices in the red, trading lower. The Dow down 55 points, just 0.2%, and the Nasdaq down 35 points. S&P in the red as well. But we have to start the morning talking about the night. Last night, 12 Democratic presidential candidates filled the debate stage once again, and many people felt that Elizabeth Warren emerged as the new frontrunner. Sorry, Joe Biden. Now, the candidates came across as united around the topic of impeachment, divided around the topic of health care. We are going to break it all down with our panel this morning. Joining us remotely from D.C. is HuffPost senior reporter Arthur Delaney. Arthur, thanks for coming on. And here on the couches with us, we've got Bradley Tusk, founder and CEO of Tusk Ventures. Bradley, thanks for being here.
Thanks for having me.
All right, guys, let's start with Elizabeth Warren. As I mentioned, appearing to become kind of the front runner. Of course, her big theme of the night was going after big tech. Let's take a look at a clip of Warren.
Look, you get to be the umpire in the baseball game, or you get to have a team, but you don't get to do both at the same time. We need to enforce our antitrust laws, break up these giant companies that are dominating big tech, big pharma, big oil, all of them.
Arthur, let's start with you. Of course, these candidates are always going for a pithy soundbite. I actually liked that comparison. I like Elizabeth Warren making a baseball comparison. How did you think it went over, and how did she do overall last night?
She did well. I mean, her front-runner status has sort of emerged from polling that shows her tied her in the lead with Joe Biden. And the way the debate went really reflected that, with everyone attacking her. But on this answer, antitrust, I think she had the energy, and nobody really attacked her very forcefully. Andrew Yang said, well, breaking up big companies isn't going to give our children healthier diets, which didn't make a lot of sense. So she's sort of out in front on that one. And I don't think that's an issue where the other candidates, except for maybe Amy Klobuchar, feel really strong.
Bradley.
Yeah, I mean, she owns this issue, right? And she's captured it really well and played. What's really smart about it is the people on the left who vote in Democratic primaries really like her position on Amazon and Google and Facebook, and yet it kind of makes sense to most other people too. So it resonates across the board. So I'm not sure she did well consistently across the board last night, but I think on this issue she continues to succeed.
Bradley, I'm wondering if you think, as you know, corporations and the wealthy, right? Because a lot of these politicians also talked about the wealth tax, for example. As they listen to these debates, should they start getting worried as Warren really kind of breaks away from the pack, that maybe life as they knew it is now ending?
The only thing that's inevitable is change, right? And if Trump is not reelected, at the moment, if you had to guess, you would say Elizabeth Warren is the most likely person to be the president next. And she will definitely try to change a lot of things. Now, will she be able to move any major legislation through Congress? History says no. Most presidents are unable to. But the power of the executive branch is very strong. And if you are any of these companies that can be investigated by DOJ for antitrust or anything like that, you're going to have a world of hurt in front of you.
You mentioned the billionaire angle, and I saw a very good tweet from my friend at HuffPost, Emma Gray, who said, we have reached the point in the night where Elizabeth Warren has to clarify that she doesn't want all billionaires to die. Right. I thought that was a very funny tweet. We are talking about the idea that the polling has now reflected Warren as maybe the frontrunner instead of Biden. I want to mention that we are hearing reports that Mike Bloomberg is maybe considering running. We saw that he said that if Biden were to sort of fade away, maybe he'd still come in. And of course, you were a former advisor to Bloomberg or consultant.
I was just campaign manager.
Okay, campaign manager. So let's talk about that. I mean, at this point in the game, isn't he a little late?
Yeah, I mean, look, on one hand, because he has a ready infrastructure, basically an unlimited amount of money and so much credibility, if anyone could jump in at the last minute and be prepared, it's him. But with that said, I think that it's a fun story for reporters to talk about. But realistically speaking, absent Biden dropping out, Mike partly chose not to run because he didn't see a path with Biden there in the centrist lane. And, Biden didn't have a great night last night. Things are not going particularly well. No. But I don't see him dropping out entirely in the next couple of weeks.
Arthur, how did people in D.C. react to this report about maybe Bloomberg isn't necessarily fully decided not to run?
Well, it's a little surprising because, like he said, he previously evaluated this option and said, I don't see a path. And nobody in D.C. sees a path either. We had 12 people on that debate stage. We added a billionaire for that debate, Tom Steyer. He had almost no impact on the evening. And I think that makes it even harder to imagine how someone like Michael Bloomberg, well-known and well-funded as his campaign would be, it's hard to see how that would be effective or successful in this primary.
Arthur, what were your thoughts on Andrew Yang kind of having his moment? His freedom dividend actually got a lot more debate going than a lot of people were thinking.
Oh, well, I mean, he's always been able to get viral moments from this campaign that he can broadcast to his intense base of supporters. But I think he never gets a great chance or does a great job of explaining actually how this would work, especially considering that the proposal involves a lot of hand-waving at the existing massive social insurance and public benefits infrastructure that has been built up in this country through like 100 years of policymaking. So I think he'll sort of continue on this low simmer path that he's been on, but I can't imagine he'll break through to the top tier of candidates.
Arthur mentioned Tom Steyer not necessarily having much of an impact. Speaking of low impact, Klobuchar has struggled recently, Amy Klobuchar, and some people thought that maybe the last few debates really haven't gone so well for her. Clearly last night tried to come out and kind of hit harder and be more of a presence. Let's take a quick look at a clip of Klobuchar from last night's debate.
But I want to give a reality check here to Elizabeth, because no one on this stage wants to protect billionaires. Not even the billionaire wants to protect billionaires. We just have different approaches. Your idea is not the only idea.
So, Bradley, did she help her case anymore?
A little bit. I mean, on paper, as Biden seems to implode, and maybe, though Sanders seemed perfectly healthy last night, but maybe the heart attack at some point knocks him out of the race, and you say who could be the moderate alternative, Klobuchar, like Buttigieg, at least on paper qualifies as that. But in reality, she hasn't really broken through in most of the debates. She was a little better last night, but I think we're grasping at straws here.
I want to ask actually both of you, but Bradley, let's start with you, about impeachment and the inquiry and how that involved essentially Hunter Biden. I'm wondering how you thought Joe Biden handled that last night.
Poorly. Here's the fundamental problem, I think, with Biden and his campaign on this issue, which is they keep making the clear distinction saying Joe Biden did not break any laws. And let's just stipulate for sake of argument that that's true. I think what they don't get is when most people look at his son, who is in no way qualified, making millions of dollars just because of his last name, people find that corrupt across the board. Democrats, Republicans, independents, liberals, conservatives. And I think that until he can sort of understand that and come to terms with it and speak about it, he's always going to be trying to parsing these differences that really don't mean anything.
Now, of course, having to respond to it at all, Arthur, I'd love your take there. Joe having to say, look, my son didn't do anything wrong and I didn't do anything wrong. Even being forced to respond up there, and of course we saw that Hunter Biden did drop off that board, sort of legitimizes a lot of the attacks that have come from the Trump side against the Bidens.
The debate moderators put this question to Biden really well. They pointed out that just the other day, Vice President Biden, you put out an ethics and government plan, which obviously was designed to highlight the collapse of ethics in the Trump administration. But he talked about not having family members in cabinet positions, and it really served to sort of validate the idea that your family members riding your coattails is not a good thing. And so even though Joe Biden said, my son did nothing wrong, I did nothing wrong, I thought that the way that the issue was presented by the moderators was definitely unfavorable, and there's really nothing he can do besides say, I didn't do anything wrong, and by the way, Trump is worse. It's sort of a muddle.
Absolutely. And since we are talking about the topic of impeachment, we want to mention that President Trump tweeted this morning in reaction to the debate. He said, you would think there is no way that any of the Democrat candidates that we witnessed last night could possibly become president of the United States. Now you see why they have no choice but to push a totally illegal, absurd impeachment of one of the most successful presidents. So an interesting tweet. Now, Bradley, while we have you here, we want to make sure that we ask, you are working on a blockchain voting initiative in some states, Utah, Oregon. Tell us a little bit about that while we have you.
Yeah, so the main thing I learned from my time in politics is that every policy output is the result of a political input. And if you want things to change and Congress to get together and pass legislation on climate or guns or immigration, they've got to have the political will to do so. And when you live in a world where almost every election is determined in the primary, and primary turnout is 15%, of course we can't get anything done because it's either the most far left or far right people voting, and they really set the tone. So the one thing where we could all potentially participate in elections a lot more easily is if we could vote on our phone. Blockchain makes that a lot more secure and feasible. So we've been funding and running elections now. We've done in West Virginia, Utah, Denver, announcing today a couple of counties in Oregon. So far it's been for members of the military who are deployed overseas, but today Utah announced that people with disabilities will also now be able to vote over their phone in this coming election. And my hope ultimately is that we live in a world in 5 years, 7 years, whatever it is, where everyone can vote on their phone over the blockchain, and participation goes from 10, 15% to 70, 80%, and we can finally start getting things done.
Something Andrew Yang would approve of.
He's for it.
The Bitcoin candidate.
Yeah, he's come out for it.
So do you think everyone will vote then if they just have easier access
So
on their cell phones?
what I
it seems
learned-
like apathy is the biggest
Right, it's
hurdle
not just
to
not
overcome.
getting to a voting center.
Yeah, so it's interesting. So when I kind of transitioned from politics to tech, the way I did it was by running all the campaigns to legalize Uber and ride sharing around the country. And the way that we beat taxi, which at the time was a strong cartel, was that regular people, ultimately a couple of million of them, were willing to weigh in on our behalf, whether it was email or tweets or text to their elected officials, and that's what won the day. So, and look, we were just one for-profit company. So I think that what I learned from that is if you make it really convenient and easy for people, they do want to participate, but they're not going to miss work or not take their kids to school or anything else and find a random place and wait online on a rainy Tuesday.
Right. All right, really good stuff. There's so much more we could discuss, but we've got to leave it there. Arthur Delaney, thanks so much for joining us from D.C. We'll check back in with you soon. Bradley Tuss, thanks for having me. Good stuff. All right, coming up on the show, new twists and turns in the opioid settlements with big drug makers. We will give you an update after a quick break. Welcome back to Wi-Fi AM at Yahoo Finance. Markets right now in the red for the moment across the board. Let's get some more insights on exactly what is happening. Let's check in with our friend Ines Ferre, live on the floor of the NYSE. Hi, Ines.
Hi, Dan. Yeah, well, we're looking at tech that's a little bit under pressure this morning. You've got the NASDAQ that's off about 0.3%. I want to mention the HMI Home Builder Confidence Number, which came out this morning. That came in at its highest level for October since February of 2018, thanks, of course, to lower mortgage rates. Also, this morning we're watching Slack. Slack is under pressure after Morgan Stanley cut its price target on Slack by $10 to $28, maintaining its equal weight rating, but citing concerns over competition from Microsoft. Also, Workday is under pressure as Wall Street is starting to weigh in on Workday Rising. That's a conference that Workday just held where they unveiled some AI-based apps and features. And RBC cut its price target on Workday to $212, still maintaining, though, its outperformer rating on the stock. Macquarie said that they announced new products which may be difficult to monetize. Now, so Macquarie has a neutral rating on the stock and a price target of $196. And then also this morning we're watching Sleep Number after a big beat for its latest quarter, beating on earnings. Sales came in above what the street was expecting. The company said a big driver for them was their Sleep Number 360 smart beds. Dan?
All right, thanks, Inez. We'll check back in with you really soon.
See you soon.
Now, Now, 3 of the largest drug distributors in the U.S. are reportedly negotiating an $18 billion opioid settlement. The deal would end a number of those lawsuits that have been brought by state and local governments that are seeking compensation for costs associated with the opioid crisis. And our friend Anjali Khemlani joins us now with more. Anjali, what's up? And would this get rid of, or I guess I should ask, what sort of percent of the ongoing lawsuits would this get rid of? Because there are hundreds and hundreds and hundreds of these still active.
Right. So the players are what's important, right? So we've seen already Endo, we've seen Johnson & Johnson, and we've seen Mallinckrodt already settled, and that takes them out of the lawsuits. It still puts them on the line for some of the others. But it just depends on like which lawsuits they're looking at. They're targeting this first one that started. And so that is what we're looking at right now is, will they get it done in time? Because just the news, it's just news of a tentative settlement. It hasn't actually been confirmed yet. And jury selection starts today, and the trial starts Monday.
Talk about 11th hour.
So it really is 11th hour. So that's why this is like so high profile right now.
Now, this batch or chunk of lawsuits that we're talking about being settled, Ohio is mostly done.
Correct.
Where are these lawsuits coming from?
It's the same.
This is still Ohio.
So this is part of that whole multi-district, right, litigation, yeah.
So I'm wondering if you could put that 18 billion number in context for us, right? Is that a lot? Is it a slap on the wrist? I mean, how little or how big is that in terms of what was wanted?
It's pretty decent. We were looking at the AGs talking about anywhere between 10 to 45. I think 45 is the max that we heard them ask for. It's huge compared to what the pharma companies have offered.
Yes.
So those have been in the range of like
million.
10 to 30 million, exactly. And those are for varying degrees of settlements and varying lawsuits. So it's very, very, very complex in terms of which lawsuits these apply to and how much the amounts have been.
So Johnson & Johnson is not involved in this specific.
It was. This is the one that it pulled out of by settling the 20.4.
They're still dealing with a bunch of other opioid-related issues as well.
And the thing that's on the table is that really large one, speaking of the piggyback that you were talking about, is whether or not all of these companies can piggyback off of Purdue Pharma, the maker of OxyContin, their lawsuit and their bankruptcy, because they'll have to set up a bankruptcy fund. So the idea is, can they piggyback off of that to just inject money and do the payout from there and not be liable for essentially anything?
It's funny optics-wise because when these companies announce a settlement or when there's news or rumors of they're edging toward a settlement, you might think that the interpretation would be, I mean, traditionally in law, settling shows that you think there's a chance you might not win / you think maybe you are liable. It's an acknowledgement of some sort of liability, even if the settlement specifically has the language of this does not include admission of liability. But come on. And yet, when there are these reports, the stocks go up because people say, oh, good, it's been handled. And in addition, optics-wise, you wonder, well, does this look bad? Does it look like, okay, see, you were responsible for the opioid crisis, but instead it seems like most people decide that it doesn't look bad.
I don't think that the optics look bad when necessarily just because you settle. I don't think
that's what I'm saying. They look good.
No, but that's what I mean. I understand why it looks good and why investors would be happy. So to your point, a lot of these settlement numbers tend to be a lot lower than what the prosecutors want. Can you imagine them paying out $45 billion? 18 billion is really is small potatoes when you really compare it to that number. And then they get to just move, they get to push the case to the side. They don't have to worry about it anymore, and then they get to go on with their business. So yeah, settling is great for them.
It also reduces the drama that's going to unfold, right? Because if you think about it, they're avoiding the further optics of whatever would come out in court. And so to the point about the amount, like let's take Johnson & Johnson, for example, right? They're $20.4 million for that one case for 2 counties. If you multiply that by, say, let's say they're involved in all 2,500, that puts them at about 50 billion. So, but that's not going to be the number, obviously, but it gives you a sense of sort of like where they're benchmarking even.
Wow.
Settling says they acknowledge that it's not going away, but they need to put it to bed.
Right.
So.
Yep. All right, Anjali Khemlani, thanks so much. I'm sure there'll be more settlements to come.
Absolutely.
So we'll have you back on.
All right, so continuing this conversation on the opioid crisis, presidential hopefuls also spoke about the issue last night during the Democratic debate. Senator Kamala Harris made headlines after she said this about pharma execs. Let's take a listen.
Are you in favor of sending those drug company executives to jail?
I am. And I will tell you, as a former prosecutor, I do think of this as being a matter of justice and accountability because they are nothing more than some high-level dope dealers.
All right, well, here to discuss is Yahoo Finance's Adriana Belmonte. So, Adriana, I know you've been talking or you've been writing a lot about this issue. So, first, want to get your reaction to what Senator Harris said last night about if she were president, she essentially would throw a lot of these opioid execs in jail.
First of all, I was just really excited that it finally came up during the debate because it took 4 debates for the topic to be discussed when, there's other things regarding healthcare that's continuously asked over and over again. And I think it's such an intricate part of the healthcare system. But yeah, it was really interesting what Kamala Harris said, and it seemed to be a common theme among a lot of the candidates to hold the pharma companies accountable. Amy Klobuchar was actually the first one to kind of bring it up and say we should tax a 2 cents per milligram tax on these companies and use that money towards helping rural areas dealing with addiction.
That would add up.
Right. So we were obviously just talking with Anjali about the lawsuits and the number in terms of fines. But I'm wondering, as you've been doing a lot of your reporting and you've been sort of taking a temperature read on this, if you are hearing or getting a sense that people actually do want to see not just, these executives for these big pharma companies, but even some pharmacies or doctors going to prison or essentially paying the consequences, so to speak, for this opioid crisis?
Yes and no. I think that it's very common to blame pharma companies for it, but just the more research I've done, it seems that, that's not the only thing that's going on. There needs to be other solutions as well. Andrew Yang, actually, he talked about harm reduction sites, safe consumption sites, and even decriminalizing it. And that's another alternative that's being talked about more and more in these circles about how people are still going to be using the drugs. At least they could be using it in a safe manner. So I just thought that was a really interesting alternative and kind of giving a voice to other minorities, minority opinions, I should say.
Any of the frontrunners, do they have any viable solutions to this opioid crisis at all? Do they have any positions that you think are actually legit?
One thing to say, put people in prison.
Right.
How will you actually stop this crisis, which is hurting Americans and killing people?
So a few of the candidates have released specific opioid plans. I took a look at Elizabeth Warren's when she released it months ago. There was a few other candidates as well, but from the experts that I talked to, hers got the most positive feedback because, again, it talked about harm reduction alternatives, just money going towards the right places. So hers seems to be the best. She didn't really get to talk about it, though. I don't think she got a chance to speak on that question during the debate. So that would have been interesting if she could have talked more.
So I don't know if this necessarily has an answer, so I'm just going to throw it out to all of you guys. But I'm wondering, as we talk a lot about alternative pain management, we've talked a lot about CBD, we've talked obviously a lot about marijuana. We have a lot of these cannabis companies, exploding right now. If we're going to start to see a hard pivot away from opioids, I don't think they're going to go away completely, but if we're going to start really seeing a lot of these pharma companies really pushing out other drugs so that they don't have to keep pushing out
And
these
it starts with
opioids
not
anymore.
prescribing those
Right.
anymore when someone needs painkillers or some kind of pain relief.
The problem is, though, it takes away from the people who have chronic pain, who genuinely need it. So it's going to be, that's going to be a hot button issue, I think, coming up.
Alrighty, thanks, Adriana.
Thank you.
Good stuff. We'll get an update soon on the opioid crisis and the campaign. We'll be right back after a quick break here at Wi-Fi AM.
Welcome back to Wi-Fi AM. It is time to take a look at today's trending tickers. First up, we have United Airlines shares flying high this morning after the company reported a third quarter earnings beat after the bell yesterday. Now, revenue came in slightly lighter than expected. Revenue per available seat mile, now that's a key metric for these airlines, rose 1.7% during the quarter and was in line with estimates. United saying clear skies ahead as the airline also raised its profit guidance for the full year. Top of investors' minds, though, is obviously the impact of the 737 MAX grounding. CEO Oscar Munoz saying in an interview earlier with CNBC that United would have had about 80 to 100 flights in the air if it weren't for the grounding of those 737 MAX jets. But he isn't too worried about competitors taking away market share because of those groundings. Now, United's conference call does kick off in about 6 minutes, so I'm sure analysts will be getting a lot more questions with management about those 737 MAX woes. What do you guys think about the quarter overall? Because Delta also reported a beat last week, but their guidance wasn't rosy at all, and so we saw the stock sell off a bit. United's not the same narrative, it seems.
Well, there are the ripple effects of the Boeing 737 MAX groundings, and then there are just headwinds, pun intended, sorry, facing the airline industry overall.
Right.
Travel trends.
Right. Airlines have actually lagged the broader market. Yes. Obviously, United doing pretty well. But no, oil prices have generally helped this industry. MAX groundings, I was actually surprised that they weren't more impacted. Because Delta, obviously we knew Delta wasn't really impacted by those groundings because those planes weren't a huge part of their fleet. But we knew that United, Southwest, for example, were heavily impacted. So to see them have a whole beat and raise quarter, despite that headwind, is pretty shocking
for investors.
It is very encouraging. And I think if you are an investor in United, it's a really nice turnaround after all the bad headlines that airline has had the last couple of years. Obviously, a new CEO. So, I mean, great for United. That's my nice wrap.
It is interesting, I will say, in this industry, how many of these CEOs have been embattled or gone through a time of scandal. I mean, Oscar Munoz had the United, Dr. Dow.
Yeah.
I mean, and he had to answer tough questions for a year, and people said, oh, get him out, and he's still CEO. And Dennis Muhlenberg of Boeing, still CEO. Of course, they took away the chairman title and split those roles, but it is interesting. It's a resilient industry. There's a scandal, and then they're okay.
And the race to the bottom actually hasn't impacted these big airlines, which we don't talk a lot about. As we see a lot of these low-cost carriers trying to come in and take away market share, it's largely failed, and to the point that these larger companies have been able to really keep their market share, and these other companies, these low-cost carriers, have essentially gone bankrupt.
Well, the low-cost ones are great while they're around, but then you can never trust. You buy a ticket 6 months out, it's out of business.
Right. Exactly.
All right, so moving on to our second trending ticker today, online messaging platform Slack shares are under a lot of pressure in early trade after Morgan Stanley slashed its price target on the stock to $28 per share from $38 per share. Now, that new price target actually represents about a 13% move higher from the current trading levels. Now, analyst Keith Weiss reiterating his equal weight target, but citing rising competition and a weaker environment for IT spending for the price target cut. And by competition, of course, he means tech giant Microsoft, which is right now currently still the most valuable company in the world. It is spitting distance from record highs. Now, it can't be stopped at this point, and I think it's a valid argument.
And Microsoft has avoided a lot of being a part or being dragged into a lot of the conversation that we've heard from regulators and politicians about antitrust laws and wanting to break up these big tech companies. You haven't heard Microsoft's name included when they say Facebook and Apple and Alphabet or Google. No, I mean,
it already happened.
It already happened to them.
Way back in the day,
But if you look at when it specifically comes to Slack, Microsoft is pretty much giving teams away for free, trying to crush Zoom, trying to crush Slack. And as a lot of these companies don't want to spend as much anymore on their IT software, they're going to migrate towards a bundle that is free. Microsoft is crushing them right now.
Part of me wonders if the threat of Microsoft's chat platform, Teams, to Slack has been a little over-exaggerated, or at least it's certainly a threat. It's a competitor, and Microsoft's so big, and they have scale, and yet, many companies use and like Slack. That's why it was able to go public and why it had a big valuation and why the IPO
But are
went
they,
pretty
though?
well at
Are
first,
a lot
the
of
direct
companies
listing.
paying for Slack, though? That's the problem.
Well, I don't know the answer to that, but my point is, are they just going to suddenly, on the snap of a finger, switch to Microsoft?
You know what? I think because we actually use Slack, and so I think we're all very familiar. But as I'm talking to people, I don't think Slack is as popular as we like to think it
Certainly
is, or as popular as it should be.
But like,
every media company
at this company, remember they got rid of all of our Microsoft Office capabilities because they don't want to pay for that big enterprise situation. But a lot of companies do pay for it. And so if you are already in the Microsoft ecosystem, it just makes it easier to use Teams.
Sure.
So in that kind of situation, I think,
I do also wonder if it turns out, let's say in 2 years, boy, it's exactly what some are predicting. Microsoft's Teams is growing like a weed. Slack is really facing problems and losing a lot of customers. Could an easy out that Slack always has in its pocket be to just sell to Microsoft?
Right.
And then Microsoft merges them, takes whatever tech it wants, takes the design, takes some people, cuts a lot of jobs. That could happen.
That is a narrative that we absolutely could be talking about.
All right, we're going to go to a quick break, but when we come back, Yahoo Finance sat down with the Facebook executive behind Libra. You will not want to miss that chat, so stay with us. Welcome back to Wi-Fi AM at Yahoo Finance, where we are monitoring the markets, and markets right now in the red. But let's talk about Facebook, and specifically Libra. The Libra Association lost 7 members last week, including Visa and MasterCard. But this week, it locked in 21 official founding members at a meeting in Geneva. And Facebook insists that those exits are no problem, and Libra will launch. Our own Brian Chung is in D.C. He sat down with David Marcus, Facebook's Calibra head, to talk about Libra's trials and tribulations. Hey, Brian, what did he say?
Hi, Dan. How are you? So it's been quite a crazy last few weeks for the Libra project. Again, this is Facebook's ambitious goal to try to make its own cryptocurrency using a network of partners, including, as of a few weeks ago, PayPal and Visa, eBay. But all those merchant processors have since decided to drop out from the project. And I had the chance to sit down with David Marcus, again, the head of Calibra, which is the subsidiary that Facebook is using to head this project, and asked him about whether or not that poses any sort of challenge to the project. And his message, absolutely not. Here's what he had to say.
Absolutely not. By the way, this was last week's news, for what it's worth. So look, first and foremost, you need to really encapsulate the spirit of what we're trying to do with Libra, right? We're trying to innovate at the core of the financial networks that help move money around that haven't evolved in the last 50 years. There's been a lot of innovation at the edges of the network in terms of fintech innovation, but at the core, it hasn't evolved. And, the change a change of this magnitude really requires a lot of fortitude to actually see through as a member of an organization like this. And so, we have now 21 members that are full-time, now members. We have a board that has been elected just yesterday. So we have a fully functional association since yesterday, which is great. And we're moving ahead. And again, one thing that is not well understood is that you don't need to be a member of the Libra Association to build services and products. So, if Visa and MasterCard want to issue cards for Libra Wallet at a later stage, they can still do it without being members of the association.
So you tweeted that, of course, it's not great news in the short term, but in a way it's liberating. Can you expand a little bit on that? I mean, it was seen that these payment processors were going to be maybe a bridge between Libra and the many merchants or parties that take PayPal or MasterCard and whatnot. So does it change the use case? Is that the way that it's liberating for you?
No, it doesn't change anything in terms of the use case because, like I just said before, you can still build all of these services by not being a member. And this is an important distinction. If you're a member, that means that you're committed, that you have passion for solving those very issues that plague billions of people today. The fact that 1.7 billion people still don't have access to modern financial services, that it still costs on average 7% to send money cross-border, that people who can afford it the least pay the most for basic financial services around the world. So if you're passionate about this change, it's going to take a lot of work, a lot of courage, and I understand, honestly, and I respect the fact that in the first place, all of these companies really joined because they believed in this and had the courage to look at potentially disrupting themselves and a part of their business to really take this on. But I also understand that they have a responsibility to their shareholders and to their stakeholders, and they were under a lot of pressure. And so again, I respect their decision, and there's going to be plenty of opportunities for all of them to participate in this later.
And David Marcus later on in that interview saying that things are probably going to get harder before they get easier. And then one of those challenges is really trying to get the regulatory approval for this project. Actually, I'm here at the International Monetary Fund annual meeting in Washington, D.C. David Marcus is actually here and will be powwowing a lot with central bankers and also international regulators, having some of those conversations. And again, it seems like a long road ahead, but now that they've officially formalized their structure earlier this week, it seems like David Marcus is still pretty optimistic that this project can go on. Dan?
Hey, Brian, it's Heidi. So great stuff there. But one thing that really stuck out to me about what Marcus said was that, well, Visa and MasterCard don't necessarily have to be a part of the association, even if they wanted to release cards later that were compatible with Libra. Did you get a chance to ask him a little bit more about that? Why would they even pull out if that was the case?
Yeah, and that's a great question. And David Marcus again saying that you don't have to be part of the founding membership in order to take Libra or use Libra. In fact, any company later on down the line, because keep in mind, this is still just a white paper, just a concept at this time, can be part of the Libra network. But as far as the founding association, again, what is now 21 members as part of this formalized structure, which they hope to expand to 100 by the time it launches, they do say that those members will be more integral in terms of deciding exactly how Libra operates, how it's being developed, how it's being used and structured, even to the minutia of what types of currencies actually back the Libra's cryptocurrency itself in the reserves that the Libra Association, or rather Calibra, will be holding. So those are all decisions that will be made jointly. Keep in mind that Facebook is heading the project, but they created the association so that it has more of a board structure where every single company will have kind of equal say in deciding how the development of this product goes on. So that's kind of why he was saying in that clip that I just played to you that if you're a company that wants to be part of this association, you really got to have the courage to kind of go through all the regulatory hurdles, because it's not easy and it does require a little bit more due diligence than if you were to simply plug and play as a peripheral partner of the project as opposed to one of the founding members.
Sure, courage is one word for it, Brian. Good interview with David Marcus, good pushing, and so much more to discuss about Libra. So we'll keep monitoring, and we'll see you back here on the couches here on Wi-Fi AM soon.
Thanks, Dan.
Now, coming up on the show, nearly half of people are not prepared for a recession, according to a new study we will discuss, so stay with us.
Welcome back. I'm here with Alan Valdez from Silver Bear Capital. Alan, retail sales came out this morning. We're looking at a flat picture right now with the Dow, the S&P, and the Nasdaq. What do you make of the retail sales that came out?
Well, they were a little disappointing. This economy's been powered by the consumer. And coming into the holiday season, you want to see retail sales a little more robust. I mean, again, if you look at September, they were ratcheted up, I think, 0.2%. So that takes a little out of the minus 0.3% hit we took this month rather. So we'll have to wait and see.
This week, what are you watching for this week?
Well, the techs, of course, will be in play, but more importantly, Netflix. We're going to watch Netflix. Netflix has to come in with a good subscriber base. I mean, if they come in anywhere like 2 million or less, forget it. The show's over for them for a while. I mean, you got a lot of competition now with Disney streaming, with Apple TV. It's going to be interesting to see how Netflix does, because last quarter they had a bad quarter also with subscribers, and that's what's going to weigh on them.
So what will it take for us to go back to all-time highs?
Well, funny you mention that, but right here, we're at 26,990 basically. I mean, let's get over 27,000 again, which we did the other day. I think you got to get the trade talks moving again in a positive way. Now there's a little risk that things are going to stall there again for the 100th time. If they start to move, then yeah, you could see this market take off.
Thanks so much, Alan Valdez from Silver Bear Capital. Stay with us. Wi-Fi AM continues after the break.
Welcome back to Wi-Fi AM at Yahoo Finance. Markets right now in the red across the board. However, the Dow off the lows that we had seen earlier. It was down more just minutes ago. Right now it's down 36 points, just 0.1%. And the Nasdaq and S&P in the red just barely as well. Now, speaking of red, let's talk about the possibility of a recession. Now, if the U.S. economy slips into a recession in the next year or two, would you be prepared? A new survey from Bankrate finds that 4 in 10 Americans would not be prepared. Our own Sabile Marcellus took a closer look at the survey. Here she is now. What do you make of this? And is it so surprising? I feel like we do often hear, this to me is a similar kind of story to the one of the average person isn't ready for an emergency $1,000 expense.
Yeah, so we saw retail sales came out and they were disappointing, and that's not surprising because a lot of consumers are facing a lot of pressure. When it comes to the economic forecast, it's kind of cloudy right now. We're seeing a slowdown when it comes to hiring and also a slowdown when it comes to GDP. So we have unemployment rate is 3.5%, 50-year low. Yeah, that's fantastic. But a lot of Americans are saying, you know what? I'm going to be cautious about this because that number could go back up. What can I do if there's actually a recession? So Bankrate did a study to basically find out how Americans are preparing should there be a recession. And what they found is that 4 in 10 Americans are saying, nope, not ready if there's a recession. I don't know what I'm going to do. I'm going to be caught pretty much off guard. So the good news here,
millennials the worst off.
Yeah, right. Of course, definitely. So the good news is
they're the best off. They're 74% of millennials are prepared for a recession.
Okay.
Yeah,
correct?
so they're
right. Yeah.
Oh, I read that wrong. You're right.
Let me clarify that. So when it comes to millennials, so there's a generational divide in terms of those who are preparing for a recession. Millennials, a lot of them graduated into the recession, so they have flashbacks. They remember how terrible that was and how difficult it was. So there are more millennials preparing themselves, taking active steps than other generations like Gen Z or baby boomers. So the most common step people are taking to protect themselves from a recession is, number one, cutting back on spending. Also, what they're doing is cutting back on on, they're actually paying down credit card debt, and they're also increasing savings when it comes to retirement and emergencies. And a small percentage are actually looking for another job so they can make sure that they're more financially secure. So that's obviously challenging, but those are all the things that people are doing to protect themselves.
So I have to ask, Sabeel, what exactly, I know we're talking about, paying down credit card debt, saving more, but really, what does recession preparedness actually look like? Does that mean, I have 6 months of my salary saved in my bank account so I can pay for my rent and my expenses while I'm searching for a job if I lose one? Exactly what, we talk a lot about recession preparedness, but what does that actually mean?
Or I've taken my money out of stocks.
Right. What does it actually mean to be prepared for the recession?
So it's not one size fits all. So everybody has different needs. You may have one child, you may have 2 children, you may be alone, you may be single, but you have a very expensive apartment. So that's why we're not seeing like the one number, the one stat, and this is what you need to do to protect yourself from a recession. You got to figure it out based off of your own expenses. But in general, experts say that if you have 6 months worth of income saved up, then you're in better position should there be a recession. But of course, if there's an actual recession, how long are you going to be outside of a job? So you got to kind of figure out kind of how long that's going to take and how much you're going to need and figure it out for yourself.
And surprise, surprise, people that are not earning as much are going to be the hardest hit.
Sure.
Yeah, and that's the thing. So there's a third of Americans who are not taking any steps to protect themselves from a recession. And you think those are the people who are making the most money, those who are earning $80,000 a year or more, but it's actually the reverse. So it's those who are at the lower end of the income spectrum, those who are making $30,000 and less, they're the ones who are more likely not to be doing anything at all should a recession hit.
I mean, I would think that. It's hard to prepare for a recession when you can't even pay
you don't have a
your
lot of
current
money.
expenses.
Yeah, absolutely. So preparing, it helps when you have, the likelihood increases when your income goes up.
Let's just hope it doesn't happen.
Right.
Fingers crossed. Eventually,
Well, it will. It will. Just when.
Long bull run. Sabeel, thanks so much.
Thanks.
Okay, coming up here on Wi-Fi AM, Jim Beam opens an Airbnb. What? We'll explain after a quick break. Welcome back to Wi-Fi AM at Yahoo Finance. Markets right now are in the red. Meanwhile, earnings season is in full swing. Of course, earlier this week we had big healthcare earnings and bank earnings. Today, we will get Netflix and IBM third quarter earnings after the bell. Netflix earnings always heavily in focus, a big topic of discussion. And here to talk both is the Synovus Trust Vice President, Dan Morgan. Dan, thanks for joining us. And let's start with Netflix. What are you expecting?
Hi, Dan.
Of course, always about those subscription numbers.
Well, yeah, you're right. I mean, everyone's going to be focused on that. Obviously, as you were speaking about before, second quarter subscription numbers fell really short. Consensus 7 million total new subscribers, because most of that coming from the international front at 6.2 million and only 800,000 domestically. So that's going to be the key number that everybody's focusing on, Dan, because as you know, we have Disney coming out with their Disney Plus. We have Apple TV going to be releasing their new streaming services starting in November. So this is the last quarter where we'll close out without a real pickup in competition. So it'll be interesting to see how those subscriber numbers come in.
Dan, Kristen here. So I'm actually really glad that you mentioned Apple TV Plus and Disney Plus. I'm wondering how much pressure you think that they're going to apply to Netflix going forward. How important is international subscriber numbers going to be for Netflix growth story?
Well, you're right. I mean, the international side is the story. As I mentioned, only 800,000 domestically. That's where they get most of their growth. What's interesting, though, is are we going to see a substitution effect where, let's say, because these are lower priced, right? The Disney is at $6.99, Apple's at $4.99. Netflix averages between $12 and $15 per subscriber. Are we going to see some of these international subscribers that may not have the same incomes that we do here in the U.S. be more attracted to these lower price streaming services? I think in the U.S. they're complementary. I think people might have a Netflix and a Disney and maybe one more service. But overseas, it'll be interesting to see if Disney can get a shoe in and start to kind of eat away at the growth that we're seeing on the international front. As I mentioned, 6.2 million subscribers expected.
Dan, just to push a little bit further on the Netflix, Disney Plus, Apple TV Plus competitive landscape, you know, one argument I'm starting to hear now, as you mentioned, Disney Plus and Apple TV Plus price much lower. Apple TV Plus price so cheaply, it's almost an impulse purchase. But now you're starting to hear the argument, instead of, oh, that's a threat to Netflix, well, maybe Netflix, it's good that it's priced higher. It's sort of like Netflix moves into the role of being the premium offering. Now, of course, Apple probably wants to think of itself as premium, but when you price it that low, that's really not the case. Apple practically giving it away because they're offering a full year with the purchase of any new Apple device. What do you think of that argument that maybe Netflix is fine because it becomes positioned as the sort of fancy one?
Yeah, right. I mean, it's the Premier, it's the Mercedes-Benz, it's the Rolex, right, of the streaming video service. And, you know, the key really for me when I look at this is obviously content, right? And you look at Netflix, you guys have talked about it before. This year they'll probably do $15 billion spend rate on content, looking around $17.5 billion next year. I mean, really the only one close to them is Amazon, which we really haven't talked about in regards to Prime. They're about $6 to $7 billion in terms of spend rate, but Apple is only $1 billion. Disney is more of a catalog company, right? They got Pixar, they got Star Wars, they got all these great things, Marvel. So they're more of, hey, we already got the big database here. So I think you're right. I think, Dan, that Netflix could target themselves as kind of the premier service with the new shows, with the content, and that way they could be able to kind of outdo some of these lower price services.
Hey Dan, it's Heidi. So I want to shift gears here and talk a little bit about IBM. First and foremost, a couple of things that I'm watching is this is the first quarter that we're going to see how that acquisition of Red Hat really played out for the company. And second, you know, IBM has kind of been a laggard when it comes to old tech companies kind of cementing their presence in a new technology world, kind of like Microsoft. And specifically, IBM's cloud business has been a real laggard in the space. So what are you predicting in terms of that Red Hat acquisition as well as the cloud growth, excuse me?
Well, you're right, Heidi. And, you know, I still think it's a little bit too early. If you look at consensus estimates for this year, fiscal year 19, roughly earnings were brought down by about $1, about same amount next year, 2020. So really the Red Hat deal is not going to become accretive towards earnings, and you mentioned the cloud, till probably 2021. And, you know, last year, overall cloud revenue was up about 12%. Their strategic imperative group was up about 9%, which the cloud group is involved. So Heidi, to be honest with you, I still think it's too early to make judgment on IBM in regards to the Red Hat acquisition. We're going to have to wait another probably 18 months before we start to see some fruit blooming from this deal. But, you know, I think the fundamentals are there. I mean, they're going to be selling Red Hat cloud software into their massive installation base. And hopefully that's going to be a recipe for growth for IBM, because this quarter we're looking for a 22% drop in earnings from year over year. So not too good.
All right, Dan, thanks so much for joining us. We'll have to have you back on soon.
Okay, thank you, Dan.
Appreciate it. And we'll be right back at Wi-Fi AM after a quick break. Welcome back to Wi-Fi AM. Markets right now still in the red, but the Dow inching closer toward the flat line. So we will keep watching all day on Yahoo Finance. Let's talk now about the cannabis market. Canadian cannabis company HEXO is making some news today, 1 week after a disappointing earnings report that dragged other cannabis stocks like Tilray down. HEXO now launching an original stash cannabis line with prices meant to compete directly with the black market. That is an effort to hurt and diminish the black market. Canadian consumers will be able to buy 28 grams of HEXO's original stash for about 125 Canadian dollars. That's basically $95 US. That makes 1 gram about $4.50 in Canadian dollars, and that's what HEXO says is the average price on the illicit market. So, boy, if you can't beat them, match them.
That's affordable.
Sure.
Yeah, I mean,
cheap weed in Canada, Heidi.
I think the main narrative here for these Canadian cannabis companies is that a lot of people were really bulled up about the recreational law, right? Okay, now you're going to be able to just smoke it wherever you want and get it whenever you want. And they thought this was going to be this huge revenue driver for these companies. Well, lo and behold, that was not the case. Right. And so now they're trying to deal with that. I don't necessarily know if this is really going to put a dent in the company, honestly, and drive in a lot of...
Well, when you drop prices, it's going to cut in on profit.
That's exactly right.
Well, here's the thing. I think they really overestimated, and obviously, Heidi, you were touching on this, how much people wanted to purchase legal weed, right? Purchase weed from companies that had obtained a license and no one cared. They're already they're doing drugs. So they do not care if it is coming from a properly licensed cannabis company or cannabis, or just the guy that they bought it from the street on the corner. So of course they're going to go for the place that's the cheapest.
Terrific point. And this has been my argument about sports betting, and I look forward to that being proven out in the same way. The analogy being, I think the effect of legalizing sports betting slowly, state by state in the U.S., is being a little overstated because people who already place bets have a bookie, and they're not now going to say, oh, now it's legal, I don't need my bookie, I'll go to the legal window. No, they're going to keep using their bookie. And similarly, I don't think there are that many people who weren't bettors who, now that it's legal, will say, oh, now I'm going to bet all the time. Right. If you weren't a gambler, you're not a gambler.
Also, when it's legal, there's a hefty tax that's slapped on everything. And so that drives up the prices. Everyone said that, oh, these states are going to make so much revenue off of all these taxes. Right. Well, guess what? Now people are buying it from their drug dealers. So
thanks, Heidi.
All right, we're going to move on and talk Airbnb. We all know that Airbnb aims to go public in 2020. Potentially, that will be through a direct listing. And meanwhile, the company is ramping up its partnerships to stay relevant. Jim Beam and Airbnb have partnered up to open a 3-bedroom, 2.5-bath Airbnb at the Jim Beam Distillery in Kentucky. Very cool. Bourbon fans can stay in the home for one night for $23, the cost of a bottle of extra-aged Jim Beam Black. I imagine there will be a very long wait list for this place. The home has Jim Beam bourbon on hand. It has a fireplace, a backyard, and fishing docks. I would like to stay there.
Meals included.
Sure.
What?
I mean, it's a gimmick.
Right,
but
absolutely.
there's going to be a very long wait list, and it will bring the signups.
I mean, yeah, but is anyone going to be driven to drink Jim Beam for stay? Like, I would just go.
Why not?
Oh, when you're staying there, sure. Do you mean like
in
more
general?
People buy Jim
No.
Beam now because
I'm going to go. I'm going to pay my $23. I'm going to take many Instagram-worthy photos, have some Jim Beam in a glass, and then I'm going to leave and probably never have Jim
Good luck.
Well,
This is like Heidi trying to get into the Taco Bell hotel.
Wow,
just
okay.
not going to happen.
All right,
hurts.
We got to wrap it there. Thanks so much, guys. That's Wi-Fi AM for today. Thanks for watching. We'll be right back here at 10 a.m. tomorrow. But don't miss On the Move. That's our next live show. It starts in just 2 minutes. We'll see you there on the Move.
Or be square.
11 a.m. here in New York City. About 90 minutes into the trading day, stocks are mixed at the moment, really not seeing much change across the board. We have a little bit of push and pull here. On the pushing downside, weaker than expected retail sales in September. But on the plus side, beating the street. Bank of America joins JP Morgan and Citi as the latest big bank to top expectations. Dems take the stage. Now viewed as the front runner, Elizabeth Warren takes friendly fire. And the fight over fees. Discount brokerage pioneer Charles Schwab joins us on the latest trend, free trades. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Good to have you here. We want to take a look at the markets right now. Inez Ferré is on the floor of the New York Stock Exchange, and we're watching the indexes fighting to go positive, it appears.
Yeah, that's right. Struggling to go positive right now. You're looking at a flat picture. We're looking at tech, which is a little bit under pressure this morning. Materials are up. And if we just take a look at some of the Dow laggards, look at United Health. It's one of the top laggards today. It's interesting because yesterday United Health had gained more than 8% on the heels of a strong earnings report. Also, Verizon is one of the laggards today. IBM will be announcing their quarterly results after the close today. Microsoft is also included in that laggards list. And Slack is under pressure today. Slack was cut at Morgan Stanley. The price target was cut at Morgan Stanley to $28. Morgan Stanley sticking with its equal weight rating, but the analyst note there cites concerns over increasing competition, of course, for Microsoft. Also, Adobe is under pressure today after receiving a downgrade at Citi to neutral from buy and a price target cut as well. Adam, Julie?
Thanks, Inez. Well, our top story today, earnings season's in full swing for big banks in particular. Bank of America, the latest to beat estimates on the top and bottom line. That's after JP Morgan's big beat yesterday. Shares of Bank of America higher by about 2.25% right now. We're joined by today's panel to discuss BTIG Managing Director Julian Emanuel and Yahoo Finance's Scott Gamm. Also joining us on the phone, Portales Partners President Charles Peabody. Charlie, it's good to talk to you. So we're looking at what appears to be pretty broad strength in the consumer businesses at the various banks, Bank of America being the latest. Do you think that that's the driver here, and is it going to be sustainable?
Yeah, in terms of lines of businesses, the consumer bank has been the only thing that's been driving the bottom line. You generally, this calendar year, have had weakness in other businesses. This quarter, though, you did get a little bit better capital markets income, which helped out.
So how is the low interest rate environment, though, playing into all of this? Because I think expectations were lowered for all of the banks going into it, and it seems as if they're just knocking this one out of the ballpark.
Yeah, I mean, expectations for top-line revenue growth or spread income or net interest income had been beaten down pretty hard. So I would say in general, the quarter met expectations, but you have to keep in mind net interest income declined in the third quarter from the second quarter and will decline again in the fourth quarter from the third quarter. So the top-line revenue growth is still pretty poor. What the markets are anticipating is that the fourth quarter will be the worst of the calendar year, and therefore you can start to expect better numbers in 2020.
You know, we also saw a rise in provisions for credit losses. Does that worry you at all?
Yeah, I'm looking at, loan loss provisions being up about 20-25% year over year in the third quarter for the group of banks that I follow, the large cap banks. There's still continued, deterioration, albeit, modest in corporate non-accruals. And I do think that we're going to continue to see corporate credit get worse and worse as 2020 progresses.
Actually, the question is Julian Emanuel from BTIG. So how firm is the conviction that we are seeing the trough in net interest income? And so is it really sort of something that investors are looking to put themselves in the rearview mirror with regard to, particularly given the fact that the yield curve seems to be starting to steepen?
Well, I think that's the big question. I personally don't think we've seen the end of the rate pressures. In other words, I think the Fed's going to have to cut a lot more than just one more time. But the stocks are trading today and yesterday as if the implied yield curve is too pessimistic, and therefore we're going to see a steepening of the curve and not as many rate cuts going forward.
And it sounds like, Charlie, for those reasons, you also think that these stocks are looking a little expensive right now. It's interesting because we have a lot of, not so much on the analysis side, but on the investment management side, we have a lot of folks who come on and say they think financials look attractive right now on a valuation basis. It sounds like you disagree.
I do. I mean, the fundamental theme coming into the quarter, it was not so bad is good enough because the stocks were very cheap. Relative to the market. And, you know, you pretty much met expectations, if not beat expectations on the top line and bottom line. So that's the reason you have the rally. What the market is trying to suggest is that we're going to see the worst of the top line revenue growth in the fourth quarter. I disagree with that. And what the market is also suggesting is that there's no recession in sight, and therefore credit is not going to be a problem. I think credit on the corporate side, as opposed to the consumer side, is going to get worse and worse. So, yeah, I would be a seller of these stocks into the rally that we're having now.
All right, Charlie, thank you. Charles Peabody is Portales Partners president. Thanks.
12 presidential candidates taking to the stage last night in that heated 3-hour-long debate. We want to listen to some of the highlights.
I'm running to be the president who can turn the page and unify a dangerously polarized country.
This is about Donald Trump, but understand, it's about the next president and the next president and the next president and the future of this country.
He doesn't want me to be the candidate. He's going after me because he knows if I get the nomination, I will beat him like a drum.
Okay, that debate was in Ohio, but we're going to Washington. Yahoo Finance's Jessica Smith has more for us about the winners, the losers, and the takeaway from the debate. Jess?
Yeah, it was clear Elizabeth Warren was in the spotlight. She has been rising in the polls over the past few months, and last night she really got the front-runner treatment. Everyone on the stage was attacking her. She spoke more than any other candidate by far, and that's largely because she had to respond to direct criticism. Let's watch.
But I want to give a reality check here to Elizabeth, because no one on this stage wants to protect billionaires. Not even the billionaire wants to protect billionaires.
And I don't understand why you believe the only way to deliver affordable coverage to everybody is to obliterate private plans, kicking 150 million Americans off of their insurance in 4 short years.
I don't just want to push Donald Trump off Twitter. I want to push him out of the White House. That's our job.
Join me in saying that his Twitter account should be shut down.
No, let's figure out.
No?
Warren took a lot of heat from Biden, Buttigieg, and Klobuchar, who largely presented themselves as more moderate candidates who could get things done. We especially saw that on the issue of Medicare for all. A good chunk of the debate also focused on jobs in the economy. The candidates debated a wealth tax, breaking up big tech, and the future of automation. President Trump was not impressed with any of the Democratic ideas, as you would expect. He tweeted this morning saying our record economy would crash just like in 1929 if any of those clowns became president. So now we wait and see who qualifies for the November debate. So far, 8 candidates have made the cut. We'll also be watching to see if anyone drops out between now and then. Adam and Julie.
Thanks, Jess. Appreciate it. Let's chat with the panel a little bit about this. And I'm most interested in the market implications or lack thereof. Julian, the markets are not so fantastic at predicting these outcomes, right, of elections. When is it too early? Is it too early to try and game out even sectors and market activity based on what we're seeing?
It is far too early for the most part. I think the one thing that we can say conclusively, and granted, we certainly saw this in 2015 and 2016, is that healthcare is at the center of the storm with regard to, just sort of the apocalyptic version of how legislation might sort itself out. From our point of view, that actually represents an opportunity. We think it's been over discounted. But in general, if you look at the length of the Republican debates in 2016, it's just too early, and people aren't really going to focus probably till mid next year.
When we hear the concern about different people, whether they be billionaires, millionaires, or investors, that this proposal for wealth tax could possibly have people leaving the United States, does anyone take that seriously? Is that a legitimate complaint?
I don't know. I mean, I think I would agree. It's way too early to be even talking about any of these implications. And I am hearing folks come out and say, if Elizabeth Warren wins, the stock market's going to crash, 30% like the president just tweeted. That's also ridiculous. I mean, we don't know what the market reaction is going to be. And I think more broadly, we give the president too much credit in terms of the president's ability to move the market or the economy. I think long term for the market, politics don't matter.
Julian, you want to weigh in on that?
So this is a unique cycle. Okay, there's no question about the fact that the landscape did change in 2015 and 2016, and politics matters sort of day to day and week to week. But over the long haul, it's the economy and it's the outlook for corporate earnings, both of which we think remain robust.
Even with the volatility with trade and China and what we've got to get accomplished before the election.
There's no question about the fact that those are challenges, but in our view, the last several days, if we've learned one thing, it's that the president is incentivized to do a deal between now and the election, and that's likely going to keep the economy on a solid footing.
Are the Chinese incentivized?
Well, look, we're talking about $250 billion worth of tariffs, or maybe a little bit more than that. I mean, we have a $70 trillion global stock market. I still, to this day, I can't get over the fact that the market is so obsessed with trade and thinks it's such a big issue. I mean, it's certainly something we have to talk about, but for the long term in the market, I don't think we're going to be talking about trade in 10 years.
All right, let's switch to something that we can all understand, which is being able to move in and out of the market, and it won't cost you anything, all right? All of the major brokerage firms, Charles Schwab, Interactive Brokers, TD Ameritrade, and most recently Fidelity, have dropped their commission fees to zero this month. Joining us to talk about this is Charles Schwab founder and author of Invested, Changing Forever the Way Americans Invest, is Charles Schwab. It's good to have you here. And
thank you. My pleasure to be here this morning.
Let's jump into so many things that you talk about in the book. But this issue of the commission-free trading, one of the discussions we've had with people who've come here is that for a small investor, I'm not a big guy. Right. How do I make sure that the people who are buying perhaps order flow, because we know the brokerages are going to make up some of the lost revenue by selling order flow, how do I make sure that I am getting the best possible price when I'm going in to execute?
Well, you certainly want to do business with somebody you trust, someone who's been around for a good period of time. And we sort of report to our clients about payment for order flow as well as price improvement, which is something we try to also disclose in every trade. Tell people what's the price improvement over the trade, given the bid and the ask of the particular stock trading at that moment. So it's all about information and being full disclosed.
When you look at the arc of your career, and of course you have been a pioneer in the discount brokerage industry, we have seen U.S. investing in the market pretty much stay around stable at around half of the U.S. adult population. Do you think that this is the best time for an investor to invest in terms of the ease of trading, the cost of trading, et cetera, over your career?
Well, I think it's any time is a good time to invest if you want to get ahead in life, financially speaking, if you want to improve your wealth factors. Any time really is. You look back over the last 100 years, and I suspect the next 100 years, the same thing. You have to get in, and you have to remain in. You can't be in and out all the time.
Is what you're doing here with cutting fees to zero, is that maybe the Facebook model, right? Try to grow your user base and then maybe monetize on the back end via the order flow dynamic that Adam just talked about?
Well, when we reduced commissions recently to zero, the book talks about the whole history. It took me 40 years to take the company from what it was very beginning with 4 people. Commissions then were half of what Merrill Lynch charged when it went to deregulation back in the 70s, and took all these years to go from that price down to zero, and how we built the infrastructure to be able to do that. So it impacts our revenues negatively about 4% by this move, because we do so many other things at Schwab in terms of wealth management. We help people if they need information or need advice about. We help them also. We charge them a little fee for that too. But transactions free.
When you talk about the book, though, and I haven't read the whole book, but I've scanned different chapters, and you talk about the experience, the phone call you had with Hank Paulson during the financial crisis, when one of what was the first one, the Reserve Primary Fund, broke the buck.
That was not fun.
Right, it's not fun, but to Julie's question about roughly 50% of the population has something in the stock market, whether it's through a 401k. How do you reinforce faith in this system when something like what we went through in 2007, 2008 required the U.S. government to step in to essentially save so many of the institutions?
Well, it wasn't a matter of saving. And what they did is return confidence to people that there wasn't going to be a run on money market funds that particular time. And so it stemmed the fear factor. And always it comes about in down markets. I've been through many in my career. The fear factor comes in. People struggle up and sort of, oh, I better sell. That's their knee-jerk reaction. You don't want to do that. As you look back over time, that is the moment in time when you should actually be doing just the reverse, like buying. Certainly you don't want to be selling. You want to be at least holding, because right on the next few years, what happened after what you're talking about now, the market went up, 100% later on. Wouldn't you feel a little bit bad that you missed that, bailed out, paid your taxes at that time? So people have to learn how to deal with the volatility of free markets. And that's what this is. You wouldn't want to have a controlled market. You would have free markets. And free markets go up and down, whether it's interest rates, stocks, commodities, you name it.
We've been talking about technology as a good thing for consumers, right? Eliminating the fees for trading. But isn't there a downside to technology? We certainly learned last night at the presidential debate the rise of automation and how that might be a threat to work. So how do I save for retirement if I might lose my job to a robot in 10 years or 20 years? Are you worried about this?
I'm not worried about it. I think the one thing that American economy is fundamentally based upon is our improvements, our innovation. And technology is a critical element to get us to where we are today, whether it's medical science or whether it's stocks and bonds or whether it's industrial situation. Technology is the backbone of what's going to get us there. And thank goodness it's happened. In our case, our cost of doing business has gone down dramatically over the last 20 years because of technology. We're down to 15 basis points. We're probably the lowest cost provider of stocks and information and things of that nature, which puts us very competitive, being a low-cost provider. So technology, thank you very much. We would like more of it.
You stated a few moments ago that down market cycles are inevitable. They are. And in this age where passive investing seems to be predominating, how do you think about the job of focusing the investor on decades instead of quarters or months, particularly with regard to your advisory?
Well, Julian, I think basically we've got to get more education into our high schools, into our colleges. Financial literacy is still at a very low component right now. We need to do better about that, to let people know how markets function, whether it's stock markets and whatever I mentioned, or even how to use credit cards, what interest rates are and what they are and how you get taken disadvantage of if you have too many credit card things. There's just so much education that people don't have, and we need to do a better job of that.
People probably want to listen to you, and when you look at where you came from, I mean, what was it, 6 figures in debt, small apartment with your wife and a child when you launched all of this?
We struggled, man, along the way.
Charles Schwab, thank you for being here. The book is called Invested, Changing Forever, The Way Americans Invest. All the best to you.
Thank you.
Thank you. Coming up, 3 major drug companies negotiate a multi-billion-dollar opioid settlement. Plus, European regulators crack down on American technology companies. Now, EU regulators are targeting U.S. chipmaker Broadcom.
Thank you very much. The tit-for-tat tariff war between the U.S. and China has taken a toll on financial markets. And despite signs of a trade truce, our next guest says words are not enough to quell investors' anxiety and appease bearish market sentiment. Ben Amons, Medley Global Advisors Managing Director for Global Macro Strategy, is joining us now. And when you look at the tit-for-tat and the uncertainty, how do you protect yourself as an investor? Because we get mixed advice here. Some people say, go into financials. Others say, beware the financials, they're overpriced.
Right, so I think this is the issue, right? That we're having this dual market of having stock markets at record highs, bond yields at record lows, and what's in the middle there. So I do think that that's the positioning to take, because if you look at this year so far, if you had this sort of hedge position, half risk assets, half safe assets, probably the right position to be in, given this whipsaw headline risk that we're dealing with, from whether that's trade or whether that's the Brexit. Ultimately, I think the market will reconcile that position and say, the trade deal will come to an end and the Brexit will come to an end, and it looks like that we're going there, that in 2020 probably this hedge position will shift and you'll be more risk on position, I think, as opposed to being this hedge position.
What gives you that confidence? And Julian was talking to us earlier about the looming election might provide a little bit more impetus on the trade front. President Trump saying today the U.S.-China trade deal is being papered, I guess meaning they're putting it in writing. I haven't seen that paper yet. I don't think anybody has. And my natural inclination is to be a little bit skeptical. Why aren't you?
Well, I share your skepticism, because you're right. There's no paperwork, there's no forward guidance or anything. We have never had an official press conference between President Xi and President Trump, which you normally would expect in these trade negotiations, the two key heads to be at the table and discussing what this trade deal really is ultimately about. I think that's the missing link here. But it seems these baby steps towards this point that they're going to have this deal, because the pressure is building on both sides. The economic data here is weakening. The economic data in China is weakening. I think this is part of the backdrop why they're moving now towards this deal, as opposed to the deadlock that we went through over the summer.
So people look for leverage. We get daily reports. For instance, yesterday, I think it was Bloomberg, the Chinese may not buy the 40 to 50 billion in agriculture. They may not buy anything. Then we get the report today. The Chinese have been injecting cash into their financial system. We're going to get data later this week that shows that the Chinese economy has slowed down even more. So who has the leverage here?
Well, I think on both sides, it's kind of a mixed picture here in terms of leverage, because the strength of the U.S. economy has clearly faded. We were a year ago at 4.5% real GDP. We're at 2% or less today. And China has slowed in a similar fashion, maybe somewhat less. If you actually look at the stock market performance over the past year, China is definitely ahead of the U.S. So investors have given maybe China a bit of the upper hand here in terms of saying, if the trade deal comes together, this will be beneficial for China because of this trade revival that we will likely see. I think particularly global trade revival will happen as on the back of this in 2020 if this deal gets together. That's just all about confidence coming back in the markets, and you're seeing this depressed trade volume pick up again. That will probably be the big catalyst.
How much do you think this whole picture is about trade and tariffs themselves versus the U.S. just trying to maintain its status as the world's #1 economy and not lose out to China?
So I think what you're pointing at is the sentiment issue about it, right? Part of your political sentiment, perhaps, of that idea if we're stronger than China, we should be stronger than China. At the same time, it's investor sentiment that is really concerned about what's the complexity of this trade deal really. Because if you think about it, we've had all these different parts of escalations over the last number of months. We get a lot of stories about the supply chain shifting. Nobody of us is an expert of the supply chain, and that's what investors do grapple with. What does it really mean? What's the opportunity here? So I think that is part of that sentiment picture, what you're alluding to, this is the trade war is one with the tariffs having a direct impact on consumer prices, but it's the complexity of it that makes investors and others wary.
At the end of the day, what I hear you saying, what I heard Julian saying earlier, is you're optimistic that this really will get resolved. We hear criticism of phase 1, phase 2, phase 3. But that both of you think this is going to be resolved, and we could have a trend to the upside very strongly next year.
Well, from our view, the most bullish thing of the last 4 days is China has waved several yellow flags, caution flags, since the Friday photo op in the Oval Office, and the president has not tweeted aggressively against those, unlike every other time over the last year when China has done something and the president has come out and counterpunched. So that reinforces our conviction.
Yeah, that's probably true, that Trump is less active on Twitter. I mean, clearly between May 5th and August 23rd, those 5 tweets that took place by escalating the trade war through tweeting were a huge impact on financial markets and the projection of economic growth in the minds of investors. So by not doing that, we're a little bit of a lull here. We can't completely discount the fact that Trump could come back at some point again if he's annoyed. But the point that I think is that the agricultural purchases for this trade deal that they're working out at seems to be closer than what we thought before, and I think that was the breakthrough, quote unquote, on Friday. And it's the same thing, different topic, but in the UK, and a similar kind of breakthrough is happening. You would expect this ultimately at the end of all this discussion, just like the European debt crisis ultimately was resolved by just political will and shaking hands. I think that's where we're at right now.
All right. Ben Amons, Medley Global Advisors Managing Director for Global Macro Strategy. Good to have you here on The Move.
Well, Johnson & Johnson has offered to pay $4 billion to settle all claims accusing the company of fueling the opioid epidemic. We recently caught up with Johnson & Johnson CFO Joe Wolk, and here's what he had to say about those lawsuits.
We're being singled out because we have a strong financial position, we have a strong balance sheet, but remember, we have less than 1% of the overall opioid share.
Now, this overture coming on the heels of a proposal by 3 major drug distributors to pay $18 billion to wipe out all opioid suits against those companies. With us now to discuss Yahoo Finance's Anjali Khemlani. Anjali, so the drug distributors, there really has been a lot of accusations of blame across the whole pharmaceutical chain, right? But the distributors have come under a lot of criticism. What does this settlement look like?
They have come under a lot of criticism, and they've been sort of flying under the radar because the sort of headline-grabbing stories have come from the pharmaceutical companies because they sort of made these drugs, right? So this $18 billion is the first major number we're seeing. We also have Purdue, the maker of OxyContin, that came out with a $13 billion deal and bankruptcy. So $18 billion is the highest we've seen so far to wipe out all the cases, and that is in comparison to the drug companies like J&J and Endo and Mallinckrodt, which came with ranges of $10 to $30 million in the past few months. So we're looking to see just how this compares, how this is accepted. Remember, this is just a tentative deal right now. It hasn't really been confirmed yet. It's just reports of it. And we're looking at today being jury selection day. The trial is supposed to start on Monday. So it's really 11th hour is what we're talking about.
Anjali, thank you. Coming up, why Wall Street is turning its back on the IPO market. Former NASDAQ CEO Robert Greifeld joins us next. Plus, Facebook's foray into cryptocurrency. We will catch up with the head of Facebook's Libra project, and that's straight ahead. We're jumping back into the stream at 11:31 here in New York City, 2 hours into the trading day. Stocks, well, now the indexes have gone back into negative territory, but just barely. Oil has been trading down as well, but now up $53.48 a barrel. Brexit on the brink. Why hopes of a deal are fading after the latest round of talks. Crypto concern will talk to the head of Facebook's digital currency Libra, as several original partners are pulling out of the project. And the King of the North, North Korea's latest propaganda photos of leader Kim Jong-un, take the internet by storm. Oh, what we could say about that. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for sticking with us. Let's go over to London now to our bureau there to find out what's making headlines. Joining us, Yahoo Finance's Tom Belger. Tom, we have some Brexit developments. Surprise, surprise. We've got now some Northern Irish politicians possibly blocking a Brexit deal, but I know there are a lot of late-breaking developments. Bring us up to speed.
That's right. It's been a remarkably volatile day in politics and on the markets in Britain, with the pound lurching wildly amid a wave of pretty conflicting headlines about how these last-ditch talks are going to avoid a messy divorce if Britain leaves the EU, as planned on the 31st of October. Sterling was at a 5-month high earlier this week on hopes of a breakthrough, but it then tanked this morning as EU sources said negotiations were at a standstill, and Northern Ireland's Democratic Unionist Party hinted they may not back any deal reached. They fear it could cut them off constitutionally from the rest of the UK, but the pound then leapt suddenly as other sources claimed the DUP had now come round to a deal. Amid speculation, they could have been offered billions of pounds of investment in Northern Ireland. And then finally, to top it all off, European Council President Donald Tusk said we could just be hours away now from clarity about whether any deal is going to be reached. But how many times have we heard that before?
We've heard a lot before, so let's shift gears. Tell us about the EU's rebuke of Broadcom and what it truly means.
That's right. European regulators have ordered Broadcom to stop its exclusivity deals with 6 leading TV set-top and cable as modem manufacturers or makers even. And it's a sign of just how serious regulators' fears are about the US chipmakers' rivals being squeezed out of business pretty quickly because of this dominance of the market, which they think could breach antitrust rules. So they've announced this interim decision before they even finished their investigation. What it boils down to is these controversial deals Broadcom signed with 6 leading firms, which mean they can effectively only get rebates, only get early access to technology and other benefits if they only buy the chips from Broadcom. They've been ordered to stop that now within 30 days. But it could be years rather than days now before we find out the EU's final decision about whether this really does breach their rules and whether Broadcom's likely to face any substantial penalties over its behavior.
All right, sir, thank you very much. It has been a tumultuous time for companies that have recently IPO'd, and with WeWork pulling the plug on its plan to go public, the question on a lot of minds is whether Wall Street is actually souring on the whole process. Joining us from Jupiter, Florida, is Robert Greifeld, former CEO of the NASDAQ and currently Virtu Financial Chairman. Bob, it is good to see you. And when we talk about IPOs, you're no stranger to it. I know you learned a lot of lessons when we talk about Facebook. But the issue today with the IPO market seems to be in hold. And some people are saying, just go direct. There's no need for all of this mishigas with the back and forth with the banks. What would you advise us? Because you've been on the front lines of it.
Well, I would say in 2003, which I reference in the book, there were 0 IPOs. I think about 0. This year, we've raised $50 billion through the IPO process. So proclamations of the death of the IPO market or the radical change of the IPO market, to me, is completely wrong. So when we look at the IPO market today, I think what it's fair to say is if you do not have a path to profitability, you're going to have a difficult time coming public. On the other side, if you're a company that's growing, that's profitable, has some level of EBITDA, the window is wide open. You can come public today, tomorrow, next week, whenever you want.
So, Bob, what does that mean for many of these unicorns that are not profitable? And not only that, they've been around for a little while, right? That's been one of the characteristics of these new unicorn IPOs is some of them are waiting a decade or longer and they're still not making money.
Yeah, so that could be a problem, right? If you have a business model that's been around for a decade and don't have a path to profitability, let's give the markets, the public markets, credit. You don't have to show profits for the last year, the last month, but you have to show, here's my business model, here's the straw man. When I execute, I'm going to look at this level of profitability. That kind of reality that they're dealing with today, I think is a positive dynamic for the market.
But Bob, you mentioned that the path is wide open if you have a path to profitability, but those aren't the companies we're seeing file for these IPOs. It's all the companies that don't have a path to profitability. So have we kind of lowered our standards in terms of who we're letting go public?
Well, I would say this, that, one, you're not going to come public without some articulation of a path to get to be profitable. Whether that's believable or not is another question. But I've never seen IPOs coming forward and saying, we'll never make money. That does not happen. They always have some plan to make money. So I think the level of examination is how credible is that plan. And I think post WeWork, the standard is, somewhat higher, that you have to then have a more demonstrable path to go public. And I think when you talk about going public, the easiest thing, we saw this didn't happen, WeWork, you can take a piece of your business that's the most mature, okay, and this is the model, right? This is what we executed. We had 2 buildings in Manhattan, 5 buildings in Manhattan. They've been out there for 5 years. These buildings make profit, and we will start replicating that across the country and across the world.
Bob, just a couple parts of this question. Is there a broader message about, what's potentially the oversaturation of private capital versus the transparency of the public markets in what's gone on recently? And then the second part is, what does the fact that you've had these problems in the IPO market over the last several months, and yet the broader stock market continues to chug along? Is there any message there for you?
Yeah, there are a couple messages. One, you have to really respect the fact that a public market valuation is different than a private market valuation. Private market valuations tend to be bilateral. For that, I mean you have 2 people across the table, they negotiate what the price should be. The odds of them or one of them getting that price wrong is obviously higher than in the public market when you have all investors voting on what the price can be. But as important, you have to recognize in the private market, common stock is not the normal way you transact these businesses. They have some type of structured instrument, some type of preferred with terms associated with it. And I like the old expression that if you name the price, I'll give you the terms. If I can name the terms, then you can name the price. So you have that kind of dynamic going on here. So it's not common stock. So one valuation is not the same as the other. You have all sorts of warrant coverages going on. You have preferred liquidation associated with some of these things. So you can't equate the one to the other.
Robert Greifeld is the former NASDAQ CEO and author of Market Mover, Lessons from a Decade of Change at NASDAQ. And it was good to see you again. All the best to you.
It was good to be here. Thank you. Have a good day.
All right, I want to bring you some breaking news now. It has to do with General Motors and the United Auto Workers. Reportedly, General Motors and union leaders have now reached a tentative deal that would end this strike for 48,000 workers. This is according to Reuters. We've got some reports from CNBC as well, citing the UAW. Details of this proposed deal not coming out just yet, but those members of the UAW are expected to receive raises and bonuses as part of this agreement. So we'll keep you posted on it. As you can see, those GM shares are moving higher on this report. It looks like they're going to be meeting tomorrow to go over more of these details. So again, we'll keep you posted.
Coming up, Mike Pence and Rudy Giuliani refused to comply with a congressional subpoena. And regular administration supporter Lindsey Graham warns that could be an impeachable offense. Plus, North Korea's dear leader appears to hold on for dear life in the latest propaganda shoot from the communist backwater. Vice President Mike Pence and President Trump's personal attorney, Rudy Giuliani, refused to comply with a congressional subpoena to hand over documents regarding the Ukraine scandal. Republican Senator Lindsey Graham, he has warned the administration that not complying with congressional subpoenas, well, that is an impeachable offense. And breaking this hour, The Guardian reports a third associate of Rudy Giuliani's has just been arrested at New York's JFK Airport. That's a hat trick for the DOJ. The vice president leads a U.S. delegation to Turkey to negotiate a ceasefire between Turkey and former U.S. allies, Kurdish fighters in northern Syria. Turkey's president refuses to meet with Pence and says he'll only meet with President Trump. Baseball fans in Washington, D.C. are celebrating because the Nationals are going to the World Series. Now, this is the first team from D.C. to go to the series since 1933. They beat the St. Louis Cardinals 7-4 last night to win the National League pennant. North Korea's communist dictator Kim Jong-un looks terrified in recently released publicity photos which show him riding a white horse up a mountain trail. Now, the photo or the propaganda photo shoot harkens to one 10 years ago when Russian strongman Vladimir Putin went full nipple in a shirtless propaganda photo showing him riding a horse. Were we going to show Vlad? Don't we have the photo from 2009?
Yahoo Finance's Brian Chung got a chance to sit down with Libra's co-creator and chief to talk about the importance of bringing commerce to the Facebook platform. Brian's with us now live from IMF headquarters in Washington, D.C. to tell us more about that conversation. Brian?
Hi, Julie. So I had a pretty robust conversation with David Marcus. He's the head of Calibra, which is the name for the subsidiary that Facebook created to embark on this ambitious blockchain project. Again, they hope to have a Libra cryptocurrency that will be used across the world and using a network of founding members. It originally was 28. It then whittled down to 21 after a number of payment processors like PayPal and MasterCard exited the project. Didn't say exactly why, but I had the chance to ask Marcus specifically why he wanted to embark on this project during a time where Facebook, the overarching parent company, was facing so many privacy issues. Here's what he had to say about that.
Well, look, if you look at Facebook and you look at the value that we provide to billions of people every day, we enable everyone to communicate for free. We enable 90 million businesses to sell their products and services on a platform and reach new constituents and hire and grow their businesses. We enable people to stay in touch across wide distances and stay informed. We have a duty to our users and people using our services to continue innovating on their behalf. And it's kind of odd with 90 million businesses on the platform and 2.7 billion people that there's no easier way to conduct commerce on the platform. And I think that that's going to empower a lot of small business owners around the world, some of them who don't even have access today to digital payments. So even if they actually wanted to sell online, if they wanted to accept payments from a lot of people around the world, they don't have a way of doing that. So I believe that this is a perfect fit for us, and it's a duty that we have to continue innovating for our constituents.
So again, it seems like David Marcus not really concerned with the optics of launching this project about a month before the Facebook company faced a $5 billion fine from the FTC for privacy violations. Marcus saying that he feels the large user base at Facebook actually obligates him to create a better payment system. For what's worth, I'm here at the International Monetary Fund annual meeting where David Marcus is present. He's trying to meet and shake hands with a lot of central bankers and international regulators to continue to push for Libra. Another part of that conversation, he said he expects this process to get harder before it gets easier. A lot of topics that we touched on in that long interview, and you can catch it on yahoofinance.com.
Brian, thank you. Nuveen Real Estate recently released its Q4 outlook on real estate investing within U.S. cities, with one key takeaway stating that the company is moving toward non-traditional investments that are well-positioned for the tech economy. One investment includes the healthcare sector. And Melissa Regan, who is Nuveen Real Estate Head of Research Americas, joins us to talk more about this and what investors can expect to the coming quarter. Let's jump to the payoff, because you talk about being more interested in healthcare-related properties that are well-positioned for the tech company. What does that mean?
I think it's more we're interested in healthcare as well as technology-focused real estate sectors. And a lot of that, so you could think of that covers a lot, right? Medical offices, senior housing, but also things like cell towers, data centers, things that we believe are going to be long-term, have really long-term structural demand drivers behind them. And, you know, just becoming late cycle, as we all know, and thinking about how do we position ourselves as we move through this cycle, and we want to be in sectors across the world that have really strong tailwinds behind them.
And you're also looking urban in many cases, and Sunbelt cities in particular. Now, whereas you might see some long secular trends with industries, cities, tend to be a little bit more cyclical. So how long does the Sunbelt cycle have to go?
Pretty long, we think. I think, Nuveen Real Estate, you're sort of right, but we also look at cities in a global perspective from a very long-term structural perspective. And we actually think we have an entire list of cities, 35, which sit in the U.S., of metrics we look at: concentration of millennials, concentration of wealth, how fast they're growing, how innovative these cities are. And we actually think those are long-term structural as opposed to cyclical factors. And so a lot of the Sunbelt cities do screen very well in the U.S., and we actually think that's a decade-long, not just a cyclical-long trend.
In a place like New York City, though, do we expect there to be a negative trend as those Sunbelt cities are now on the rise?
So I get that question a lot. What I would say for the gateway markets, things like, places like San Francisco or New York, and you've read about population leaving, and that is true. However, what we would say is there's still plenty of real estate opportunities, particularly tech-driven. New York is going to be becoming much more tech-driven, even life science-driven in New York. San Francisco, certainly tech-driven. And when you have those, our factors show that when you have that concentration of tech and wealth, and the life science component, you do very well from a real estate perspective and from a very long-term structural perspective.
When you think about the next decade, where the transfer of wealth from the baby boom to the millennial generation is literally going to be the largest transfer in the history of wealth building, how does that factor into your thinking?
Well, again, as I said, so concentration of millennials is one data point that we do heavily focus on across these cities because of that wealth transfer. And so the 35 across the U.S. as well as global, concentration of millennials is a big key factor in that. And so that definitely plays into it, right? Because they will come into peak spending power here. They're starting to, and over the next decade, they will come into peak spending power. And so that drives real estate, retail real estate, office, apartments, whole nine, industrial real estate. So it factors in quite a bit. And then I'd also say as the baby boomers age, that plays into our healthcare, certainly our healthcare story, and the demand for senior housing, medical office, really strongly driving those sectors.
How do you convince an investor to perhaps rotate out of the high-flying tech sectors and into some of the sectors you're talking about right now?
Well, I don't think we advocate you need to rotate out of San Francisco or New York from a technology perspective. We also look at it from, depending on what you want, right? From a real estate perspective, from a risk-adjusted return perspective, what are you looking for? If you just want very, very stable kind of core income returns, you're going to want some of those sectors that just have the really long-term structural demand behind them. If you're looking for something that's much higher returning, it's a different conversation in terms of, do you want that to be a much shorter term play, more of a development play, getting in, getting out? So it really honestly depends on what you want the real estate to do for you from a risk-adjusted return perspective.
Melissa Regan, who is Nuveen's Real Estate Head of Research Americas, good to have you here. Thank you for being on The Move.
Coming up, what's driving the markets? Have investors shifted their focus from the trade war to corporate earnings? But before we go to break, let's take a look at some of the biggest losers in the Dow today. United Health, after getting a big pop on its earnings yesterday, giving up some of those gains. Let's take a look at some trending tickers from YahooFinance.com. Workday shares under sharp pressure today. They're down by about 12% on the session here. Enterprise software is broadly under pressure in today's session. So Workday, just one example. You can see it's now come almost full circle year to date. It had its analyst day, and analysts not so bullish on the stock after the company made some commentary. Among other things, it said its human capital management product will see 20% growth this year. However, that represents a slowdown. Also, analysts expressing some skepticism about some other new products that the company is introducing. Morgan Stanley out with some notes on some of the other enterprise software companies, including ServiceNow, which is enterprise software and services. You can see the shares up about 40% year to date, but they're pulling back by 8% today. Morgan Stanley cutting the stock to equal weight from overweight, among other risks, is pointing to the CFO transition and is also looking at that big run that the stock has had this year. And Slack is in the sights of Morgan Stanley as well. The price target, they're going to $28 from $38, although that's still above where the stock is right now. It's down nearly 8%. Morgan Stanley talking about increasing competition for Slack. So those stocks under pressure. If you look broadly at the markets today, as we've been talking about, seeing a bit more of a mixed picture. The NASDAQ is under pressure in particular, perhaps because some of these enterprise companies.
It is time for Word on the Street, where we check in with the panelists and find out the stories they're watching. Scott, you say the trade war may be taking a backseat to corporate earnings this week. Why is that?
Well, and we got a flavor of this yesterday when the markets rose 1%, largely on the heels of 4 strong earnings reports, right? UNH, J&J, Goldman Sachs, JP Morgan. So I'm curious to see if the market continues to react to earnings. Remember, it's been a while since the market rose on the heels of earnings. If you look back over the past 6 months, a lot of the big up days we have seen have largely been driven by some positive trade headline. And so I think it would be healthy for the market to get back to what traditionally drives the market, and that's earnings. One other quick point on this, we saw investors yesterday rotate out of shares of Procter & Gamble. The stock was down over 2%. Now, we know Procter & Gamble has had an incredible run over the past couple of months, but now it's moving away from its record high. The stock still today not getting a bid, and I think that's because investors are finally waking up to other areas of the market. Maybe there's not such a need to stay in some of these safe areas of the market.
Okay, so let's get Julian's take on this, because you say the mood on Wall Street has changed. I feel like it's changing moment by moment, but I'm sure you have a different perspective.
Well, we really feel like the last 2 days is a bit of an inflection. And when you look at this morning's retail sales number, it's not a surprise to us that the market is largely shrugging it off, given the fact that coming into Friday's negotiations in the White House and more news that Brexit is potentially moving forward, that's always an open target. But the fact is that whether it's percentage of bulls at multi-year lows last week, or the options market reflecting fear, or CEO confidence, which had been sagging, they're all sort of in a so bad it's good category. And when you think about it in the context of how much fear there was of the fourth quarter of last year, that is to us the potential for climbing the wall of worry.
So in other words, you're saying the mood is changing to be slightly potentially more optimistic.
That's right. That's right. And it's at this inflection point where stocks often make their move.
But last year in the fourth quarter, it was Jay Powell in December that sent us down. But it was we knew the tightening was coming. Is that because we had a sell-off in October on the S&P 500 last year? That's not coming this time, isn't it? Really, that you can point to that, the fact that we're in an easing period with the Fed as opposed to anything else.
Well, we are. We actually think that the Fed may take a pass on October 30th because in a lot of respects, the retail sales data is very volatile. Inflation is toward target. The economy is clocking at 2%. We think they may decide to take a pass, and we think stocks may end up shrugging that off as well.
Very interesting stuff. Hope to have you back soon. Julian Emanuel, BTIG, thank you. Scott Gamm, our own from Yahoo Finance. And coming up, Democrats duke it out. We'll bring you the highlights from last night's presidential debate. Plus, streaming wars. Investors await Netflix earnings report, the final one before the competition fights for the throne.
All right, it is just a little after noon in New York City. We're 2.5 hours into the trading day. Stocks are going back and forth, but right now you can see the Dow's positive. We'll talk about the two others in just a bit. Following weaker than expected retail sales in September, that's clearly being digested by a lot of investors. Take a look at what's happening with the 10-year Treasury yield. It's at 1.75. At one point, it was up to 1.76, but falling once again. Beating the street. Bank of America joins JP Morgan and Citi as the latest big bank to top expectations. But can the trend continue? Here comes Netflix. What you should expect from the streaming giant in its last quarterly report before Disney enters the streaming wars. And Dems take the stage as the frontrunners come under fire. Several names fight to keep their spot on the big stage. Welcome back to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for sticking with us. Let's take a look at what's going on in the markets today. We've got a mixed picture. Ines Ferre is on the floor of the New York Stock Exchange to break it down for us. Ines.
Yeah, Julie, you're seeing a little bit of a mixed picture because tech is a little bit under pressure. So you're seeing the NASDAQ that's under pressure. You've got the S&P that's essentially flat, and the Dow is in the green, being led higher by Johnson & Johnson, up more than 2%. Johnson & Johnson was also up yesterday on the heels of its earnings report. And also Boeing is up more than 1%. So that's helping the Dow stay in the green. Meanwhile, some of the Dow laggards include United Health Group. Yesterday, United Health was up more than 8% on the heels of its earnings report. Today, it's down more than 1%. Microsoft and Visa are also on the laggards list. And then we're also watching GM. GM is up more than 2% after the UAW reached a tentative agreement that would end the union strike against GM. This is a strike that's been closely watched by Wall Street. Wall Street analysts, when the strike first started, said that if it lasted 1 to 2 weeks, the impact wouldn't be too bad on GM. But if it went beyond 2 weeks, then you would see the impact be more material. So the next steps now will be for the local UAW leaders to approve the proposed contract, and then the unionized workforce would vote on it.
Inez, thank you. Our top story right now, 12 presidential candidates took the stage last night in a heated 3-hour-long debate. Here's some highlights.
I'm running to be the president who can turn the page and unify a dangerously polarized country.
This is about Donald Trump, but understand, it's about the next president and the next president and the next president and the future of this country.
He doesn't want me to be the candidate. He's going after me because he knows if I get the nomination, I will beat him like a drum.
Yahoo Finance's Jess Smith is in Washington, D.C., and the target is now, it appears at least, on Elizabeth Warren, right?
Yeah, she faced attacks from everyone on the stage. She is clearly emerging as a frontrunner with former Vice President Joe Biden. She continued her calls on the debate stage to break up big tech, but not every candidate is ready to take that stand. Here's Warren talking about Amazon, followed by entrepreneur Andrew Yang addressing Warren's approach.
It runs the platform, gets all the information, and then goes into competition with those little businesses. Look, you get to be the umpire in the baseball game, or you get to have a team, but you don't get to do both at the same time.
But we also have to be realistic that competition doesn't solve all of the problems. There's a reason why no one is using Bing today. Sorry, Microsoft, it's true. So it's not like breaking up these big tech companies will revive Main Street businesses around the country.
We also saw Senator Kamala Harris go after Warren during the big tech section of this debate. She called on Warren to join her in urging Twitter to suspend the president's account. Warren just brushed that off, was not interested in engaging on that front. But one other note that I think is interesting, there was a question about automation and the role it could have for workers going forward. This has been a key issue for Andrew Yang, but now we heard from some of the other candidates. Yang has been pushing his universal basic income as a way to address this, and we did hear Congresswoman Gabbard and former HUD Secretary Castro say they would be open to considering some form of universal basic income. Senator Sanders says the way to fight automation is with his federal jobs guarantee program, and Senator Warren answered by saying job losses are largely because of bad trade policy. So some interesting answers from the candidates on that front. Now we watch to see who is going to make the November debate. So far, 8 candidates have made the stage. Adam and Julie.
Thanks, Jess. Appreciate it. We're joined by the panel this hour. Yahoo Finance's Dan Roberts and Emily McCormick are here to talk about that debate last night. I don't know how much changes in the wake of this particular debate and the very crowded stage that we saw last night.
Well, I think the main takeaway from this debate was really the fact that Elizabeth Warren is really becoming the front runner here. If you just measure that as the attacks from other candidates, that's one proxy for that. The fact that this is the first debate that we've had where she's really starting to close that spread between herself and Joe Biden in some of these national polls. I think that's where we're starting to see the tides turning. It was a little bit disappointing to see her continue to dodge that question of where is this, what's going to happen to the middle class taxes, what's going to happen to taxes across the board if we have this Medicare for All plan. While Bernie Sanders has acknowledged that taxes would go up, she continues to just talk about costs overall going down while not acknowledging taxes are probably going to have to go up.
She'd rather not say.
Right.
That's the question, where the money will come from. Yeah, it was an interesting night for Warren. By the way, not just more attacks on Warren from the other candidates, but the polling shows that she's closing the gap with Biden. I do think that Biden having to respond on the Hunter Biden issues, and then, of course, we saw a few days before the debate, Hunter Biden did drop from that board, shows that by some measure, sort of regardless of your politics, the Trump attacks on the Bidens over the last 2 weeks have been successful. I mean, he had to respond to it. It's become an issue for him, and I think it has hurt him somewhat. We can argue about how much or how fair or whether it was even true or whether there was corruption there, but he had to answer for it, and I think it has hurt his candidacy.
Not that Elizabeth Warren is a young whippersnapper, but the issue with Biden at the core, no matter what side you're on this, is the influence that the establishment, whether it's Republican or Democrat, has had, and the children and the access that all of these people have had because of their last names and their relatives in high places.
And no one can say that about Elizabeth Warren. I mean,
That's
God
right.
knows it. You may not like her best as your
Or
candidate,
Sanders,
but the
for
going
that
after
matter.
the companies.
Yeah.
The other thing I wonder, and this is sort of neither here nor there, I guess, but we're 1 year out, right? When do some of these candidates on stage start to drop? Because if the Dems want any real chance, and I know later in the show we're going to talk about a new study that suggests that based on past trends, President Trump's likely to get reelected right now unless there's mega voter turnout, which isn't likely. Right. So right now, 1 year out, if we look at 2016, the problem was the Dems and the party really couldn't rally around one candidate early enough. Well, if they want to win this time to condense, time to cull the field and rally around one candidate. So some of those people on that stage, we said 12 candidates, some of them need to drop. I mean, Bill de Blasio knew, time to drop.
Yeah. What are they waiting for?
Tulsi Gabbard, Klobuchar, Tom Steyer was on the stage. Drop. Sorry, right? That's what needs to happen next.
Well, and I think a lot of it is a matter of pride. I mean, we're already getting reports now that, Mayor Bloomberg may actually come into the scene.
Oh, yeah.
So there could be more people potentially coming on, depending on, how Joe Biden does. That seems to be the contingency that reports are swirling around for that.
Just because you have the money to do it doesn't mean you should do it.
Right. Well, talk to the DNC about that and the fundraising.
Tell Tom Steyer that.
Yeah.
Let's turn to something more palatable, perhaps. Deal or no deal? China is reportedly pushing the U.S. to drop plans to impose new 15% tariffs on $156 billion in consumer goods starting December 15th and could use the farm purchases as leverage. President Trump spoke to reporters about all of this just a few hours ago.
I agree it hasn't been papered yet, but it's being papered. But in the meantime, as you know, and as we've said many times, China's already started buying. They want to buy. They want to make a deal. They really have to make a deal. Their economy's been hurt very badly by what we've done and by the tariffs that we've charged. And we've taken in tremendous amounts of tariffs. A small portion of them we've given to the farmers, which is more than made up for what they've lost.
When I was a kid, getting papered meant you went to someone's house and you threw toilet paper in the trees. But what the president's talking about is phase one and putting this down. We can talk
Signing
about
it.
right, and who's got leverage. But the fact is, China's economy is slowing down. But the Chinese have also said, we don't have to buy the 40 to 50 billion in ag products.
Well, they don't actually need to buy these products. I mean, this would be more than they've ever spent in the past. That's something that the Wall Street Journal has pointed out. So really, they do look like the ones that have leverage here. They could say, hey, we can't hit your commitments unless we have to roll back some of these tariffs. That would mean you would have to reciprocally roll back tariffs. So this could be another sticking point before we actually get this deal on paper.
Two things that I'll say. First of all, last week when we got the reports, and then only a couple hours later, the confirmation from President Trump that we have a phase 1 deal. I mean, is anyone surprised that it turned out maybe we didn't really quite have the full phase 1 deal? I mean, not just, hasn't been signed, but competing reports that China really doesn't see things the way that the administration has been representing in the last few days, doesn't see things as, yes, we came to an agreement and we have a deal. So that's step one. I mean, don't believe that there's any kind of deal, whether it's phase 1, full deal, partial deal, until they stand up there for the photo op, shaking hands, and something has been signed. Now, step 2, it's interesting to me, if you just pull back, zoom out a little bit, even though all these things have changed and there are twists and turns and there are developments and tit for tat and a new tariff, and then we're going to hold off on this new tariff, even though there's been certain developments, if you think about it, in the last year, nothing has really changed in terms of the U.S.-China trade war. The biggest sticking points are still the biggest sticking points. We're saying the same things we said a year ago about China, which is willing to tighten its belt, willing to get into a battle of austerity in a sense, and both leaders not wanting to back down. And then the U.S. saying, well, we'll, suffer through some short-term pain for longer-term gain.
You think the president would back down?
The Trump?
Trump, yes.
Can't. And maybe arguably doesn't want a deal before the re-election because under the argument that I'm the only one who can actually get us the deal.
The one thing that has changed over the past year is that the tariffs have gone up. And so we have been talking during the show about this earnings season. Maybe it'll help stocks get a boost, but it'll be really interesting once again to see what companies have to say about the effect of those tariffs. Here's one company that probably is not affected by those tariffs. It's Netflix. And it's reporting its earnings after the close of trading today. It'll be the streaming giant's last quarter before Apple and Disney roll out their new services. Joining us now to discuss is Wendy Johansson, Publicis Sapient Group Vice President, who measures a lot of these various streaming trends. So going into this report, what are your numbers? What's your research telling you about how Netflix is doing?
Netflix is definitely going to take a drop in their subscriptions, but you know what? This is really great news for you and me as the consumers of Netflix. They're going to double down on their customer loyalty. They're going to work really hard to keep us where they are, while the networks are betting that content is king.
So if they do double down, if they cut prices, how, if I'm an investor in Netflix, am I going to get return on that stock if they're cutting prices, but they're competing with that many more services who are going to be signing up people? How do they grow?
They're going to continue to grow through innovation. I mean, Netflix is a technology company at core. They only got into content when they decided they had enough money for that. Whereas we see the big studios coming in, they're coming in with new technology platforms that were based off what Netflix has succeeded on in all these years. So they're going to continue to build better technology, better consumer experiences, and they can cut the costs, but they're going to get more subscribers through that loyalty.
Wendy, Dan Roberts here. Thanks for coming on Yahoo Finance. Let me ask you, when you predict that Netflix at some point is going to have to cut prices to compete with these others, and yes, Disney Plus, Apple TV Plus, priced so low, especially Apple TV, practically giving it away, or they are giving it away if you buy a device for the first year. But the other argument I've heard is that maybe these two coming along and having prices so low sort of accidentally positions Netflix as the premium player. Maybe Netflix leaves its prices alone and tries to beef up on its originals and position itself as the premium fancy offering. That's over here, that's separate. Might that be the route that Netflix goes?
That could definitely be a route they go, especially because they are the only ones just focusing on this content streaming, whereas everybody else, Apple's coming in. There's a reason Amazon Prime never won this war. Nobody calls it Prime and Chill for a reason.
Wendy, you mentioned that you're predicting a drop in subscribers for Netflix. Are we going to see that actually reflected in this earnings report? I mean, because we did see that drop in North American subscribers last report, but that was mostly due to a weaker content slate for the second quarter. It looks like things might have picked up now, no, with the Stranger Things release?
Yeah, so we're probably just going to see maybe 1/1000th kind of an effect on them, which is barely scraping the barrel for them. So maybe into Q1, we're going to see a bigger drop with the competition there, but it's so inexpensive for consumers today. We'll kind of see how this rides out into the second quarter of the year.
And so if you're looking at this landscape then going forward, of course, it's not just about price, right? It's about what you're getting from each of these services. Do you think Netflix is going to be able to keep up the quality of its content? It has been culling some of the shows that haven't performed as well.
That's absolutely a factor, but when you really look at it, when you're on other services and you're not getting it on your mobile device, you don't know how to log in, things are buffering all the time, it's really coming down to that core technology experience, which is why I'm doubled down on Netflix. Is they're a technology company out of Silicon Valley. They know exactly how to cater to that end user, and that's who they're always thinking about.
We're talking about technology, but at the end of the day, content. I mean, we have Netflix, love Ozark. They're going to have to spend big bucks to compete with Apple and with Disney to keep turning out content that all of us love.
Mm-hmm.
I'm glad you agree with me. Wendy Johansson, it's rare I get the last word. We will check back in with you to make sure that Netflix does what you think it will do. Coming up, consumers hit the brakes. What an unexpected drop in September retail sales means ahead of the holiday season. Plus, take a look at some of today's trending tickers on Yahoo Finance.
U.S. retail sales declined unexpectedly for the first time in 7 months in September. What does this mean for the American consumer? We're going to turn this discussion over to the panel for more on this because so many of the folks that Adam and I talk to say consumer, consumer, consumer. That's the only thing keeping us going. And yes, this is just 1 month, but it does seem like a little bit of a concerning signal.
I mean, it definitely does seem like a concerning signal when you look at it, but if you look at the trend line, we're still pretty strong. I mean, a lot of analysts are saying that this is just some payback from strong sales that we saw in August, particularly on the e-commerce side. We saw these non-store retailers, which are essentially e-commerce merchants, drop for the first time since December 2018, but that trend line is still really strong, going in the up to the right direction. So really, it looks like this could be an anomaly.
Well, it's a little like the inverted yield curve, right? Where people are saying, like, give it more time. Right. Yes, it can signal a recession if it stays inverted for a sustained amount of time. I mean, let's not make too much of 1 month. Now, if the numbers are equally bad for the next month, okay, then you start to worry. But we're approaching the holiday season.
$1,000 a person. That's what they're anticipating. People are going to be spending on average $1,000 for the holidays.
Very, very pivotal holiday shopping season, it seems like to me. I know we say that the last few years, but especially right now, I mean, we saw that President Trump, certain tariffs were supposed to go into effect right before the holiday season. Surprise, surprise, that he called those off or temporarily halted those because you don't want to implement more tariffs right before Christmas.
And one thing that you could put into the camp of, yes, consumers will continue to be strong, is the fact that even though wages in the last jobs report were the same, they were flat compared month to month, they're still up year over year. So people have more money in their pockets, and the savings rate, they're able to spend what we've been spending and still have a savings rate of 8%.
Well, and if we just look at some of the other soft surveys that we've had coming out, University of Michigan consumer sentiment beat expectations last week. We had NAHB home builder sentiment beat expectations. We had Empire State Manufacturing. That also exceeded expectations just at the beginning of this week. So we are seeing a confluence of October data that has still come in ahead of expectations. This is just one blip of hard data that did miss expectations.
People don't want a recession. Get out there and shop.
Yeah,
Vote with your wallet.
One of the interesting parts of this is that a lot of the drop was driven by autos. And so you have to wonder as well, the UAW strike and sort of the press about that, you wonder if that has a depressive effect.
Well, there's been a lot of negative news from the, Ford, not that Ford was on strike, but Ford had declining sales in China, with a 30% drop. It's been negative for the auto sector for a while.
Meanwhile, Tesla does well in China, but it's a topic for another day. We'll see. The strike supposedly may be over.
Yes, that's right. There was a report that they're coming to an agreement.
Tesla does well in China. That's like David Hasselhoff is big in Germany. That's what I was
sure.
reading. All right, I went there. Let's switch gears and talk banks. Bank of America reported its third quarter earnings, beating Wall Street estimates. Its shares are up more than 2%. And Timothy Chubb, Chief Investment Officer, joins us now to talk more on banks and the broader market. And, they're not the only bank that is outperforming what we were expecting going into this earnings season. What should we as investors understand about how we were set up for low expectations and now they're all doing so well?
Yeah, that's kind of what the Wall Street two-step is, right? If you set the bar low enough, you're able to jump over it relatively easily. And something that we don't just see with the banks, we see with a lot of other areas. I mean, going into this quarter's earnings season, I think the average estimate was right around a decline of earnings of about 3.8%, which would have been the worst decline in about 3 years. Unlikely to be that large of a decline, if any at all. We could see things coming in relatively flat, but for full disclosure, we recommend and currently are in our strategies, Bank of America and JP Morgan, not names that I personally own right now, but we've been pleased to see, the higher quality banks that I think are better able to withstand, an economic downturn than some of the others potentially, really perform well in the last 2 days.
Tim, I want to ask you about what's going on with defensive sectors, because you see those sectors like utilities, real estate, consumer staples, that maybe we could see a sell-off in those sectors. And with all of this talk about pressure from the trade war, about slowing economic figures, we were just talking about retail sales, why do you think we might see people rotate out of some of those defensive sectors?
Yeah, I think part of it is, with what we just talked about a little, just a few seconds ago, in that I think earnings are going to be better than expected. I think this phase one trade truce could potentially give a little bit of a lift to some of these more cyclical sectors. We continue to see semis, here's where the bellwether hit all-time highs. Investor sentiment that hasn't necessarily changed on some of these more cyclical companies and industry groups, but I think defensives are overvalued. We've seen a really crowded trade so far this year, 2 standard deviation move. A lot of these businesses aren't really growing at all, both their top or bottom line. They're loaded up with debt. They pay a ton of their earnings out in dividends. And so I think if you're a long-term investor, some of the opportunities that have recently presented themselves, maybe within the technology or consumer discretionary sector, are worth nibbling at, especially as we go through earnings season, get a better idea of how they're thinking about their customer base.
We're in an environment right now of low interest rates. It looks like we're moving towards even lower interest rates. Do you see that potentially being accretive to earnings for highly levered companies, just because they do have to deal with a little less of that interest rate pressures?
Yeah, and that's something that we actually saw a boost from with the tax reform. Its interest coverage ratios have remained pretty good for highly levered companies in particular. The tax cut that they got really dropped a lot to the bottom line, and their interest coverage really improved. We've seen it also be the case within some of the larger, more financially stable companies. But I think in this environment, although some of these more levered companies are going to have an easier time with maybe paying a lower interest expense with rates moving lower, now's not the time to really dive in and gobble up a lot of this exposure. With the geopolitical and economic uncertainty that we have, I think it's better to stay higher quality, more sector neutral, and away from some of the more levered cyclical sectors or companies that you may have been really interested or levered to in your portfolio the last couple of years.
When we look at what's happening with Bank of America stock right now, and it's up over 2%, do you think that a lot of this might be herd mentality? Because Berkshire Hathaway had filed the paperwork in order to increase its stake above 10%, but some people may not have realized they already had basically 10%. I mean, what do you make of that?
Yeah, I think Bank of America has been maybe unloved over the last couple of years. They've been through a lot. They've really digested, numerous acquisitions, going back to the global financial crisis. That's taken a lot of time. They still have a lot more cost cutting to do. They have this great retail branch network. And I think they've got the balance sheet and the vision to really compete in a digital age. And when you look at a lot of these money center banks and regionals, you really have to wonder what the long-term secular trends are going to look like for the banking business. We're seeing a lot of acquisitions take place, but branch counts still stay the same. And it's with everything moving more towards digital. So I think Bank of America has that vision. They don't rely as much on the spread business as others. They've got the great wealth management group with Merrill Lynch, which I guess as a competitor maybe pains me to say. But it really is a great franchise, and we really like the leadership of the company. So I think some of it could be herd mentality, but they continue to really deliver on the results and the vision that they've been laying out for the last couple of years.
Tim, I quickly want to ask you about another one of your picks, Constellation Brands, because that one really stood out to me. The stock has been kind of hammered over its investment in Canopy Growth, the cannabis company. And it's yes, it's gone up this year, but it's really kind of been going sideways for months now. What do you think is going to turn Constellation around?
Yeah, I think it's a couple things. There's been some really interesting research out recently. I think a lot of consumers and investors that I've talked to would be surprised to see alcohol sales actually starting to climb within the younger demographic. So they've got a really nice portfolio. They've got some good craft beer businesses that I'm sure are trading at even higher valuations that they've acquired over the last couple of years. Of course, the Corona Modelo business. They've been struggling in certain segments of their wine business. But I think if you want to own a consumer staple stock that's going to be less sensitive to the cyclicalities of the economy, alcohol is a great way to go. And I think a lot of analysts feel as though they may have overpaid for their stake in the cannabis business, to your point. But long term, there's a great opportunity there. So I think you get paid while you wait. It's a great cash flow business. You've got a great portfolio as it is, and until we can really start to see more legalization take place within the U.S., beverages come to Canada. I think they're a great operator, and they have a really strong vision for what that looks like long term for them. And some research supporting that. And I think it gets, you're paid to wait with the alcohol business.
All right. Timothy Chubb is the Chief Investment Officer at Gerard. Good to have you here.
Thanks for having me.
Coming up, MGM bets big, but is it taking a major gamble by selling two famous Las Vegas hotels? Plus, let's take a look at some of today's most actively traded stocks by volume. Teva Pharmaceuticals topping the list. Just after 12:30 p.m. here in New York City, about 3 hours into the trading day, stocks are mixed at the moment. The NASDAQ, it's accelerating to the downside, now off by about 1/3%. Let's take a look at gold prices as we see this mixed picture for stocks. Gold heading higher by about 2/3%, $14.93 the ounce. Smart play or a big gamble? Why MGM is selling 2 of its historic properties on the Vegas Strip. Equal pay on the field. Legendary women's soccer player Michelle Akers joins us to discuss the debate that is raising questions in the sports world. And NASA wants to make sure SpaceX employees stay grounded, so to speak. The steep price they reportedly paid to keep those employees from lighting up like CEO Elon Musk. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Good to have you here. Almost everyone has some form of debt. Outside of car, student, and mortgage loans, 1 in 4 Americans carry close to $20,000 in debt. That means being smart about how you pay off those loans obviously is a necessity. Joining us with tips on how to manage your debt is Erin Lowry, also known as Broke Millennial. Erin, the holidays are approaching. A lot of people, we just talked about it, $1,000. That's how much everybody's expected to spend. So what advice do you have other than don't spend?
Well, that is a good tip, but let's be realistic. Most people are going to be spending. And when you're thinking about holiday spend too, it's October. So it's great that we're talking about it now because it's good to start cash flowing that early. But another thing that you want to be doing is figuring out how to minimize the impact of the debt that you may already have. So you mentioned that $20,000, and one of the options might be to look to moving that to a lower interest rate.
And so it seems like there is not a lot of education or understanding on the part of people once they rack up the debt, what to do with it. And there are some options. You mentioned moving it to a lower interest rate. You can consolidate your debt too, maybe move some, not just one area of debt or one credit card balance, but move several, right? So what are some tips that you have for people?
Well, absolutely. So first of all, that idea of a debt consolidation loan is great. So for example, Lightstream, an online consumer lender, they released a survey this year, 2019, that found that 70% of Americans do feel that debt is unfairly stigmatized, especially because a lot of people took it out for responsible reasons and are managing it responsibly. Debt consolidation being one way to do that. And so you are bundling your loans, hopefully to a lower interest rate. And then another thing too is you have to create an attack plan. And I know it sounds kind of silly, but a lot of times people just don't want to face their numbers. It's that ostrich in the sand type situation. So you have to be writing down who owns the debt, how much debt you have, minimum monthly payments and interest rates to have that attack plan.
There's also something that the banks and the lenders know. Most Americans work very hard to pay off at least the credit card because they want to keep the ability to borrow. You can call them and you can do settlements with them. You don't have to pay the full debt load if you are that swamped, can't you? You can say to them, look, I'm willing, and enter into a negotiation. I'll give you 80 cents on the dollar.
Well, you could look at doing a settlement. And I would also say a lot of people don't necessarily understand the difference between consolidating and settling. Depends on how you do the settlement. It could have an impact on your credit score. So consolidation is a way to protect your credit score. And I would also look at the fact, you mentioned that 20,000 number. So let's say that you have $20,000 of credit card debt at 20.23% APR. That's crushing. Mm-hmm. And if you consolidated that to a debt loan that then is at 5.95, you're going to save $5,000 over the course of 3 years. And you have that one easy payment as opposed to trying to scramble and manage all of these other payments at once.
Well, and I'm thinking specifically of student loan debt here. And a lot of the individuals that I talk to, paying off that debt is not part of their plan. They're just so swamped under the amount that they have, the number of years that would take to actually pay this off. What advice would you have to people like this who might not even be considering paying it off as part of their financial plan?
Well, one, you need to look at how to get it onto a plan. So if you have federal student loans, I would definitely be looking at your options such as income-driven repayment plans. So, and if you have, your loans that are private, that's when you want to be looking at other options because those are not going to get forgiven. So you need to still make an attack plan. And I look at this as a situation where you want to ask for permission, not for forgiveness later. You want to call up your lender proactively and have that conversation if you know you're not going to be able to make a payment and see if there's a way that they can work with you because you don't want to decimate your credit score in a particular month, especially if you have a high spend situation around the holidays.
All right, Erin Lowry, good to have you here, the Broke Millennial.
Thanks for having me.
Coming up, women's soccer looks to score big in the battle over pay. We're going to talk to two-time World Cup champion Michelle Akers about where things stand next. Let's take a look at some of today's winners on Wall Street. Let's take a look at the top trending stories on Yahoo Finance right now. Shares of medical device maker Abbott Laboratories in focus today. The company fell just short of Wall Street estimates for quarterly revenue and trimmed its full-year earnings forecast. The miss mainly due to the company's flagship cardiovascular unit. Nike has acquired TraceMe, a Seattle-based startup co-founded by Seahawks quarterback Russell Wilson. TraceMe allows fans to connect with athletes and celebrities. Nike said that the acquisition will supplement its content strategy on Nike-owned platforms. And for the first time ever, those planning a trip to the Bluegrass State have a chance to experience a unique lodging experience courtesy of Jim Beam. Starting October 21st, a home on Jim Beam's distillery property in Kentucky will be available for one-night stays via Airbnb. The reservation, the cost, it's just $23. I think it's BYOB, isn't it?
No. All right, the U.S. women's national soccer team continues to advance the ball toward equal pay. Most recently, the team kept up its fight in court, arguing that it should be allowed to move forward with its equal pay lawsuit as a class action. With us now, someone who's no stranger to the pitch, two-time World Cup champion, Olympic gold medalist, and National Soccer Hall of Famer Michelle Akers, breaker of chains. We were joking about some of your titles earlier. Michelle, when you look at the equal pay push that we are now seeing on the part of women's soccer, what do you make of the argument? Do you think it should be class action? And what do you think the implications should be for women-led sports in general?
Well, we've been fighting this fight for a long time, and we, meaning the U.S. women's national team. When I played on the team 1985 to 2000, this was a huge agenda for our team as well. And the latter teams have continued to push, and appropriately so. Things need to change. The pay and benefits opportunities, marketing, et cetera, are not equal to that of the men's. And that it just needs to be upscaled and reviewed. And let's get on with it. That's kind of my thought, is what's holding us up. This is the #1 team in the world for years and years. Clearly, the rest of the world is changing as well. The World Cup this last summer, where the U.S. won the World Championship, had a huge following, equal pay, equal opportunity in the stadiums, and it was a huge movement. I spoke to the media about it all summer. It was really incredible. So looking forward to seeing what this team will do with this opportunity.
You just answered the question I wanted to ask you partially. When you talk about that the audiences for Women's World Cup are as large as for men, because the critics of, when we have this discussion about equal pay, often will say, well, women's professional sports don't get the audience or the backing and the revenue that men's professional sports get. So what do you say to those critics?
Well, the stadiums are not as large as the men's stadiums, and the spectatorship in person is not the same on the women's scale versus the men's scale. That is completely true. However, the base of their pay as it is at present isn't reflecting the audience that they're playing to, literally and figuratively. And also the marketing dollars put into creating a larger audience or creating more spectators for the women's game may or may not be equal. I would say, I bet the barn that it's not equal dollar for dollar wise for the men or for women based on the percentages of what they're bringing in and who they can reach. So this, I think, is part of the issue. It's not as simple as just saying, hey, they get paid this amount, we should get the same. It's more complex.
One of the other things that you're trying to raise awareness about is CTE, and I know that's gotten a lot of attention on the football side, less so on the soccer side. What do you think that athletes, particularly young athletes, need to know about the risks when they're playing soccer?
Well, CTE, the chronic traumatic head injury, and for soccer, it's talking directly with heading the ball, a lot of heading of the ball, and what does that do to the brain, especially in younger kids, and then over time, that adds up and what happens. So for soccer, that really hasn't been explored. Obviously for football, it has. It still hasn't reached the level of understanding or change that is needed. And that goes for soccer. So soccer around the world has been looking at this. It's a new look. And so Brandi Chastain and I have offered to discuss this in the media and be kind of a figurehead of our concerns as athletes. We've headed the ball a lot over our career, and how will that affect our brains later on, and what can we do to prevent that? And also the comparison, all of these studies in the past have been for men's athletes, and why not for women's athletes? Why not for females in general? So this is a new change. This is, a big landmark as far as, the equal pay thing. And let's also give equal health opportunities and do studies based on men and women as well.
Hey, let's switch gears very quickly. You're auctioning off personal memorabilia. Now, part of the proceeds are going to go toward your Horse Rescue and Outreach Foundation. And I think a lot of people who are your fans may not realize what you do to help horses.
Yeah. Oh my gosh. That's my Thunder Man right there. That's his smile trick. So yeah, he does it to me nonstop. So it's like he's training me to give a treat. But I do, I've done horse rescue and sanctuary work for over 10 years now. I started in 2007. I've always loved horses. I read The Black Stallion as a little girl and wanted to be that kid in that book. And started saving these horses. And, I retired in 2000 and been thinking about it a long time. And this summer I decided, hey, I'm going to go for it and auction off all of my memorabilia. Actually, it's my entire collection except for a few pieces. And so it can help launch us into taking a bigger step into the horse rescue and partner with other organizations doing similar things, and also include programs for veterans and people wanting to do personal development leadership with these horses and animals that have been saved or helped in some way. So that's what all my memorabilia is going for, and I'm really excited to be taking this next step.
Great, and people have a few more days to get in on that. I believe the auction closes October 19th. Golden Auctions, GOLDIN auctions.com. Yeah. Michelle Akers, National Soccer Hall of Famer, thank you so much. Appreciate your time.
Thank you. Thanks so much.
MGM is making a sale. The global casino giant is selling two of its properties on the Las Vegas Strip, the Bellagio and Circus Circus. The Bellagio will be put into a joint venture controlled by Blackstone Group. That MGM will hold a 5% stake in that. The company says the sale will free up cash, allow more flexibility. Panel, jump in on this. Why is MGM selling these two hotels, do you think?
Emily?
Well, I mean, clearly these hotels aren't doing well under MGM. If we just look at MGM stock, it's underperformed the broader S&P 500. They're really turning to other initiatives to really turn this business around. One of the things I know we were chatting earlier was about sports betting, and also geographically, Japan. They're making a lot of investment there. Recently had laws that legalize casino betting, and that's something that could be a boon both for MGM Grand and for Las Vegas Sands, some of these other casino companies.
Yeah, all that is true. I would really emphasize the sports betting. There's a key quote in this article. I want to make sure we say that the piece is from the Wall Street Journal. The MGM CEO said, sports betting is a better use of our capital resources than traditional gaming. Well, there you have it. MGM has partnered with the NBA, with Major League Baseball, with the NHL, all the major leagues except the NFL. The NFL went its own way and partnered with Caesars for its first casino deal. But eventually, it's certainly welcome to make additional casino deals. So MGM, I'm sure, will get into the NFL as well. And the MGM sort of strategy right now, the playbook, sorry, pun intended, is open up physical spaces for sports betting, beef up its app and its mobile presence, and as legalization occurs state by state, these Vegas casinos can't just sit back and say, well, we're good because we're the brick and mortar presence in Nevada. People will come to us. They need to expand their arms and tentacles into mobile online betting across the U.S.
Well, that's what I was going to ask you. I mean, essentially, hasn't Vegas jumped the shark when you can go with basically anywhere in the country, you can go to a casino?
Well, not yet it hasn't, but I think we see the writing on the wall. In May, the legal betting revenue in the state of New Jersey exceeded the legal legal betting revenue in the state of Nevada for the first time. Now, May, a traditionally slow month anyway in Nevada at Vegas sportsbooks, but that was a major milestone. Now, look, in a month where you have March Madness or you have the Super Bowl, you have the World Series, that's not going to happen, but maybe we can see a time when eventually there's just not as much need to go to Vegas. I think already we're getting there. Now, it's still a thing for young people. You go to
Vegas also has a huge conference business, which is part of the business of the city, too.
LVS got
the buffet at the Wynn is worth it.
All right, coming up, NASA wants SpaceX to go sky high, but not on the ground. The massive price they paid to keep employee ideas from going up in smoke. Plus, take a look at some of today's losers on Wall Street. Workday falling after its Analyst Day. We got some more trending tickers for you from YahooFinance.com. One of these stocks is Adobe. Citigroup downgrading this stock to neutral from buy and taking the price target down to $313 from $322. Although it being neutral, the stock is still above that target price at the moment here, or I should say the target price is still above where the stock is right now. You can see the stock year to date has been an outperformer, pretty much paced with the market up 19%. The analyst at Citigroup says financial momentum will be slowing for this company. We continue to watch the drug distributors, and that's after the report in today's Wall Street Journal that they're close to coming to some sort of settlement regarding opioid prosecution to the tune of $18 billion collectively. So Cardinal Health and the other drug distributors are rising in today's session. In addition to that, we continue to watch General Motors. That's after the UAW said they were close to an agreement with the company, some sort of labor agreement that is going to give some concessions. So we await more details on that agreement. But in the meantime, the shares were up nearly 2%. If you're following today's trending tickers, make sure you're watching the ticker. It's right here at 2 p.m. on Yahoo Finance.
But let's go into the buzzer beater round right now. 3 stories, 1 minute each, and we start with this. The squad is feeling the burn. Democratic Congresswoman Alexandria Ocasio-Cortez, I did not write this, Ilhan Omar and Rashida Tlaib announced their support for presidential candidate Bernie Sanders. Does it matter?
Sure.
To an extent, I think it absolutely does. If we think about just the age range of some of these candidates, I mean, Bernie Sanders is 78, Joe Biden 76, and then Elizabeth Warren at 70. This really does kind of diversify just the people that they have throwing support by age, showing that some of the younger, demographics might be able to get on board with this.
I find it really disappointing, I'm sorry to say. And I think I can say that separate from politics. It's not like I'm a Warren supporter, but you look, we see the direction that Bernie's going in. Full respect to Bernie. I mean, his health is an issue. He's of a certain age. Joe Biden, too, is of a certain age. They had a chance, especially we're talking about whether Warren is sort of becoming the front runner. These women had the chance to back Elizabeth Warren and help elect the first female president, and they went with Bernie, and I'm surprised by this and disappointed by it.
I do wonder if voters will follow them. We'll see. All right. According to Moody's, speaking of elections, Trump will win the White House. And if the numbers are right, it's not even going to be close. And this has to do with how people are feeling about the economy and the markets right now. It's the economy, stupid. The old wasn't that Bill Clinton era? Am I thinking of the right time?
That was the Bill Clinton
And turnout. As I understand it, unless there is record voter turnout, this will be the outcome. And why would there be record voter turnout?
Don't believe the polls, because people lie when pollsters
Right.
call them.
No, I think that's pretty much the theory here is, all these polls are saying different things. Polls didn't show that Trump would be winning the 2016 presidential election, and here we are. So really take all of them with a grain of salt.
Although the polls back then, we're talking about the general population.
Right.
Hillary Clinton did win that by 3 million.
I was just about to say, that's what 538 and Nate Silver like to say as well. Actually, the polls were right. Hillary Clinton won the popular.
Well, and again, just to be clear, this has nothing to do with a poll. This has to do. This does not have to do with how people say they're voting. It's how people tend to vote when the economy is doing a certain way.
Okay, so NASA is throwing 5 on it, said the tightly wound middle-aged white guy. $5 million, that is. A Politico report says the space agency footed the bill for a mandatory review of workplace culture at Elon Musk's SpaceX. The report claims the review was prompted by Musk's alleged marijuana use. What's alleged?
But that taxpayers are footing the bill for
million,
this,
yeah.
as opposed to the company.
I mean, bottom line, this is just another example of taxpayers having to pay for, the fact that cannabis is still legal at a federal level. This is ultimately coming down to Elon Musk's, smoking of marijuana on a show, and they
Joe Rogan's podcast.
and now having to pay for that.
Adam, you're not familiar with I Got 5 on it.
My Eric calls
That
it
was
a
the
nickel bag.
reference.
All right. Thanks so much, guys. Appreciate it. Don't forget to tune in tomorrow. Our interview with Union Pacific CEO and Chairman Lance Fritz will be coming up then.
See you later.
It is 1 p.m. in New York City, and the major indices are teetering at the break-even point, as softer-than-expected retail sales numbers offset a strong start to earnings season. On tap for today, uncertainty still keeping the U.S.-China trade deal champagne on ice for now, why China may be positioning itself to flex its power before the busy holiday shopping season. Plus, Democratic presidential candidates duking it out in Fight Night Round 4. We'll have all the fireworks and the top talking points, including Social Security. The former Social Security Administration chief economist will join us to break down why not a single Dem has earned a passing grade. And Facebook not giving up on its crypto project. The executive behind it explains to Yahoo Finance why Libra is here to stay. All that and more. This is Wi-Fi PM. Good afternoon. Happy Wednesday. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Sabeel Marcellus, along with Blackhawk Financial founder Leanna Hawkins. Guys, good to see you again. We got a big day today. Right now, the market action a little bit quiet when we check it out. The Dow off by about 18 points, the S&P off by about 7.5 there, and the Nasdaq right now leading the way lower, off 0.4%. We'll see where things go throughout the hour. But first, the top story today. Questions are mounting over China's promise to buy more U.S. agricultural products, as the $50 billion worth of farm products would be significantly more than China has ever spent in 1 year. The Wall Street Journal reports Beijing may use the farm goods as leverage to urge U.S. negotiators to roll back plans for new tariffs slated to go into effect in December. But President Trump doubled down on China's commitment while speaking to reporters earlier today. Take a listen.
There have been some reports that China is not buying until the deal is signed. No, China started buying already from the farmers. It'll be anywhere from 40 to 50 billion, which is far more than anybody thought or expected. It's a great deal for the farmers. I think the farmers will come out, along with many other industries, something that's already taken effect, even though the deal won't be signed, probably until I meet with President Xi in Chile.
Yeah, so the deal hasn't been signed yet. So there's a lot of people saying that nothing's final until that happens. And of course, we've seen kind of both sides waver on commitments they've made in the past. We've seen that play out, and there's no guarantee that it couldn't also play out here.
Yeah, my thought is, here we go again. We've seen this before, where President Trump basically has a truce with the Chinese president. China promises to buy more agricultural goods, and then no movement. They don't actually make those purchases happen. So at this point, it's like, is China trying to make President Trump look like a fool? Because he should have known. It's like, what is the expression? Fool me once, shame on me. Fool me twice, shame on you. Fool me twice, shame on me. At this point, it's like, shame on President Trump for actually thinking that it would make a difference this time. China is actually using his vulnerability, the fact that he's facing an impeachment inquiry, to ask for more. So what they got out of this mini trade deal, phase one deal that hasn't been signed yet, is that President Trump hasn't gone through with escalations in tariffs this week. So already a win for China, nothing for the U.S. Now they want more. They want the December 15 tariffs to also not go into effect. So the U.S. is really not getting anything out of this at this point.
Yeah.
I mean, he's definitely putting pressure on China, though. $50 billion in agricultural exports to China alone, that would be a third of the U.S.'s entire farming products exporting from the country. So, you know, the studies and articles are saying that really it's not an attainable number if that's going to be the mark that he's going to put on them. And obviously managed trade is not allowed by the WTO. So China's really going to have to figure out some sort of realistic time frame and pricing metrics to be able to make any of this even close to attainable.
And the question is, do they even want to? Were they just kind of throwing that number, you know, behind closed doors, and then now that it's public, just not make those purchases and just make President Trump just like out there on a limb?
And balking at the number as well, potentially seeing if they shrink it moving forward. But you're right. I mean, when we talk about the October tariffs that a lot of people were wondering about, at least those were taken off the table, being something that we did see concretely come from phase one of the trade talks there. But now both China and the U.S. looking to those December tariffs as well. We'll see where progress goes. As the president says, nothing will be final until he meets with President Xi Jinping in Chile. Meanwhile, though, on the U.S. side of the trade war, the House passed legislation that takes an aggressive stance on China's Huawei, the tech firm in the country, in addition to showing support for Hong Kong protesters. So this is a little bit of a wrinkle that might complicate things here. The question is, obviously we've seen what the NBA is dealing with. We're going to get into that in a little bit later in the show. But obviously, the Hong Kong pressure point here is interesting, as is the Huawei pressure point, because we're talking about some big sticking points on the Chinese side. And if you're talking about it here in this country, in the U.S., that seemingly would complicate these discussions and negotiations on the trade front.
Yeah, so when it comes to supporting these Hong Kong protesters, so the U.S.'s best export is our values, not necessarily our goods, but being the moral leader in the world. And I think that's one of the reasons why the world has followed us since World War II. And what we're seeing with the Hong Kong protests is when it comes to American businesses and when it comes to sports, and we'll get into more of that later on the show, but they're basically missing the boat here. They're basically putting profits above of American ideals, especially freedom of speech, which is like extremely important. So what we're seeing here is that legislators in the House are actually putting out measures saying that, you know what, we support Hong Kong protesters, we support their autonomy, and you have the U.S.'s back as long as, and they want to prevent China from interfering in Hong Kong's affairs. And it'll be difficult, but at least they're saying the right thing.
And I would say as far as the Huawei subject goes, the security threats, IP, security from the U.S. and Iran sanctions. I mean, basically, I think what he's trying to do is potentially make an example of this situation, saying this is not okay. Again, we have a higher moral ground, or this is what we like to exemplify as a country, and this won't be accepted by the American people.
Yeah, and it's not just Hong Kong or Huawei. It's also, remember, a couple weeks ago, the human rights violations as well that President Trump was talking about, and what's going on in China as well. So there's all these points, but nonetheless, both of those things came before we got phase one of the trade deal, so not too much seemingly of an impact there, at least for now. But again, these are all very complicated issues, and as you get to phase two or phase three, further along in the trade deal, you have to expect that these things are going to be a little bit thornier than what we saw in trade one, just taking tariffs off the table.
And also, real quick, China is also warning that if the U.S. actually does legitimately back Hong Kong or interfere, it's going to affect bilateral talks. So it's definitely going to seep into trade war talks.
Yeah, for sure.
So it's definitely going to have an effect there.
Back here, though, in the U.S., we're getting new economic data today showing signs of a shaky consumer. Remember that the U.S. consumer is what has really held up so far, despite all the recession talk. Retail sales now, though, dropped for the first time in 7 months in September, unexpectedly falling 0.3% last month. Analysts polled by Bloomberg had estimated a 0.3% increase. So, guys, the question is whether or not this will strengthen the case for the Federal Reserve to once again cut interest rates if this retail data does show perhaps a crack in the U.S. consumer, the bastion of strength that we've seen hold up so far.
Yeah, huge red flag. We're seeing consumers pull back when it comes to spending just as we're getting into the holiday season. It should be the reverse. There should be an other momentum going into that. But it's also, you know, consumers, they're reading the headlines. They're hearing about all these tariffs. Consumer goods are going to get more expensive. Companies get it right. They know when it's the holidays, people want to hear about sales. They want to hear about discounts. They don't want to hear about tariffs and consumer goods becoming more expensive. Also, there's even like European cheeses and wine. That's also going to be more expensive. How are you supposed to entertain your family in this kind of an environment?
No cheese, no wine, no good holiday. That's
right, exactly.
Well, at least we're not getting the wine from China. I get most of mine from North America. But that being said, I mean, yeah, clearly consumers, it looks like they're pulling back a little bit. We'll see when the next report comes out if they actually end up doing that through the holiday season or not.
Yeah.
But I think, you know, as a financial literacy best-selling author, I think it's important as well that it seems that consumers have probably learned some lessons from our last recession. And if we are gearing up for something in the next, 12 to 24 months, that they should be a little bit conservative.
Yeah, and I mean, Sabila, you've been looking into that too, right? Because we've looked at how the U.S. consumer might be able to stomach a downturn, but increasingly it doesn't seem that, though we've been in the longest expansion in U.S. history, that people are in that much of a better position.
No. So Bankrate actually did a survey, and nearly half of Americans say, I'm not ready. I am not prepared for a recession. Now, the good news is some Americans are actually starting to take steps because they really fear that a recession will hit within the next 12 months. So the most common step is people limiting their spending. So that's probably what we're seeing there reflected in the retail sales that were disappointing. But also, they're also increasing savings for emergencies, for retirement. Some are even looking for other jobs so they can have more financial stability. So yeah, so consumers are basically trying to deal with financial insecurity, and they just want to feel a little bit more safe because they remember what happened in 2008. It was ugly, and they don't want to go through that again.
Yeah. And I mean, if you're weighing kind of spending now or saving for the future, there's always that piece of the interest rates playing into what kind of APR you're getting at the bank as well, that plays into this when you're trying to decide, should I spend my money now or should I not? But you're right. I mean, when we look at the retail sales numbers, if that's what Americans are doing, potentially saving for that rainy day,
right?
I mean, this is where we kind of do hear people talk about scaring yourself into a recession.
Yes, so there's always that risk. So you definitely don't want to scare yourself into a recession, but you don't want to be caught off guard by a recession either.
Yeah.
We know the big banks, if it's really, really bad, they can get a bailout. You're probably not getting a bailout for you and your family and your kids. So you have to take care of your own finances and protect yourself. So limiting spending is a good way of getting a good financial footing.
Yeah, there's not a lot of government coverages for personal bailouts other than bankruptcy. Nobody wants to go through that. The statistics around that, the majority of the Americans don't have $500 to even $1,000 for emergency savings at this point. I mean, that's been hugely publicized this year. So hopefully, a lot of people have learned from mistakes and lessons from 2008, 9, 10.
Well, normally I get paid to make segues, but you guys basically did my job here talking about it, because the
noticed that.
The next subject, we're talking about General Motors, and that's a perfect example of bailouts, and then also protecting your well-being, because we've seen this battle between GM and its auto workers go on, battling with the union there. But we have news that General Motors has reached a tentative labor deal with the United Auto Workers Union, and it's a critical step that would help end the 5-week-long strike that brought over 30 GM factories in the U.S. to a standstill. Guys, the strike will continue for now because this needs to be approved by the union leadership before Thursday. But a positive development on both these sides. As I mentioned, 5 weeks the strike has gone on so far.
Yeah, finally. I mean, we're talking about 48,000 workers on strike. That number is massive. And if they're actually close to getting a deal that could be signed possibly in 2 weeks, I mean, it's a win all around. We don't know the exact details of what GM is promising and what the union is willing to accept, but we believe that in previous negotiations, GM had talked about spending and investing $7 billion and also creating more jobs over the next couple of years. So we expect that's probably going to be a part of the deal. But in terms of strikes, we expect that the union will actually take this this deal as soon as they sign it with GM and use it as a template for talks with other car makers. So we're going to continue to see ripple effects of the strike, even if it ends.
The heart of it, too, it was healthcare costs as well. The union pushing for making sure that they weren't going to be stuck with the healthcare costs that we're seeing rise with these companies and workers overall as well. But when we talk about how long this has gone on for, the costs had been stacking up for GM. When we talk about how much the strike has impacted them financially, $450 million. And we're talking about weekly costs for that company here when productivity reaches a standstill. And on the flip side, $12 million from the strike fund for UAW workers. So both sides had been feeling the pain. If they do reach a deal, hopefully both sides would be pleased with that, depending on, of course, as you mentioned, Sabeel, the details coming out later. Well, coming up, the Democratic presidential hopefuls taking the stage last night for the 4th debate. We'll have all the fireworks and who was able to break from the pack next, plus Social Security emerging as a key topic of debate night. We'll chat with a former chief economist at the Social Security Administration for his take on why none of the candidates are going far enough to stop that program from running out of money. When Wi-Fi PM returns. Welcome back to Wi-Fi PM. Right now, we are still watching the market action in the red. The Dow off by about 20 points and the NASDAQ still leading the way lower, off by about 0.5%. We'll see where things go throughout our hour. Well, the Democratic debates got heated last night as we saw sparks fly. Senator Elizabeth Warren defended her positions on taxing big corporations, but also made it clear she doesn't have beef with billionaires. Take a listen.
I guarantee you built it in part because in workers all of us help pay to educate. You built it in part getting your goods to market on roads and bridges, all of us help pay for. You built it at least in part protected by police and firefighters, all of us help pay the salaries for. And all I'm saying is you make it to the top 0.1%, then pitch in 2 cents so every other kid in America has a chance to make it.
So there she goes. She was really going after billionaires there. I mean, this is why we've seen a lot of Wall Street, a lot of rich people out there scared of what might happen if Elizabeth Warren's elected.
Yeah, Warren was in force during the debate last night. I mean, everyone was attacking her because, of course, she's now emerging as the likely frontrunner for the Democratic Party. When you could look at the national polls, she's actually beating Biden. So she was under attack, and she really defended why she wants to go after billionaires' pockets, why she wants to make them pay more taxes to achieve all the other big promises she's making in her campaign in terms of canceling student loan debt, Medicare for all, having the government provide your health care, and also going after Wall Street. So, for example, private equity firms can't make a fortune when they buy a company that actually fails. So the way her proposals would actually change the way Wall Street does business. So that's why we're seeing a lot of investors be scared. I was talking to a money manager recently. He was saying that over the past 2 weeks, clients love to talk about football, but it's been like Elizabeth Warren all the time. Like, that's all they want to talk about. They want to catch up and figure out like how her decisions and her being president would impact their portfolios, what the risks are, and how they should allocate their assets. So that's pretty much what a lot of investors are worried about right now, and in several different sectors.
Yeah,
I agree. And yeah, working within the financial sector myself as an entrepreneur, we have these conversations all the time. Like, what is the Warren tax bill going to be if that does happen? And yeah, how would we allocate our investments to minimize that bill of anything new that comes into play?
Yeah, I mean, she was hit plenty of times by other candidates up there asking about tax increases for the middle class as well. That being a big worrying point. When you hear new taxes, everyone's wondering, how am I going to be impacted?
Yeah, absolutely. So the Medicare for All conversation, I'm so glad you brought that up, Zach, because that got really contentious. And she was even called vague for having a vague plan by Biden. And Senator Klobuchar was like, oh, you're being disingenuous. How are you going to pay for Medicare for All? You're not going to raise taxes on the middle class.
Yeah.
And Elizabeth Warren stayed on point. She repeated her message. She's like, taxes are only going to go up for the wealthy and corporations. They're not going to go up for hardworking middle-class Americans. I mean, this woman is a pro. She knows exactly how to stick to her soundbite. And her policies will definitely impact Wall Street, but she has said she doesn't want Wall Street money. So she's definitely staking her claim as, I'm going to be the person who can't be bought in this race.
I mean, she definitely did stick to her gun. She stuck to exactly the talking points that I think she's had, that she's seen work. When we talk about her becoming a very true force, and as you mentioned in the Quinnipiac poll, leading among the Democratic candidates as well. But when we talk about who spoke the most last night, that's always an interesting component of the debate, which with this time clocked in at about 3 hours time. But which candidate spoke the most? Well, turns out, as you can see there, was Senator Elizabeth Warren that took the most time, nearly 23 minutes of speaking time.
She's busy defending herself.
Yeah, she had a lot to say, followed by former Vice President Joe Biden clocking in at just under 17 minutes. And newcomer Tom Steyer came in last place with just over 7 minutes of speaking time there, which is kind of surprising considering he had been polling a little bit stronger than Tulsi Gabbard, certainly heading into the debate, but he hasn't been one of those candidates who had been up there before in the same kind of way that we've seen other candidates take their moment and shine. He didn't get to speak all that much.
No, but he tried, because obviously we were talking about income inequality. They were talking about it at the debate, and it's like he's the only billionaire on stage. So how can you not see that as your opportunity to shine or at least make a statement? And he tried. So he definitely said that, yeah, I'm a billionaire, but he does see income inequality, and he says the reason why he's running is because he believes the government's broken and corporations have too much power. So he said the right things, he hit the right notes, but he just started. You know, he's a newbie on the debate stage.
Yeah, well, you talk about how many people were coming after Senator Elizabeth Warren, and maybe that was a piece of why she was talking so much, because she was repeatedly responding to everyone else's talking points. But we want to highlight one of those moments. Check out this clash between Senator Warren and Andrew Yang debating big tech.
It runs the platform, gets all the information, and then goes into competition with those little businesses. Look, you get to be the umpire in the baseball game, or you get to have a team, but you don't get to do both at the same time.
But we also have to be realistic that competition doesn't solve all of the problems. There's a reason why no one is using Bing today. Sorry, Microsoft, it's true. So it's not like breaking up these big tech companies will revive Main Street businesses around the country.
All right, so there you go. Elizabeth Warren was talking about Amazon there, and then Andrew Yang came back with the idea that maybe breaking up big tech isn't the answer.
Yeah, that's been repeated all over the networks this morning. Is that one statement about Microsoft from Yang?
Yeah, absolutely.
And not even, I mean, I wouldn't even say just about big tech, but it's interesting also to see when you look at the different categories of what was discussed in yesterday's debate. Healthcare, obviously number one. Climate was last by far. Probably about a third of the time they spoke about healthcare, gun, other issues, education. So that's
I saw a lot. There was a lot of talk on Twitter, and everyone was angry about climate change not getting the time it needed.
Yeah.
We even saw from Jay Inslee, some of the other candidates who had been in the race. But CNN dedicated a 7-hour town hall to climate change, so credit where credit's due.
And Bernie Sanders did mention it slightly when he was asked about automation replacing jobs, and he's like, yeah, make more green jobs. Yeah. So it was a little bit mentioned, in the debate, but it wasn't definitely not a center point.
Yeah, I mean, you can't.
Volvo came out with their first electric car today, so.
There's a lot there.
Some people are talking about it.
Still getting the attention I think that it deserves. But an interesting night, debate round 4 there when we saw everybody. As we broke down there, you can debate who's winning or who's losing, but those are the topics that are being talked about most. When it comes to money, though, that's an interesting piece of this, too, because it's not all just about polling and what sound bites you can generate on debate night. And right now, people are worried about former Vice President Joe Biden's fundraising numbers for his campaign. And Yahoo Finance's Kristen Myers joins us now with the details on why Uncle Joe might not be looking too good here. What's going on?
Right. So yesterday was the filing deadline with the FEC. Now, we've heard a lot of the campaigns already come out with their third quarter campaign numbers. Biden, of course, did not, and usually that's not a good sign. So I do have his numbers. He only raised $15.7 million in this last quarter, and he only goes into the rest of his campaign with only $9 million cash on hand. Now, that cash on hand number is pretty important because obviously that's how much they have still left to spend on advertising. Now, just to put this into context, right? So Joe Biden was originally thought to be the front runner. He famously pulled in like $6 million in 24 hours when he first announced his run, but he's obviously quickly losing steam. So you have Elizabeth Warren. She's got $26 million cash on hand. She raised almost $25 million. And of course, this does not compare at all to Bernie Sanders, who's doing the best. He has $34 million cash on hand and raised $25.3 million. So when it comes to the rest of the Democratic candidate field, Joe Biden is not doing very well, and especially not well enough to be the front runner right now. And as we're seeing Elizabeth Warren really surging in the polls, and of course last night during the debates, all of the candidates really took shots at her, trying to pull her down a peg, which really I think cemented in a lot of people's minds that she is right now the front runner, especially with Sanders, who I think at first was edging her out a little bit after he had his recent health scare. I think what Warren has been able to really pull ahead a little bit. But no, when it comes to money, Joe Biden is not doing well. Yeah. And of course, as we all know, Donald Trump
continues to rake it in.
Yeah. But it's not, handily beating them all.
But it's not just fundraising, though, that we're looking at, too, though, because it's how much you're spending. And,
yes,
we highlighted that a little bit. But Joe Biden's spending about $1.12 for every dollar he's bringing in right now.
He's spending more.
Cash flow problem.
Right. So he raised $15.7 million. He spent more than $17 million last quarter. And he's spending it on things like private jets. He spent almost $1 million last quarter on flying around in private jets.
Gotta travel in comfort, right?
I guess you do. But
you're a Democratic candidate, of course.
If you don't have a lot of money, you just can't be making these decisions anymore. And it's going to get to a point, if we continue to see that number dwindle, we might actually reach a point where Joe Biden, we're starting to hear him say things like Cory Booker had said, which is, I can't continue my campaign unless I have your financial support.
And also the problem with Biden is that every time we're talking about Trump's impeachment inquiry, Biden's name keeps coming up. Obviously, he's not under investigation, but it doesn't help. And it makes him a lot more vulnerable. And that's why we're seeing even former New York Mayor Michael Bloomberg saying, you know what, I'm going to run at this point, because he's also worried that Elizabeth Warren could be the Democratic nominee. And when it comes to Wall Street, they definitely don't want Warren to be the nominee because they view Biden as a non-market event. But if Warren is elected, then things are going to change.
Well, Biden is largely viewed as one of the more centrist politicians up on that stage. Amy Klobuchar is another one. Obviously, Sanders and Warren farther left than the rest of the field, actually pushing that field, I think, a little bit more left than would have happened if they were not on that stage. But again, we talk about this a lot, and I do want to mention this for people because they say, well, how much does money really matter, right? How, as long as you have the support of the people and you're willing to get the votes, does it actually matter how much money you have? Well, the answer is yes. In short, it's yes. Time and time again, studies have shown that the person who has the most money wins overall. And it's particularly alarming when your front runner among your field is not doing well when it comes to the money that they're pulling in from donors, especially when they have made this election essentially this like David versus Goliath match between the Democrats and Donald Trump. And Donald Trump is, frankly, just beating the crap out of the Democrats when it comes to fundraising, when it comes to those numbers, when it comes to how much he's able to pull in from donors, small dollar donors as well, which is huge. Republicans normally do not do very well when it comes to those grassroots donors.
But he's not facing competition right now. He is going to be the Republicans' option unless there's an
unless there's an impeachment. Unless he's impeached, he's going to be their
besides
nominee.
that,
when it comes to money, he's absolutely destroying them right now.
So. And that's probably not going to happen. But all that being said, Biden's campaign officials have no worries, they say, and they say that the burn rate is sustainable. So, I mean, not that they're going to outright admit it if there's a cash flow issue.
Sure.
They're going to play it cool.
They are saying they're confident in that sustainability, right?
As long as they crank up the donations that they're getting, it's fine. But it's one of those things you got to watch.
Hit the pavement with that plane, right?
It'll be interesting to see fourth quarter how well Biden does, if he can get a little bit of a boost or if he continues to just.
Yeah. Well, he ended the debate last night with a very serious. Got up and shouting and ended it with period. And we will end this segment with that as well.
He's like, no training
We're
on
done
day
here,
one, right?
Period. All right, Kristen Myers, thank you so much. Appreciate it.
No problem.
All right, well, Social Security, speaking of running out of money, Social Security is one of those programs that's also running out of money. And Democratic presidential hopefuls have a variety of ideas for raising additional revenue, according to a survey of presidential campaigns by Yahoo Finance and the Funding Our Future campaign. Take a listen to Senator Elizabeth Warren's stance last night.
I think the thing closest to the universal basic income is Social Security. It's one of the reasons that I put forward a plan to extend the solvency of Social Security by decades and add $200 to the payment of every person who receives Social Security right now and every person who receives disability insurance right now. That $200 a month will lift nearly 5 million families out of poverty.
So joining us now is Bipartisan Policy Center fellow Jason Fichtner, and we should note the Bipartisan Policy Center is a partner in the Funding Our Future campaign, which is dedicated to making a secure retirement possible for all Americans. Jason, you're a former chief economist at the Social Security Administration, so what's your take on the plans put forward by the candidates when it comes to Social Security?
First, thank you for having me on today. I think it's important to realize that, as you kind of pointed out at the beginning of the segment, that the Social Security program right now is facing a financial shortfall. The combined trust funds for both the retirement and disability programs are scheduled to be depleted in 2035. Now, that does not mean bankrupt. It just means that at that point in time, the trust funds are depleted. Social Security can only pay out in benefits what it collects in payroll taxes, which would amount to about 80%, meaning if nothing is done by 2035, then we could see a 20% across the board reduction in benefits for everybody. So the point is that right now, we can't even promise to pay the benefits. We've promised people already, and we have candidates out there trying to promise more benefits on top of the shortfall already. And to give you an idea of the magnitude of the shortfall, it's basically about 2.7 percentage points of taxable payroll. So if we were thinking about raising payroll taxes, it's roughly 3 percentage points to make the trust fund solvent. But it also amounts to about a $14 trillion present value calculation, meaning we need about $14 trillion more in the bank today just to pay the benefits we promised going forward.
Well, I mean, when you're talking about the candidates' plans there, too, you're noting that none of the candidates have plans that would ensure solvency for Social Security moving forward. So if it's not just payroll taxes that's going to get us there, what do you think can be done to make sure that the program can stay funded past 2035?
Well, this is actually a very good point. I mean, Representative Larson in the House from Connecticut has actually put forward a plan, and to his credit, he puts a plan forward that actually is solvent. And to give him extra credit, he actually was on your show yesterday and said that the Congress has a responsibility to do something and recognizes that you have to spread sort of the taxes increases across everyone, including the middle class. And he's being very honest about that and deserves a lot of credit for coming forward. And traditionally, Social Security has relied primarily on payroll taxes to fund the program and some interest off the trust fund bonds. There's a question now about whether or not we want to keep raising taxes on payroll, on labor, which could make labor more expensive and harm the ability to hire workers, instead of looking for other sources of revenue for potentially maybe like a carbon tax to fund Social Security.
Jason, when you I don't know if you were watching the debate last night, but if you were, there seemed to be a common theme when you're talking about spending more on these benefit programs. There's a big one out there that's being talked about now when we talk about Medicare for All. There's a big issue during the debate last night. I want to play a little bit of the sound and get your reaction. Take a listen.
I will not sign a bill into law that does not lower costs for middle-class families.
But the way to do it without a giant multi-trillion-dollar hole and without having to avoid a yes or no question is Medicare for all who want it.
The plan is going to cost at least $30 trillion over 10 years. That is more on a yearly basis than the entire federal budget.
I believe the best and boldest idea here is to not trash Obamacare, but to do exactly what Barack Obama wanted to do from the beginning.
The issue is whether the Democratic Party has the guts to stand up to the healthcare industry, which made $100 billion in profit.
So there you go. I mean, Jason, when you're listening to all that and you're talking about Social Security not having enough money to last till 2035, I mean, is it inevitable that taxes here, whether it's payroll or elsewhere, are going to have to go up to fund either Medicare for All, Social Security, or all these benefits that Democrats are talking about? Because even amongst themselves last night, it didn't seem like they could agree on at least coming out and saying that, yes, taxes are going to have to go up.
And the answer is yes. If you're actually trying to have, and you're going to come out and promise free education, free health care, reduction of student loan debt or forgiveness of student loan debt, basic economics we were all taught is that there's no such thing as a free lunch. Someone's got to pay for it. And you can't keep saying the top 1% is going to pay for everything, or there'll be no top 1% anymore, or we'll keep reducing the value of those who have 1%. It costs money. I mean, as Vice President Biden pointed out, the Medicare for All that Senator Sanders put in, which was a bill that was scored by some outside experts, basically estimated it costs about $32 or $33 trillion over 10 years. That's $3 trillion a year. Again, Social Security currently, which is the largest federal program in the country, last year spent $1 trillion. So you're talking about a new program that would spend 3 times the amount of Social Security.
Yeah.
And that would drastically change how we look at healthcare today. And you've heard some of the debates earlier about who this impacts, and it definitely impacts the middle class, especially like UAW workers, who right now, with their various contracts they have with the automobile industry, get better healthcare benefits than Medicare. So if you're talking about Medicare for all and you're getting rid of the private sector insurance, they don't want to give it up. And so it's going to impact them in some way or another. They're going to have to pay.
Yeah.
So at the debates we've had so far, Medicare for All was definitely front and center, attacking it or supporting it. But Social Security doesn't really come up. I mean, even when we played that soundbite there with Elizabeth Warren, it only came up because she was talking about it. Exactly, compared to what Andrew Yang was offering, which is universal basic income. So why do you think Social Security is not a bigger issue discussed on the debate stage? Is it because it's going to create more taxes and no one wants to talk about that?
Well, I think the problem is that 2035 seems like a long way off for people. You know, we're now in 2019, so we're talking about 15, 16 years. And for some people, they're like, we'll deal with it 5 years from now or 10 years from now, or we'll deal with it when we get to the insolvency date. That's too long to wait. But that distance is basically making people think the crisis is not here yet. The crisis is already here. If we were to raise taxes today, so if we did it right now to solve the Social Security solvency, just on tax increases, nothing to change on benefits, no additional benefits, just made the program solvent to promise what we could pay people we promised today, it's a 2.7 percentage point increase. So from 12.4, add 2.7% to get to 15.1. If we wait till 2035, then it's a 3.7 percentage point change. So you're basically going from, that amounts to a 30% payroll tax increase on Social Security payroll taxes.
Yeah.
That's a big benefit. That's a big tax increase.
More
just
reason
to get basic solvency.
More reason to get it solved right now, and more reason to admit that it's an urgent issue. All right, Jason Fichtner, thank you so much for breaking it all down
Thank you
for us.
for having
Appreciate
me.
you taking the time. Let's check in with Scott Gamm on the floor of the New York Stock Exchange, though, to get back to the market action we're seeing today. Scott?
Hey there, Zach. Well, stocks are slightly in the red right now, but we had a big up day yesterday, so it's no surprise that stocks are taking a bit of a breather today. And remember, last Friday, we had a big up day, and what happened on Monday? Stocks took a breather. So this is part of the normal pattern we're seeing within the Dow right now. Your leaders are stocks like Johnson & Johnson, Boeing, and Disney. We know, of course, Johnson & Johnson reported strong earnings yesterday, and the stock is up for a second straight session today. Your laggards in the Dow right now are Exxon, UNH, and Microsoft. United Health giving back some of that big gain we saw yesterday when the company reported strong earnings. UNH was up about 8% yesterday, and today it's down a little bit less than 2%. And then outside of the Dow, Zach, we're also keeping an eye on shares of General Motors. That stock is up about 2% right now. We have been seeing some reports that GM has reached a tentative deal with the United Auto Workers Union. Of course, a deal that could end that 31-day strike that has been going on for the past 30 days, Zach.
All right, Scott Gamm on the floor of the New York Stock Exchange. We'll check back in with you later on in the show. But next, on Wi-Fi PM, the pressure to break up big tech intensifying among Democrats. Why Senator Kamala Harris is calling on Twitter to deactivate President Trump's account, and why China might be exerting more effort on the platform than people realize. Plus, the Facebook exec leading the charge to launch the company's crypto project, defending its goals in our new interview with David Marcus. We'll have that right after this. Good afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Sabeel Marcellus, along with Blackhawk Financial founder Leanna Hawkins. Guys, good to see you again. Strong second act to get to. I think it's going to be tough to top Act 1, but we're checking the market action again to see right here, right across the board, the Dow up by about 12 points, the S&P up by about 7 points, and the NASDAQ right now still leading the way lower, off by about 0.4%. We'll see where things go in the second half of the show. Well, the blowback against LeBron James is intensifying after the NBA superstar took issue with Houston Rockets GM Daryl Morey's decision to tweet his support for Hong Kong protesters earlier this month. And many have criticized the league and now James for caving to pressure from China to stay quiet on the Hong Kong matter. And protesters in Hong Kong were seen burning James's jerseys since he chose not to echo Morey's support. And back here in the States, memes of LeBron depicted as a Communist Party member, like this one, were circulating on social media. But last night, the star told ESPN he was done addressing the Hong Kong issue. Take a listen.
I probably won't talk about it again because I'll be cheating my teammates by continuing to harp on something that won't benefit us, trying to win a championship, because that's what we're here for.
All right, so there you go. I mean, Sabeel, LeBron says he's moving on, not going to talk about it. Of course, if he tuned into Yahoo Finance's AMS, he would have seen Jay Williams give NBA players similar advice. Don't talk about it. Just steer clear. But will everyone else move on, I guess, is the question.
Well, it's too late. We already heard how he feels about this issue. And he said exactly the wrong thing. I mean, as an advocate of Black Lives Matter, how could he not understand that Hong Kong lives matter too? Freedom of speech, it's important, not just to Americans, but to other people around the world. He messed up here, big time. And remember, Laura Ingraham of Fox had said, you know what, he should just focus on the game of basketball, just, be quiet. She's a stronger, and dribble. And it looks like that's what he's going to do now, because now he's wadded into this geopolitical, tensions that are going on right now between Hong Kong and China and the U.S., trying to kind of support Hong Kong without actually physically interfering onto the Hong Kong territory. Yeah. And, he just showed that for him, it's all about profits. It's all about money above people's right to their own sovereignty.
And that's why we saw kind of the memes that we were just showing there of him in communist garb kind of proliferating on social media right now because people are calling him out for that.
Yeah, and as he said in the clip there, it's affecting his teammates. The preseason game they had in China on Saturday, all the Chinese networks refused to air it. I think that when an athlete or anyone that's outside of the political world where they can and maybe should be making public statements or aren't necessarily educated on all the different areas of, the topics and the discussions around Hong Kong and what's going on there, these people have to remember, like athletes, when they make statements like that they have brand partnerships, they have deals with shoe companies that have huge money, huge business in China. And, I think, as you said, it looks like he's learned his lesson. He is going to stay quiet now. But yeah, it's a big, we all have the right to freedom of speech in America. Yeah. But you got to be careful how you use it sometimes.
Well,
Twitter.
Yeah, well, speaking of
Trump does it on purpose. Like Trump, his whole game is Twitter.
Yeah, and now LeBron is learning his lesson too.
Well, while we're talking about defending freedom of speech here in this country, that's a big piece of what these tech companies are looking into when they're trying to make sure that speech is not limited on their platforms. And for Daryl Morey, that was an interesting piece of this too. When you look at what happened to his Twitter account after he did come out with his pro-Hong Kong stance, because he took that tweet down. But even after deleting that tweet, his Twitter account was hit with what cybersecurity experts are calling a coordinated pro-China attack, which could be a mix of bots and human accounts used to influence the thinking on the platform. In total, Morey's account was hit with more than 160,000 tweets in the week after his Hong Kong tweet was taken down, about a quarter of which came from accounts without a single follower, which is interesting since those cybersecurity analysts are pointing to perhaps a state-oriented attack on Morey after he took that pro-Hong Kong stance. But Twitter responded to the journal's reporting in a statement given to Yahoo Finance saying, quote, "Coordinated activity and other forms of platform manipulation have no place on our service. We will take enforcement action on any accounts that are displaying these behaviors." Because, of course, Twitter does not want to get caught up in some of the other problems that perhaps Facebook has seen when it comes to policing its platform. Because you don't want states and foreign interests kind of deciding what what Americans can say on their own accounts here.
Yeah, but it's a little late for Twitter to say, oh, we don't want, this interference on our platform, because we know the interference has been going on. Plenty of people use bots. The other day we were talking about a story on Juul and how, federal officials are going after Juul e-cig manufacturers because they're using bots to promote e-cigs to the American public. So yes, there's a huge misinformation problem on Twitter, and it's not just China using these bots that's the problem.
Yeah, and we've seen Twitter try and address it before, take those bot accounts out. That's been something they've been pushing their shareholders on buying into, because sometimes it might hurt their active user numbers as well. But as long as everyone's buying into it, shares have held up when they've tried to convince shareholders that that's the right way to go. But I want to shift away from Twitter to Facebook now, because Libra's co-founder is speaking out after several key backers, including PayPal, Visa, and MasterCard, decided to drop out of the crypto association. And Yahoo Finance's Brian Chung joins us live from Washington, D.C. with more on that. Brian, you sat down with Libra's co-founder last night. What did he have to say about it?
Yeah, well, we had a long conversation about everything from the privacy concerns with Facebook to the actual status now that, as you mentioned, 7 companies have dropped out of the project, but they did sign an agreement in Geneva with the 21 remaining companies. That was on Monday, and they say that that's the first step in really starting to get some of the formal processes behind Libra in place. But keep in mind, David Marcus, again, the head of Facebook's Calibra project, is here at the International Monetary Fund annual meeting where I've been doing hits from all day, and he's been having conversations with regulators and central bankers all over the world about where Libra goes next. And here's what he had to say about some of those conversations.
No. And look, I think, I want to characterize the conversations that we've been having with regulators and central banks all around the world as very constructive and productive. In other words, they invested a lot of time to understand where we were coming from and what we were trying to do. Of course, highlighted a number of legitimate concerns and risks that could be posed by a system like this if it's not actually managed properly and designed properly. And now it's on us to come back with answers. And now that since yesterday we finally have an association and governance model to do that, we're going to do that. But those are very constructive conversations. They're not conversations where they're telling us don't do this without actually giving us a chance to do the work, which I think is not always true from all the stakeholders that we're interacting with, but on the regulatory front, central bank side, it's actually very constructive.
So now that you do have this governance model with the 21 members, what is the next step in terms of dialogue with these members?
So first, there's a board, and I was lucky enough to be voted in on the board yesterday with 4 other really remarkable people that I look forward to working with. And the board now has a search committee to find a managing director or head of the association that I'm not part of. And that's a big priority, finding the leadership team and really staffing up the association so that it can actually, take on all of this work on behalf of the 21 of us, and more to come. So that's one priority. Second priority is also welcoming new members, and we want more diversity. And I believe, again, I speak on behalf of my fellow members here, that we want more diversity and more representation of the people that we hope to serve. So organizations from all around the world and organizations that can help really solve the key problems that we want to solve. And by the way, if we have a chance, I do want to talk about the problems that we want to solve, because it's all great to talk about how hard change is, but there's a reason why this change is hard and it hasn't happened in 50 years, and that we're in such a sad state.
And David Marcus saying that he expects to have no issue filling up the remainder of the Libra Association. Keep in mind, they want to have 100 members by the time that they launch. But as part of our discussion, we also talked a little bit about some of the issues that they face in terms of trying to even get to its target launch date in the first half of 2020 next year. He said that they will not go forward without any sort of, without the proper regulatory approvals from the requisite regulators, both in the United States and also internationally. But for those that are interested, you can catch the whole in-depth interview on YahooFinance.com. Zach.
All right, Brian Chung from Washington, D.C., breaking it all down. Very fascinating interview. Thanks so much for bringing us that. Well, coming up, a new study comparing the financial results of companies led by male and female CEOs and CFOs. The author of the study will join us to break down the findings when Wi-Fi PM returns. Welcome back to Wi-Fi PM as we're checking the market action here. Still red across the board, although the Dow has pared its losses there, off by just 9 points right now. And the NASDAQ still leading the way lower. We'll see where things go as we approach 2 p.m. Eastern Time. Well, businesses with female executives are raking in Sirius Bank. A new study from S&P Global Market Intelligence finds the companies that appointed women into CEO and CFO positions generated a better stock price performance compared to the market average. In the 24 months after taking the position, female CEOs saw a 20% increase in stock price compared to male counterparts. CFOs saw a 6% increase in profitability and 8% larger stock returns. So joining us now to discuss this is the author of the study and senior director of quantamental research at S&P Global Market Intelligence, Daniel Sandberg. Daniel, thanks so much for joining us. Very interesting findings here today. The study also found more female CFOs are more profitable and generated excess profits of up to $1.8 trillion as of June 2019. So I guess this is all to say that the study puts to rest the ideas that women can't do it as well, if not better, than men can.
Zach, pleasure to be here joining you, representing the quantamental research team at S&P Global. Yes, this study had a number of interesting findings. We found a number of key performance metrics where female executives who have been appointed to office to date have outperformed their male peers.
So superior stock price performance, I mean, what's behind that? How are women getting it so right when they actually do have those senior executive positions?
Sure. So what we found in this study, besides the superior performance of these companies, we also took a deeper look by studying the biographies of the executives who have been appointed. And what we found was that there are common attributes amongst both men and women that are associated with outperformance. Female executives simply seem to have these attributes more frequently. And I think that one explanation that resonates would be that boards of directors may be more selective with their female appointments, which is justified by also the statistic that there are 19 male CEOs for every one female CEO.
Wow.
I think that higher level of selectivity basically translates to a higher bar for women to get into these positions.
So, Daniel, I love the campaign that S&P has launched since January, the hashtag #ChangePays. And as a woman who works in finance my entire career, I was actually, this is very relevant because I was just talking a couple of weeks ago with some female colleagues of mine that are very senior in their careers in finance, and we are definitely the minority in the financial sector alone. How can, in the financial sector and in others, how can firms better retain senior management and senior employees as they're going through different life changes, like having children, building out a family? Because that seems to be sort of where those senior leaders are leaving their industries.
Sure. Well, let me say this. I am representing one of our more academically rigorous, sort of quant-focused teams. So I'm going to pivot from the policy question that you've asked, and I'll just say that I think that using the data, the essential intelligence, and the analytics that are core competencies at S&P Global is the way that we can raise awareness and further the discussion around the gender disparity. And I think that that in and of itself is the way that we can make the most impact in this particular case.
And Daniel, you mentioned some of the attributes might be more present in the female candidates you've mentioned here. What kind of attributes are you specifically talking about that might actually result in better performance?
Sure. So it's interesting to try and narrow in on some of these specific attributes. I will mention a few. Technology and leadership seemed to stand out as individual attributes that really were associated with higher success. But it's worth mentioning that the analysis we used was based on artificial intelligence and natural language processing. Obviously, don't want to get into all the technicals here today, but suffice it to say we found some numerically and statistically significant results that support our conclusions.
All right, very interesting findings there, very important findings, no doubt. Daniel Sandberg, appreciate you taking the time for breaking that down. Also, thanks to you guys as well. Leanna Hawkins sticking around for the full hour. Very interesting insights on that one. Also just fun to have you back around, so thank you for coming back.
Thanks for having me again.
Sabeel Marcellus, thanks as always. Very good times. Very happy Wednesday. Let's check in with Scott Gamm on the floor of the New York Stock Exchange for more market action. Scott?
All right, Zach, thank you so much. I am joined now by Peter Tuchman. All right, so we had a big update yesterday, taking a little bit of a breather today. What do you make of the action?
All right, so look, yesterday's up was really kind of a, I think it was super powerful that JP Morgan, which was one of the companies that talked about the trouble with going forward, projecting guidance and earnings for the coming quarter, for last quarter, over the Chinese trade problem, coming through with really solid earnings was a sort of a vote of confidence for the market, right? And so I think that took the market higher. I think today, yes, it could be a pause. Yes, it could be consolidation. Retail numbers were disappointing. I think that's also as a function of the fact that we don't have anything to chomp our teeth into in the China story. Okay, and then we also, so you've seen the market within a range go up and down about 50, 80 points. So while it looks pretty drastic on the screen, it may be not that drastic, but we saw negative news on retail took it down, then it kind of lifted on, God only really knows. It sold off kind of hard, and then we talked about Fed balance sheet. Right, that they are going to be buying treasuries, but it is not QE. It feels like QE to me.
I want to talk about the retail numbers. A couple of things on that. One, obviously it was not good that they declined because we know that the consumer is kind of the last bastion of strength in this economy.
Correct.
But two, those numbers tend to be volatile anyway, so you can't just look at one report.
Right, and I kind of think that retail is one of those things. I was mentioning it earlier in the day that I was at Comic-Con last week at a toy show. And the largest toy makers in the world are in China. And they told me that Walmart had to yank so many of their really big orders coming for the holiday season because of the uncertainty about the tariff question. So Walmart, the largest retailer in the world, if they're doing that, yanking billions of dollars of orders because they really won't know what their costs will be for the coming season, that gave me the idea that maybe that's the only company that's having this problem, and that it'll probably fall over into the Targets and whatnot. We do have the Christmas season coming up around the corner. Retail should be actually inching its way higher, but this tariff thing is a big deal, and we still have no certainty on it.
All right.
That's crazy.
We'll see what happens. Peter Tuchman, thank you so much.
Back to you, Zach.
Back to you.
Coming up, Yahoo Finance's Akiko Fujita sits down with the finance minister of India. We'll have her new warning about how governments are responding to a global slowdown next. The ticker starts in 2.
afternoon and welcome to the ticker on Yahoo Finance. I'm Akiko Fujita. Checking the market action, we are seeing red arrows across the board. They're pretty flat action right now. The Dow is down 23, the S&P 500 down 8, and the Nasdaq down roughly 36. We did get weaker than expected retail sales numbers. That's offsetting a strong start to the earnings season. Let's get to our big three tickers. General Motors reaching a tentative deal to end the UAW union strike, but will workers get on board? Major drug distributors like McKesson are reportedly in talks for a huge settlement over opioid litigation. And Bank of America gives a healthy outlook for the economy in its latest earnings. But first, let's get to that news that developed just a few hours ago. General Motors there, the automaker reaching a tentative labor deal with the United Auto Workers Union. Now, that marks a critical step that could help end the 5-week-long strike. The UAW did release a statement in response saying the national negotiators elected by their local unions achieved major wins for members in the proposed tentative agreement. The negotiators voted to recommend the National Council accept the proposed tentative agreement as the agreement represents major gains for workers. Now, the number one priority of the national negotiation team has been to secure a strong and fair contract that our members deserve. Dan Howley has been following this story. And Dan, the union has said they're not going to be talking specifics until the actual vote happens. What more do we know, and what's the timeline right now?
So right now we have to wait for the actual rank and file members to vote. They're being advised to vote to approve this contract. And essentially, we're waiting for that. We're not going to hear many details. There could be things such as bonuses or raises for some employees. But really, the bulk of the negotiations here had to do with temporary workers and them being treated more like full-time workers, so getting the same kind of pay, getting the same kind of health care. The health care seems to be being kept intact, but again, we're not going to have any exact specifics until something is ratified by the actual union.
Yeah, Dan, higher wages and bonuses certainly was a part of the discussion. We're going to wait to see if the results or what actually came out of those negotiations that went on for 5 weeks now. But this vote is really far from certain when you think about what's been playing out with the UAW union. We, of course, have a corruption investigation that's going on that involves the president. How is that likely to affect the vote and how people perceive the union or these workers? Because that corruption scandal actually stemmed from the UAW leaders using the funds that were paid for by these very workers.
Yeah, it's your own dues going to someone's insanely over-the-top New Year's Eve party. We're talking well into the thousands and thousands of dollars. And that's really part of this discussion. Cristal bottles, things of that nature being purchased using union dues. So it'll really determine whether or not the actual rank and file workers will go along with this, because they may just see the heads of the union as too corrupt to be looking out for their own interests. Now, I think they've been on the picket line for quite some time. And frankly, this hasn't gotten the kind of national attention that it may have gotten in years past. And that could have to do with the fact that our news cycle is constantly changing. But this strike has been going on for quite some time. They might just want to get back to work.
Okay, we'll be watching that vote very closely. Thanks for that, Dan. We are also watching the pharma sector today. The Wall Street Journal is reporting 3 major drug makers, McKesson, AmerisourceBergen, and Cardinal Health, are all in talks to pay $18 billion to settle sweeping opioid lawsuits. This comes as Johnson & Johnson faces similar litigation. Yahoo Finance's Anjali Kamlani is with me here at the desk. Anjali, let's start with those 3 big names, though. What does this mean in terms of the thousands of lawsuits that are currently on the table in relation to the opioid crisis?
Yeah, so it actually means that they would go away for these 3 distributors. And the timing of it is actually what's really interesting about this, because today is jury selection day for this trial that is set to begin Monday. So we're talking very last minute coming to the table on this discussion, which is probably why we know about it right now versus the suspense. Similar to what has gone on with individually pharma companies, they've had sort of settlements with just independent suits in all of this, but they haven't been broad-based. The only one that we've seen this broad-based is Purdue Pharma, which is the maker of OxyContin, the original drug, and that was at $13 billion, including a bankruptcy settlement structure. So that's about where we're seeing is this 13 to 18 billion. Compare that to where it was originally supposed to be, which was 45 billion is what the AGs were all asking for. So it's really widespread. We're going to see how this all plays out.
And what does it mean for Johnson & Johnson? They have already settled 2 cases, as far as we know, one in Oklahoma, one in Ohio as well. Why aren't they part of this?
So the drug distributors are sort of a different level. They're playing differently in this whole argument, and the blame that they're getting is very different. So they can do this sort of global settlement. Why Johnson & Johnson or even Endo or Mallinckrodt, who also settled earlier for similar amounts to what J&J did. So J&J settled 2 cases for about 20.4 million, a case with 2 counties, and then Endo and Mallinckrodt also did somewhere between 10 and 30 million as well. So they are also facing the rest of the cases, and they have to do it, case by case, depending on how they feel about it. So it's a separate sort of issue.
Okay, so just separating the distributors from the also drug makers as well. All right, appreciate you walking us through this. Thanks so much for that. Let's also talk about Bank of America now. Shares are popping after the bank beat revenue estimates for the 3rd quarter. Management also reiterated guidance for 2019 as 3 of its 4 major divisions reported revenue gains. Dan Roberts is with me. And Dan, where does BofA see the most growth right now?
Yeah, I think the most encouraging thing to shareholders is the growth in consumer banking, so the retail area. And that arguably is a good sign for the economy, for Main Street, as we say, Main Street versus Wall Street. Now, as you mentioned, 3 of the 4 divisions' revenue went up. Now, BofA saw losses on its trading desk, its traditional Wall Street trading, and we saw with Goldman Sachs earnings the same losses. But obviously with Goldman, that company was especially hit by its Uber and WeWork backing, so that was tough for them. BofA doesn't have those same problems. And look, ever since Moynihan took over Bank of America, he's been all about cutting costs. That has gone very well for BofA. But yeah, we're showing on the screen right now the growth in global banking. That's another bright spot. But I think that, this week we talked about how healthcare earnings and bank earnings overall would be so important for taking the temperature of earnings season. And so very good overall for the markets to start off with these good JPM earnings and then good BofA earnings. And again, I really would highlight that consumer banking spike, arguably a positive sign.
And Dan, meanwhile, Warren Buffett's Berkshire Hathaway seeking permission from the Federal Reserve to boost its stake in BofA. What's the very latest there?
Yeah, I love this story. I think there's a lot here. You could sort of be a Buffett flag waver and say that this is a good sign for BofA and that this, if you're a shareholder, you should like this, whether or not the Fed approves this. And just to be clear on what the this is, as you mentioned, Berkshire wants to buy more shares of BofA. It is sort of that simple, but complicating things is a rule that it can't have more than a 10% stake. Nothing other than a bank itself can have a bigger than 10% stake in the bank. Now, Buffett has also promised that if they are allowed to go over that 10% stake, he would invest passively. That is, they wouldn't mess with management, they wouldn't be an activist investor. But on the other hand, I mentioned that if you don't believe in Buffett's recent track record, maybe you don't think this is such a good sign about BofA. Berkshire recently had a little bit of a black eye, or arguably a lot of bit of a black eye, because of Kraft Heinz. That was one of those Berkshire 3G Capital joints, and it didn't go very well at all. And in fact, Buffett and his investing partner, Charlie Munger, admitted on stage at the annual shareholder meeting, we were wrong about Kraft Heinz. We overvalued it, we overspent, we were wrong. And so, it's not necessarily a huge vote of confidence in BofA that Buffett wants more of it. And let's also mention that he wanted to do the same thing, ask the Fed for the same permission years ago to buy more than a 10% stake in Wells Fargo. And then he pulled back when Wells had its giant scandal. So not a guarantee that, the next few years will be good for BofA, but we know that Buffett likes banks. And overall, some analysts that we've talked to in the last few days believed that BofA's stock price hike this week wasn't just due to earnings, but actually that it went up a little due to that news that Buffett wants to buy more of it.
Okay, thanks so much for that, Dan. Well, there are increasing questions about China's promise to buy more U.S. agricultural products with that $40 to $50 billion range worth of farm products will be significantly more than China has ever spent in 1 year. The Wall Street Journal reports Beijing may use the farm goods as leverage to urge U.S. negotiators to roll back plans for new tariffs in December. But President Trump doubled down on China's reported commitment while speaking to reporters earlier today.
There have been some reports that China is not buying until the deal is signed. No, China started buying already from the farmers. It'll be anywhere from 40 to 50 billion, which is far more than anybody thought or expected. It's a great deal for the farmers. I think the farmers will come out, along with many other industries, something that's already taken effect, even though the deal won't be signed, probably until I meet with President Xi in Chile.
Joining us now is Anthony Soccaro. He is the Chief Financial President of Providence Financial. Anthony, it's kind of been all question marks since we saw that announcement from the White House on Friday. Now we're hearing that maybe the Chinese didn't actually see the same agreement or didn't actually understand it to be the same agreement that was announced on Friday. What do you make of this back and forth that has come out since?
Well, the key to the last clip that you just played with Trump is the fact that the agreement will be signed. It has not been signed as of yet. And there are so many questions about this agreement at this point. There's a lot of people that are doubting whether the agreement is something that's even realistic. I think the largest amount of ag goods that China has ever bought before is slightly over 20 billion. Trump's talking about 40 to 50 billion. So the numbers don't seem to add up. But Trump's a negotiator, and as a negotiator, or I should say, as an attorney, knowing a little about something about a negotiation, I'm wondering if he's put the level high so that, in fact, he can wind up lowering it later and still get what he wants, even though it's not that 40 or 50 billion. You don't start a negotiation at what you want to get. You start much higher, and I think that may be what's happening here.
You could argue that in any negotiation, there is an issue of trust as well. And as we've seen play out between these two countries and these two leaders, there is a lack of trust given the back and forth that has played out over more than a year. How do you think the market interprets the headlines that are coming out?
Well, I think the Chinese negotiation and the tariffs and everything else is a huge factor when it comes to the market. The reality is that trust, you're right, is absolutely critical, and the markets are just going to take it day by day. The markets like the fact that last week we came to a partial agreement. At least that's how they took it. I don't know that we came to any agreement at all. China wants to kick the can down the road. I think last week's negotiation and the fact that they haven't signed anything yet is actually a big win for China, for Xi Jinping. So I think the fact that the markets like that, Trump was able or willing to forego the tariffs this week, but in December, who knows what happens. If the tariffs are on, the markets probably aren't going to like it.
Meantime, we've got finance ministers as well as central bankers meeting over in Washington, D.C. for the IMF World Bank meeting. And on that front, we did hear from India's finance minister, Nirmala Sitharaman, who I spoke to yesterday. She warned about a repeat of the 2008 financial crisis in the face of a global economic slowdown. And I want to read to you what specifically she said, because I think it is quite telling. She said, I think the intensity is being felt across the board now. And she's talking about the slowdown. It's a lot more than how it felt in 2008. What probably is not available now that was available in 2008 was this greater sense of collectively everyone wanting to respond to it from their respective quarters. So essentially what she's saying here is, look, even if what played out in 2008 is being repeated, things could get much worse because all the governments are not aligned right now in terms of how to respond to that. What's your response?
Oh, I agree with her 100%. We've had a very strong economy globally for the last decade or so. If you look at Australia, they've had a hugely strong economy for the last 20 years or so, and now they're talking about negative interest rates. So I agree with her assessment. I agree that if we're not careful, we could have another 2008-like scenario. The governments are trying to be proactive, and I think they're doing a decent job. Even our own government lowered rates twice in the last 60 days, not because there's a reason to lower rates, not because they're trying to stimulate the economy, but because they're trying to be proactive and stave off any recession that's potentially coming. And a lot of the other governments are doing the same thing. So I like the proactiveness, but I think you can only push it off for so long. At some point in time, there's got to be a major correction. We just hope it's shallow and doesn't last too long.
Well, there's also questions about whether central banks as a whole, given the low rates, have enough levers to pull in the case of any kind of financial crisis. The Fed's latest Beige Book did come out a few moments ago, and it said the economy is expanding at a, quote, slight to modest pace since early September. What does this tell you about the health of the U.S. economy?
Well, the U.S. economy, it's no secret that it's been, a lot slower than we'd like to see it, right? The fact is that part of the reason why the Federal Reserve hasn't raised interest rates is because they can't get that darned inflation factor above 2%. I think there were only 2 quarters recently that actually went above that amount. So everything is plodding along. It is slowing down. And right now, part of my concern is that the U.S. economy, as a lot of my friends have said on various networks, it's really the cleanest dirty shirt in the laundry basket. There's really nowhere else to go. And I think that's why the U.S. economy is looking a little better than all the other economies. But at some point in time, I think that's not going to keep going. At some point in time, the economy is going to slow even more. And when the stock market realizes that, it's probably not going to be happy at that point.
Yeah, and on that front, we did get a growth outlook from the IMF yesterday. They cut it down given sort of the U.S.-China trade tensions as well. I'm wondering, when you talk about the overall slowdown that we're seeing, how much of that and the uncertainty can actually be removed by a phase 1 or phase 2 type deal between the U.S. and the Chinese?
I think that's a great question. And I think a lot of it can be removed momentarily by the deal or any deal that Trump puts into play. Trump holds the keys to the kingdom. He's got the cards in his hand. If the economy starts to falter and the stock market starts to falter, the reality is he can pull out his cards at that point and play them and get the economy to come back or get the stock market to come back. His entire election is going to be based on the economy, and he's going to control the economy between now and then. So you've got this battle, this balancing act of the slowdown in the global economy that's weighing down the market, or at least keeping it from growing as much as it could. But then that's balanced out by the presidential election year and the fact that Trump controls the cards. So I think that it all comes into play. I think this next year is going to be flat. I don't think we have a lot of upside potential. I don't think we have a lot of downside potential. But after the election, it's fair game. Who knows what's going to happen? I'm not excited about it, though.
Yeah, that points to the increasing mix that we see between economic policy and politics as well. Anthony Sakara, appreciate your time today.
Thank you, Akiko. Appreciate it.
Well, coming up is a surprise decline in retail sales, a warning sign for U.S. consumers. A top expert joins us to weigh in next. The co-creator of Facebook's Libra speaks with Yahoo Finance's Brian Cheung on whether the crypto project could present a systemic risk to the economy. Stay with us. Welcome back to the ticker. Let's check the markets with just over an hour and a half left to go in the trading day. The Dow has been pretty flat in the afternoon session. It is down just 8 points. The S&P 500 down 6 and the Nasdaq down 30. Let's get to Scott Gamm on the floor of the New York Stock Exchange. Scott.
Hey there. Yes, stocks taking a little bit of a breather, but we had a big up day yesterday, and that tends to happen when you have a big gain. You kind of go to the side, you have a sideways trade the next day. Remember last Friday we had a big up day, and then Monday we also took a breather. When it comes to the best performing Dow stocks today, you're looking at names like Johnson & Johnson, Boeing, and Goldman Sachs. Johnson & Johnson, by the way, was also up yesterday after reporting strong earnings. Your laggards in today's session are names like ExxonMobil, Microsoft, and United Health, which is giving back some of that big gain it saw yesterday when UNH reported strong earnings, which drove the stock up about 8% in one day just yesterday. And then we're also keeping an eye on shares of General Motors. That stock is up right now on reports that GM and the UAW have reached a tentative deal to end that strike that's been going on for the past month or so. And then we're also keeping an eye on shares of Sprint and T-Mobile on news that the FCC has formally green-lighted the merger of the two companies. Remember, the Department of Justice did the same thing a few months ago, but there are still more hurdles to close the deal because a consortium of state attorneys general are still suing to block the deal, so that remains an outstanding hurdle. We're not seeing much of a reaction in shares of Sprint or T-Mobile for that matter right now, Akiko.
Okay, thanks so much for that, Scott. Well, new economic data is showing signs of a shaky consumer. Retail sales dropped for the first time in 7 months in September, unexpectedly falling 0.3% last month. Analysts polled by Bloomberg had estimated a 0.3% increase. Joining us is Charcy Evers with Retail Trends. And Charcy, the retail sector, or we should say that the consumer, has kind of been the key support for the economy as a whole. Right. What do the numbers today suggest in terms of how that is faring right now?
I have to say that I'm not surprised, to be honest, and I think it's a course correction that has been coming for a while. I think it's an indication of a consumer class that is dwindling, and that is the middle class. And you see that in the number of store closings that we have seen, especially in the apparel sector. Anytime you have a record number of stores closing on that level, it signals a shift in the whole economy, and I think that that's what's happening now.
What's the shift that we're seeing?
That the middle class is dwindling, that the consumer itself has less spending power, more debt, and is more concerned and just a little bit uncertain. So I think that also in the apparel sector specifically, it's overstored, it's gotten hit by e-commerce, trends are shifting, there's not a lot of newness out there. So I think that sector in particular is really being hit hard.
You said one of the surprises that you've seen is just sort of the resale outlets here. So we're talking about companies like The RealReal who've really benefited as a result of what's playing out. Who's been on the losing end of that? How do you describe this overall trend?
Well, I think that the middle tier, again, these stores like the Sears, the JCPenney's, because the two sectors that are doing well are the luxury market and then the big box stores and dollar stores and things like that. So those two ends of the market. It's the middle market that's really suffering. And why am I going to go out and buy something if I can rent something of higher value at a lesser cost? And then also in the name of recycling and sustainability, which is a very big sentiment, especially with millennials and Gen Z, there's the element of that too. It's a big trend.
So let me pick up on that point, because I wonder, when I see that kind of trend shift, how much of this is about companies not being able to keep up with the changing demands? How much of it is the mindset of the consumer? And when you talk about the consumer, how much of it is just trying to hold back and maybe save a bit more because they're not so confident in what's happening in the economy? How much of it is about sustainability?
Well, I think it's a perfect storm of all of the above, really. Sustainability is a big factor and will be a big factor going forward. I keep saying that if you do not have something in place and implemented a sustainable program of some sort, whether it's partnering with someone like RealReal, like Burberry just recently has, or a ThredUp, like some of the bigger retailers have done, then you don't have a future in terms of certain consumers, in terms of the Gen Z and millennials that are really, really pushing it. I think, again, also going to resale and having the ability to buy something but then also give it back or turn it in and to get credit towards the next purchase, it's kind of like the thrill of fast fashion and that immediacy, but without the guilt and without all the product.
How does the tariff impact play into all of this? When you look to September, that's when we saw the latest round of tariffs kick in that did hit footwear and apparel. What have we seen on that front?
Well, I think that we haven't seen the worst of it.
yet. And I think that with this consumer sentiment report coming out, that it's just more of an indication of where things are going. And I think we'll see, because there is so much uncertainty, that it will have a bigger effect and impact going forward. It'll be interesting to see what happens. Going into December, it's the holiday season. We're either going to, the consumer and retailers are either going to, buckle down and double up on everything, or, hold back a little bit. And I think that, if it's looming, it's still that uncertainty. And if you're questioning something, that's what's going to hold you back.
So that doesn't sound like you see a huge holiday season. I mean, if things are still uncertain, what consumers
I'm
are
being
just gonna
hopeful.
hold back.
I'm being hopeful for, like I said, that everyone's going to get all their numbers in or their shopping done before December 15th. But if China decides to retaliate after something is implemented, then it's going to have a really big impact on the holiday season. But I like to still be hopeful.
I want to go back to the original point, though, because, we look at these retail sales numbers. They do often fluctuate from month to month.
Right.
Sometimes there are seasonal factors that come into play.
Of course.
But the big question, as you point out, has been about the confidence of the consumer. We keep hearing from those who are quite bullish who say they're still shopping out there, regardless of where the headlines are going on trade.
Right.
Can we point to these numbers to say that confidence is starting to crack?
No, because it's just a matter of where they're going to shop. The confidence is still there. It has nothing to do with the confidence. It's a matter of where they're shopping. And when you look at Ross Stores rolling out 100 stores, and then a JCPenney's or another retailer closing all their stores, they're going somewhere. And also the luxury market is doing really well. So the confidence is there. It's just a matter of who the customer is, where they're going, and what's to be seen ahead.
Okay,
and the uncertainty.
Okay, Charcy Evers, always good to have you on.
Thank you.
Coming up, could Facebook's planned cryptocurrency pose a systemic risk to the financial system? The co-founder of its Libra project speaks with Yahoo Finance's Brian Chung next. Plus, the CEO of SoftBank-backed OneWeb joins us on how he plans to beat out Elon Musk and Jeff Bezos in the space race. Don't go away. Welcome back to The Ticker. I'm Akiko Fujita. Let's give you a quick recap of the tickers we've covered in the show today. Our first ticker, General Motors. The car makers reached a tentative deal with the UAW union to end a months-long strike. The proposed contract still needs to be ratified by workers before the strike can end, and details of that agreement have yet to be released. We also looked at major drug distributors McKesson, AmerisourceBergen, and Cardinal Health. They are in talks to settle ongoing opioid litigation for $18 billion, according to the Wall Street Journal. Johnson & Johnson would also reportedly contribute additional money. Also in focus, Bank of America. It's on the rise after reporting better than expected results in its latest quarter, with notable strength in its retail banking division. Now let's check the closing price of oil in what has otherwise been a pretty flat trading day. Now we are seeing crude up 1% there, 53.42 a barrel is what we are looking at. This comes as energy stocks are sinking faster than crude oil prices. New analysis from the Wall Street Journal finds many investors are ditching their shares after years of disappointment. Let's get to our next group of tickers. The co-founder of Facebook's Libra crypto project is speaking out about its potential systemic risks. Investors are eagerly awaiting Netflix's latest earnings, set for release after the bell. And casino giant MGM Resorts announces 2 major billion-dollar deals. But first to Facebook. The platform is struggling with its cryptocurrency Libra as backers withdraw from the association. Yahoo Finance's Brian Chung sat down with the co-founder of Libra last night and joins me now from Washington, D.C. to discuss. Brian.
Hi, Kiko. So we're here at the International Monetary Fund annual meeting here in Washington, D.C. David Marcus, again, the head of the Calibra project, that is the cryptocurrency blockchain network that Facebook is developing right now, has been doing the rounds and meeting with international regulators and also central bankers to talk about next steps for the project. But I asked him, amid all the regulatory questions and broader concerns about Facebook, about whether or not they can still hit their target timeline for launch of the first half of next year. Here's what he had to say.
Well, so this is something that I want to talk about a bit, because I think it's really helpful, and this is something that I've used all of my life as an entrepreneur and building products. It's always good to have an ambitious timeline that becomes like an external forcing function for everyone. So the goal is still 2020, but again, I want to reiterate, and I believe that all my fellow members have, agree with that, and the Libra Association agrees with that, no one wants to move forward with this unless it receives the proper regulatory approval and that we've addressed all legitimate concerns from key stakeholders around the world. So we have a lot of work to do, and we want to do this the right way. And we've wanted to do this the right way from the beginning. That's why we announced it so early, and we spent a lot of time pre-briefing a lot of key stakeholders and regulators around the world before we made the announcement, and have continued doing that. And now, since yesterday, finally, we're going to be able to engage on behalf of everyone with one association that will continue getting stronger and have the appropriate staff to do all of this work.
Well, as you mentioned, it's not easy though. So
big change is never easy, but it's worth it.
So David Marcus saying right there that the 2020 deadline is an ambitious goal for him. One of the reasons why that is ambitious is because there's so many regulatory issues with Libra, one of them being whether or not it could be systemic. Consider that the Facebook platform has over 2.7 or about 2.7 billion users, 90 million businesses use it for commerce. So there's some worry, especially voiced by the Federal Reserve, that this could be of systemic risk. David Marcus saying for Libra's part that they hope to design it in such a way where it never gets systemic. So Akiko, a lot to watch out for there.
Yeah, Brian, what's interesting, David Marcus there is also kind of repeating what we heard from Mark Zuckerberg in the leaked audio that came out from the meeting, or internal meeting, where they essentially said, look, we wanted to release it early to get the, to kind of get the feedback and see where things are going. But I'm wondering if the backlash that they have received since has really gone beyond what they had initially anticipated.
Yeah, well, the question really is about what types of discussions he's having with regulators behind closed doors. Keep in mind that he's been trying to do the rounds as they've gotten further on this project and trying to get the proper regulatory approval. And he said they won't launch until they have that regulatory approval. But what we don't know is to what extent regulators have required them to put certain measures in place or show the types of compliance that they'll be able to have as part of their system before they launch. Keep in mind that as far as right now, Libra is still just a concept. It's not anything that's been put into practice for right now. And David Marcus was telling me that at the end of the day, they feel like they have an obligation to create this technology because of the fact that the commerce platform is so large that they feel like their scale actually makes them obligated to create this sort of technology. So interesting to see David Marcus kind of double down despite the concerns that we've not only seen from regulators, but from even those within the Libra project, because Visa, MasterCard, and PayPal, some of the big names that have since dropped from the project. But David Marcus saying our game plan is still to get to 100 members by the time they launch, whenever that ends up being. And they said that they already have a queue of about 180 members that have already received preliminary approval for membership. So he said that it shouldn't be a problem at all replacing them.
Okay, hasn't shaken their confidence at least yet. Thanks so much for that, Brian. Well, let's move on to our fifth ticker of the day, and that is Netflix. A streaming giant will report earnings after the bell today, as rivals Apple and Disney are about to jump into the streaming space. Dan Halley is back with me. So, Dan, the positive is that we're looking at a quarter where they didn't have significant price hikes, which kind of weighed on the previous quarter. The negative is just what we said. This is the last quarter before Disney as well as Apple jumps into the fray. What are we expecting to hear?
So what we want to hear is that they added plenty of new users. Internationally, you're not really going to see a lot of users come and go in the U.S. because it's already such a saturated market for them. But internationally is really where you want to see that growth, and that's the most important. That's been the most important factor for the company going back a few quarters now. One of the issues that they've had, that they haven't had, as you said, is the addition, the price hikes. What they did have, though, is additional content that was really sticky. So you had the new season of Stranger Things come out. You've had the new Breaking Bad movie come out more recently. You've had these different shows that are really the type that people talk about and want to get Netflix because of. Now, I think that Wall Street is overblowing the fear of Netflix being hurt by the likes of Apple specifically, and that's only because Apple, yes, starts at $4.99. It's a compelling option.
They don't have a lot of content.
Where's that content? Exactly. They are really banking right now on the price, and so far what we've seen is the morning show and a few other tidbits of what they have to offer. But if you're going to be sitting down and using a service to replace your TV, and that's where we are now, these services are supposed to replace our cable subscriptions. Netflix has that beat because they have that huge amount of content. Apple, frankly, doesn't. Now, Disney Plus, on the other hand, has the entire Disney backlog, plus whatever Fox has, plus whatever Marvel has. Star Wars is in there. You can binge, however many seasons of The Simpsons there are now, all for that $4.99. So I think, Disney is really the existential threat to Netflix, not necessarily Apple at this point.
You talk about the declines that we've seen in Netflix's stock since the previous earnings report. One of the things that really weighed on it was the fact that they actually lost subscription.
Right.
They lost users in the U.S. for the first time. What happens if that happens again in this quarter?
I think then that's when you really start to see the stock tank, because that's something that people are, it's kind of taken as a given that they're not going to lose as many subscribers in the U.S. and they're not going to add any in the U.S. And I think, kind of anecdotally, after Apple announced their new service, I was speaking with someone and they said, I'm going to drop Netflix now. I don't know what Apple has to offer, but it's only $4.99 a month, so why wouldn't I go with that? And to that I say, you don't know what you're paying for at this point still, but it's something that consumers might really be thinking about, saying, well, I'm on the $11.99 plan, I'm on the $14.99 plan or something along those lines. Why am I going to pay that when I can get a streaming service out of Apple? I don't necessarily think that's the way to go. But remember, Apple, right out of the box, if you buy a device, you're getting Apple TV Plus for free for a year. And that's really, I think, the threat that they pose. Not necessarily the pricing right away, but the fact that people can jump onto the service for free, and then they might stick around afterwards as they continue to add more shows. Disney Plus right out of the gate is going to be fantastic, though.
Yeah, and that seems to point to additional content that's going to have to churned out by any one of these streaming services, because as we know, they can sign up and then just as quickly sign off as well. Yahoo Finance's Andy Sorwer did speak with television writer and producer David Simon about Netflix's content push. Take a listen.
They're flooding the market with content, and I don't understand the model. But that's not a rap on them. I don't understand the model. A long time ago, I went into journalism and I was a police reporter from Baltimore. So that I don't understand a mass communications model in the digital age is no great insult to anybody. But I don't know the revenue stream and how you get people to watch your content overall and where the money comes from eludes me. And in some respects, it's not just Netflix, it does in every sense. I mean, I understood cable bundling. When I get to HBO, that seemed to be the lion's share of what they're doing. Now everyone's got their own platform, and how you pull people to that platform is either library or buzz or having a hit. And in some respects, Netflix is trying to do, I think, really rely on the library model. And maybe they're right, but it seems like it's an incredible amount of production in terms of money. I'm astounded by how much they're spending on content.
So I guess, Dan, the takeaway from that is that David Simon's not necessarily pitching to Netflix anytime soon.
He also doesn't understand how it works, apparently. That's obvious now, too. I mean, they rely on subscriptions. That's how they make their money. And yes, they spend billions. They burn cash like nobody's business. But they do put out these shows that are sticky. And when you talk about streaming, you don't talk about, oh, I'm going to put on Hulu. Oh, I'm going to put on this, that, the other thing. You say, I'm going to watch Netflix. There's a reason why Netflix has become a verb now. Want to watch Netflix, want to go, well, maybe not a verb, but it's the go-to for streaming is what I'm saying. And I think that's going to continue to be the case. Yes, they might not see their growth as insane as it has been because of Disney and because of Apple, but this is by no means the death knell for Netflix. It will continue to be around.
Okay, we'll be watching when those numbers come out after the bell. Thanks so much for that, Dan. Well, our sixth ticker of the day is MGM Resorts. The company has signed a deal to sell its Circus Las Vegas property for $825 million. Separately, Blackstone and MGM agreed to form a joint venture to acquire Bellagio real estate in a deal worth $4.25 billion. Dan Roberts is back with me. Dan, what's the strategy for MGM?
Cut costs and also move away from its traditional brick and mortar casino business. I think this is kind of the beginning of the end of that. That's what you're seeing. And in fact, MGM CEO Jim Murren said in this announcement, and I think this is kind of the key to the whole story, that sports betting, for example, is a better use of our capital resources now than traditional gaming. So that kind of tells you everything. A, sports betting, both in the US and then in Japan. And then B, changing up the model, more partnerships and deals like that. So look at the state-by-state tide of sports betting legalization right now. Okay, it's moving slowly, but if you use one state as an example, the first state to do it, New Jersey, in May, a big milestone hit. Revenue from legal sports betting in New Jersey was higher than the revenue from legal sports bets placed in the state of Nevada. Now, that was just in the month of May. But people saw that as hugely symbolic and a sign of where things are headed. So if you're MGM, you don't want to be saying what some of its competitors sort of seem to be implying, which is, well, we're fine. We're here in Nevada. We own the space. We've got brick and mortar casinos. Everyone will always come to us. Instead, you want to start getting into mobile betting all over the U.S. in states where it's legal and making more of those deals with leagues as well. MGM has now signed deals with the NBA, Major League Baseball, and NHL, and more are to come.
Let me go back to the original point you talked about, though, in terms of cutting costs for MGM, because part of this is also preemptive, right? I mean, the company is looking at, in the case of a potential downturn, they want to make sure they have enough reserves as well. I'm wondering, as a shareholder, should that be a concern?
Well, I think there's two ways to look at it. You could be concerned that it's selling off some of its key properties. Circus, that's fine. That was kind of the cheaper option on the Strip. But Bellagio, a major sort of gem in the portfolio. So it is, I think it's a major shift in strategy. Now, of course, I think you mentioned this, but MGM is still going to be managing the Bellagio, but we'll have a 5% stake in this joint venture. So you could be concerned, or at least bracing for a major shift. But you could see this as a good sign that MGM is branching out into new businesses and is trying to skate to where the puck will be, not just where it already is. And again, I really think a lot of this is about sports betting and trying to get ahead with that.
Okay, and we know you follow that very closely. Thanks so much for that, Dan. Well, let's shift our attention now to the space race, because it is really taking off, with one company rivaling Elon Musk's SpaceX and Jeff Bezos' Blue Origin. OneWeb is installing thousands of washing machine-sized satellites in low Earth orbit to bring high-speed internet to all corners of the world. It's even in remote areas like the Arctic. Joining us is Adrian Steckel. He is the CEO of OneWeb. Adrian, welcome.
Thank you very much.
Yeah, let's kind of backtrack here to talk about the business model, because you're always going to get the questions about SpaceX, Elon Musk, and Jeff Bezos. How do you compete? You've talked about the scale that you've got, able to produce 2 satellites a day. Can you walk me through your value proposition?
Well, so our value proposition is that people need internet like nobody's business. I mean, it used to be a luxury item. People need it. We've seen that over the last 20 years. It used to be something that just a certain elite had, and now everybody has it. And if you aren't connected to the internet as a child, you're at a huge disadvantage. There are about 3.8 billion people that don't have access to broadband internet. And there's a great necessity for that. And so what we're doing is we're putting up internet everywhere to through low Earth orbit satellites. And so the quality of that internet is going to be the same in Africa, Latin America, Asia, or in rural America. And so you will have internet everywhere.
A lot of these areas that you are trying to address that don't have internet right now are areas that are rural, but also a lot of developing countries as well. How do you make this a cost-effective solution?
Well, what you have to go back and say is we're going to be giving internet everywhere, North Pole, Latin America, everywhere. And so there's some portion of this where there is high margin businesses in the developed world, which is subsidizing service in the developing world. So we'll be concentrating on aviation, maritime, everything on the go services for governments and for schools. And that helps us to pay for rural broadband in Africa, the United States, everywhere else.
How does your partnership with Airbus allow you to have a leg up?
Well, we got a huge reaction from people when they saw our factory at Cape Canaveral. It's right across the street from Blue Origin. And people really focus on launching satellites, but the game of doing this is really complicated. The ground game is complicated. And the satellite production at scale. So it used to be that a GEO satellite would cost $250 million. We've gotten those costs down to $1 million, and that's going lower. Launch costs are also coming down. But people, when they saw that factory, they could see how it's roboticized, how we can produce several satellites a day. And it's really changing the entire supply chain of the industry. It's not the same as go to a supplier and say, oh, I want 5 or 10 of that over a period of 18 months, and saying, no, I want 650 or 1,000 of those.
Walk me through some of your markers now. What is the goal in terms of the number of satellites, and what does the timeline look like?
Well, so we sort of broke it down into 2 phases, and there'll be more phases after that. This is a long game. The first phase is global coverage. So like a mobile carrier, you want to give coverage everywhere, and that coverage is very expensive. And so that implies building out ground stations, and that implies 650 of our phase 1 satellites. Then after that, we will be putting in what we'd call our second phase, which will be roughly about 400 satellites or so, which will give more capacity where we have hotspots. But we have filings at the ITU for thousands of satellites, up to 6,000 satellites. And then we're also bringing to use other bands. And so we'll be able to pump in a lot of capacity. It's a scale game. It's a scale game for SpaceX, for us, for Amazon. And to the extent that you have greater scale, the cost of the bandwidth goes down and of the devices goes down.
As we see the competition increase, that only leads me to think, well, it's got to be getting a lot more crowded up in space. And there are concerns about collisions between the satellites. What are the conversations that are happening between governments, conversations you're having to ensure that space debris doesn't get any more larger than what we're already seeing right now?
So as a startup, you'd think that we would not want to be regulated. I mean, that's sort of anathema. You want to push the limits and do everything you can, but it's a shared resource. And I think that in the greater context, if you look at companies in general, you need regulation, because there really isn't a cop up there. There's not somebody who's going to say, hey, you need to have everybody applying the same rules. And those are nation states, so the US, the UK, and other launch countries have to really regulate this. And typically what happens is everybody cries for, oh, why didn't we regulate after there's a problem? And if you think about this in sort of very simple terms, if you and I to get in a car accident on the corner of 8th and Broadway, we'd walk away from the car, the tow truck would show up and tow them away. In the case of space, where our satellite's going 16,800 miles an hour, which is you can't really grok that, and somebody else's is going at that speed, they're going to shatter, and they're going to spoil that space for everybody. And so it's a shared resource we have to care for. We have shown, in general, without regulation, that we have a great capacity for spoiling resources.
But are you confident in those conversations that are happening among regulators?
I don't think that those conversations are really occurring right now. I think that there's the opportunity for it, and it's something that we think that my policy folks said, hey, we don't want to be regulated. But I think at the end of the day, everybody needs sort of fair rules and understanding that everybody plays by the rules to preserve that. Because it's not that I spoil it for myself, I spoil it for everybody.
Okay, Adrian Steckel, good to have you on today.
Thank you very much.
Coming up, Yahoo Finance's Dan Halley pits Google's new Pixel 4 against the iPhone 11 in a picture face-off. Who wins the day? He's got the answer next. It is now time for our ETF report brought to you by Invesco QQQ. Today we are watching ProShares S&P 500 Dividend Aristocrats ETF. More than half of S&P 500 companies now yield more than U.S. 10-year treasuries, making them a more attractive bond alternative to some investors, according to our next guest. Joining us is Todd Rosenbluth. He is the head of ETF and mutual fund research at CFRA. So, Todd, walk me through the case for some of these ETFs.
Yeah, so we've got much more volatility in the broader marketplace. Investors are more nervous than they've been, despite the fact that the S&P 500 is up more than 20% this year. So you can get the benefits of diversification with a dividend-oriented ETF. NOBL, which is the ProShares product that we showed earlier, and a few other dividend-oriented ETFs, focus on companies that have raised a dividend for a consecutive period of time, 10, 20, 25 years. NOBL is 25 years. Companies that have raised a dividend for 20 or 25 years certainly have the earnings growth and the stability that investors will want to have, but the diversification, so you get lots of the different sectors that are in there at a very low cost structure.
What kind of returns are we talking about?
So it depends upon which ETF we're talking about, and that devil is often in the details. So some of the dividend growth-oriented ETFs are up close to the broader market this year. NOBL and SDY are the two that we at CFRA were highlighting within our research piece this week. And there's about a couple hundred basis point difference between them, whereas a third ETF, LEAD, is the ticker. It's a reality shares product. It's a smaller product that's more growth-oriented with more technology exposure, is actually outperforming the S&P 500. It's up 22, 23% this year. So it really matters what ETF you end up buying.
What are you finding in terms of how, investor behavior? I mean, we talk a lot about how to hedge against volatility. Is that moving people more into ETFs? In other words, as they see some of their stocks fluctuate, is the idea maybe to go into more of a broad-based fund instead of going for individual stock picks? Have you seen that?
We are seeing that. So our clients at CFRA are increasingly using ETFs and are working with us, of course, to be able to sort through that universe of products that are out there. So instead of buying an individual stock, and then you obviously have the risk of a dividend cut, which has happened increasingly in the third quarter. More dividend cuts took place than in the prior year. The benefits of diversification. We're also seeing it in more the thematic-oriented investing. So instead of buying an individual cybersecurity company, you're buying a cybersecurity ETF and getting more of a broader landscape. Or video gaming, you get the broader diversification that you would have with certain ETFs.
And where are you seeing the most fund flows right now?
Well, fixed income has been dominating, which is a surprise in 2019. It's been 10 years since we saw more money go into fixed income ETFs on a calendar year basis than equity ETFs. I think that's a sign of investors being nervous about the broader market.
It's just the risk-off sentiment that we've seen as a whole.
It is in general, but we are seeing investors be willing to take on risk, either with interest rate risk, with a product like IEF, which is an iShares longer-term treasury product, or with a product like JNK, which is a SPDR high-yield bond ETF, or HYG, which is an iShares product that's there. So investors are willing to take on risk with fixed income, which is, of course, lower risk than you'd get in the equity markets.
Okay, Todd, always good to talk to you. Thanks so much for joining us.
Thanks.
Let's give you a quick recap of the tickers we've covered in the show today. Our first ticker was General Motors. It has reached a tentative deal to end a month-long strike by the UAW union. The agreement still needs to be ratified by workers. Also in focus, major drug makers McKesson, AmerisourceBergen, and Cardinal Health. They are in talks to settle ongoing opioid litigation for $18 billion, according to the Wall Street Journal. Johnson & Johnson would also reportedly contribute additional funds. And it's our last tick of the day. That is Alphabet. The tech giant just released its new Pixel 4 phone. Yahoo Finance's Dan Roberts and Dan Howley are back to weigh in. Dan Howley, let's start with you because you have both of the devices in your hand right now. You were just out kind of walking around the city to compare the two. What did you find?
I do have both devices. You can kind of see them right here. They're very cool, sweet looking phones. I found that between the two, I would say that it's tough. It's very tough to determine which one is actually better as far as the cameras go. But low light, honestly, turns out to be a bit ahead on the Pixel phone, and that's because Google does a lot of software work behind the scenes. You can see the Pixel 4 down on the bottom and the iPhone 11, the difference in the coloring of the low light photos. And then outside of
They're
that,
still both really good.
oh yeah, I mean,
for
this
a
isn't
low-light
like
photo.
yeah, this isn't like back in the day where it was you got garbage and you got greatness. It's basically greatness on both levels. There's also a photo that I took of a yellow flower. Now, I'm looking at both of them. The flower in the Pixel version looked really clean and crisp. The colors were fantastic. And again, on the iPhone, you got the same kind of color and contrast. The details were a little bit sharper. But Google also adds a feature that allows you to adjust the brightness and darkness in an image at the same time. With Apple, you can only change the white balance. You could see here when you're messing around with the settings, I managed to make the flower look a lot better on the Pixel than I did on the iPhone. So there's really a lot going on here between the two devices. I also just wanted to point out the selfie camera on both. The selfie camera on the iPhone seems to be better than it does on the Pixel. You can see I look normal on the iPhone 11. On the Pixel, I look kind of weird. Well, in general I do, but my coloring on the Pixel is a little bit off. So I would go with the iPhone 11 for the
Yeah, it seems a lot brighter on the iPhone 11 there. You look good in both, Dan. Dan Roberts, you heard the review here. Does that make you want to switch?
I've always been tempted to switch to something other than iPhone, and recently, thanks to Howley's reviews of the Pixel, I'm tempted to switch to Pixel, but I doubt it'll happen. I'm too afraid to leave the Apple ecosystem, and that, I think, is the problem for a lot of people. They don't want green text messages.
Okay. I certainly don't want green text messages because they add up to the bill, right? All right, thanks so much, guys. Coming up, Netflix's highly anticipated earnings set for release after the bell. The final round has it all covered next.
Hello, everyone. I'm Jen Rogers in New York, and this is the final round. Wall Street wavering as retail sales unexpectedly fall in September.
And I'm Miles Upton. This is stocks. Mixed market today, but we do have strong bank earnings headline by Bank of America. We'll have more on that and all the market action coming up in just a bit.
Plus, get ready for Netflix earnings. We're going to have all the numbers for you as they break after the bell. And Facebook's head of Calibra says Libra is not in jeopardy. We're going to have more from Brian Chung's big interview coming up. Plus, the debate over drug prices heating up. A former Pfizer insider joins us with her take. Let's take a look right now at where stocks are in this market. Not a whole lot of anything going on here that you're going to be wanting to write home about. All right, I'm going to give you something.
Sure.
S&P holding 2990. Yeah, that's pretty good.
You know what else is happening underneath the surface today? Good old-fashioned rotation.
I
think we have the BORPs available for our perusal here, because this is not a pretty picture when you look at what's happening in some of the software names today. It's kind of a continued story that we've seen all year. I mean, Okta down 7% today. Zoom is down 5% today. Great job by Beyond Meat being the outlier there,
holding it together.
But we continue to see, relative to their 52-week highs, kind of this whole group, this SaaS group, whatever you want to call it, names off 30, 40%. Slack's down 44% from its recent high. PagerDuty, which is only down about 2% today, is off 55% from its 52-week high. And so the market's had a great year, but there is still a lot of pain out there if you go looking for it.
So we're watching that rotation. Let's bring in Andy Serwer, Yahoo Finance editor-in-chief. What have you been looking at today? Another thing that I think has caught both of our attention, everybody on Wall Street's financials.
Yes, that's where I
Bank
was
of
going.
America, is that where you were going?
That's where I was going.
I guess we're back at.
Ticker is BAC, and Brian Moynihan's little institution, and that's what I was looking at. And part of the story, not surprisingly, is the consumer, and it's not going to shock anybody out there, especially people who watch this little show here, that is the U.S. consumer, and that bank is a big player there, and they benefited from that. Not as much as I thought. But it's kind of a mixed picture, generally positive. Brian Moynihan is a smart guy, has done a pretty good job running that bank and sort of pushed the right buttons. The trading revenue was in a good place. Part of it not. It gets a little bit complicated once you start to dive into it. But, generally, though, I think it's a positive sign for this sector. And, why buy Okta when it's down 8% when BAC is up 3% today?
BAC right now, the best performer in the XLF. The XLF actually just kind of treading water here, but Bank of America is holding on to some pretty good gains. We've also got U.S. Bancorp and Bank of New York, BNY Mellon up 1%, Everest, and Goldman Sachs almost up 1% as well. Is there anything in the financial news that's not as rosy? I guess, in terms of the outlook from these companies? I mean, I know a lot of people took away what Jamie Dimon said about a recession coming. Of course, nobody knows when. What about from Bank of America?
No, I mean, I think the strange thing about Bank of America is that when you look at what Goldman and JP Morgan told you about the actual business of Wall Street, their equity markets group, and all the banks define it slightly differently, but essentially investment banking, working with corporate clients, doing financial engineering for them. We all know that's a struggling business. That business has been under pressure for some time. I think even though it's tangential to it, you see the fees to zero on trading stocks. On the corporate side, right, that means the fees that a JP Morgan or a Bank of America can earn by executing a share buyback, those are also coming down, right? All of that value is coming down. Bank of America, of course, the outlier here, right? Up 13% in the last quarter in their equity group. And I think that's interesting only because Bank of America is seen as a consumer mostly. Merrill Lynch is in there, but people don't really think about that brand alongside a Morgan or a Goldman or even a JP. And so we'll get Morgan Stanley results tomorrow, but I think for Bank of America specifically, a strong quarter there. But I don't think the banking sector has told you anything negative about the macro economy. Of course, the business of banking still remains under pressure.
Yeah, I agree with that. Between rates and investment banking and the world of private capital sucking the oxygen out of the room, those are 2, 3 really big trends, and I haven't even said China.
That's right.
So it's hard to see, be so constructive on that sector going forward, I think. But the good management could prove me wrong. You got like 2 good examples of that, at least.
Yeah, I mean, I guess sort of the other way to answer the question is, from our perspective outside the financial sector, nothing in there says we need to worry about a downturn broadly, right? They didn't tell us anything we didn't know, but what we do know is, to your point, Andy, that is a challenged sector, I think, secularly, looking over the next couple of decades. For more of today's market action, let's go to Scott Gamm. He's live on the floor of the New York Stock Exchange. Scott, talking a little bit about the rotation into value today. One of those value names we know everyone loves is General Motors, announcing a tentative labor deal with the United Auto Workers. What's the story there?
Yeah, that's right. This tentative deal, if it gets approved, and it may take a few weeks for it to get approved, could end the strike that has been going on for about 50,000 GM workers. And that strike started a month ago today. GM shares are up on this news. The stock is up about 2% right now, and it's back trading near the levels it was at prior to the start of this strike. GM had a little bit of a dip a few weeks ago. But we should also point to the economic impact of all of this, because we know that the reference point for the government's monthly jobs report just passed a few days ago. So it'll be interesting to see if there is any weakness in the October jobs report from this strike, and we won't get those numbers till early November. But if there is some weakness, I just hope the recession people don't come out and misinterpret that weakness, because it would likely just be a one-off item. But nonetheless, GM shares are up today. And then, Miles, we're also keeping an eye on the telecom sector, watching shares of T-Mobile and Sprint on news that the FCC has green-lighted the merger. We know the Department of Justice did the same thing a few months ago, but there are still hurdles to the closure of this deal. That's because we know a consortium of state attorneys general are still suing to block the deal. That has not been resolved, and so you're not seeing much of a reaction today in either shares of T-Mobile or Sprint on this FCC news. Miles.
All right, Scott Gamm, live on the floor of the New York Stock Exchange.
Facebook's Libra has been dominating the headlines after a slew of big-name companies left the deal, including MasterCard, Visa, and PayPal. Yahoo Finance's Brian Chung sat down with Libra's co-creator, David Marcus. So, Brian, is David surprised about how this has all been playing out recently?
Well, surprised, I mean, maybe. He did have that tweet saying that he's disappointed that those companies decided to leave, but said that it actually offers a little bit of relief for him to move forward on this project. He was saying that he respects their decision to leave, but one interesting question was trying to figure out exactly why they left and maybe the conversations before they did. I asked him about whether or not he agreed with Treasury Secretary Steven Mnuchin's assumption that maybe they left because of the regulatory pressures, and here's what David Marcus had to say.
Well, I can't speak for them, but what I can say is my understanding as of now, and again, I can't speak for the Libra Association anymore since yesterday, but from my own vantage point, I don't believe this has anything to do with it. I think that on the regulatory front, we do have some legitimate concerns that have been voiced, and we need to address these concerns. That's what we've been working on, and we're continuing to work on. But since yesterday only, can we do that as a group, as an association? And so, you know, there's nothing that's operating right now. This is a project. It's an idea. It's a white paper.
Still a white paper, yeah.
And so it is normal because it's normal that we have not addressed everything because this has not been done before. And so we have to work with everyone. And that was the idea from the get-go, to actually announce way before we launched so that we had an opportunity to hear all of the concerns and then as a group, as an association, work together in addressing these concerns. And we've said it multiple times that, you know, from our vantage point, we don't want to launch this unless it has the appropriate regulatory coverage and approval. We just need the time to do the work.
So you mentioned yesterday that was in Geneva. You signed with 21 members the formal charter for this whole project. The release mentioned that there's been excitement and interest from over 1,500 entities, and approximately 180 entities, you say, have met preliminary membership. Just to clearly add, what exactly does preliminary membership mean? Does this mean that these are 180 companies that will be part of the Libra Association soon?
No, again, I mean, and this is something you should take with the Libra Association, but what I believe it means is that 180 meet the criteria that was published on the Libra website for what it takes to become a member, and then the Libra Association is going to run a process to get to 100 members prior to launch, which is the target that we've communicated from the get-go. And I based on what I know now, I don't think we'll have any issue getting there.
So David Marcus saying no issue in getting its full membership, but another issue is whether or not they can get regulatory approval. We had the conversation last night. David Marcus has since joined the IMF annual meeting right here, again, the International Monetary Fund annual meeting in Washington, D.C., where he'll probably be rubbing shoulders with a lot of international regulators and central bankers. He said discussions with them so far have been productive and constructive. Guys.
So, Brian, you are down in D.C. For the IMF meeting. The IMF is never bullish, in my experience. What are the takeaways there this time? Is it fair to say, again, not too optimistic?
Yeah, well, gloomy skies again from the IMF. They had their annual, biannual World Economic Outlook yesterday. They said that they've actually revised down their expectations for global growth for 2019 to 3%. That's 0.2 percentage points down from their most recent update that was back in July. But then today they also had a financial stability report where they said that they're worried about the increasing level of corporate debt. They said that could reach $19 trillion at some point. That would cover more than, almost a majority of the corporate debt out there that's actually serviceable by the amount of earnings that these companies actually have on their balance sheets or in their income statements. So a pretty gloomy report from the IMF, but underscoring that in general, it seems like there is a global slowdown and that we should not expect countries around the world, including the United States, China, and Japan, to pick up anytime soon.
Brian Chung live in D.C.
Right, and coming up here on the final round, Wall Street getting ready for Netflix's big earnings report. That's after today's closing bell, with Disney and Apple breathing down its neck. Can Netflix deliver for investors? We'll discuss straight ahead, but first take a look at where European markets closed on this Wednesday. All right, Netflix, third quarter results. They'll be the focus of investor attention after today's closing bell. Last quarter, Netflix revealed its first quarterly domestic paid subscriber loss in 8 years. See the stock there up about 0.6% today. You look over the last several months, though, Netflix well off of its highs during that period. You see it's in a bear market. I know we don't like to say that about individual stocks, but off 21% over the last quarter, even with the market kind of hanging in and making some new highs in there. I think the FANG thesis really kind of broke because of Netflix. Now, a number of analysts coming out with notes ahead of this. Cowen putting a $35 price target on the stock, maintaining an outperform rating. And I think Jen bringing up something that we all know intuitively is true, but certainly the story has soured on the street, which is that people watch Netflix more than they watch other stuff. It's best in breed, best in class, whatever analogy you want to use for that. But, so you've got 38% basically of 18 to 34-year-olds saying they use Netflix the most of anything on TV. That is a large number. But
over basic cable.
But it's still, and this includes everybody. This is all ages here we're looking at on the screen. But it just seems like the story for investors has really broken down.
Indeed, but Cowen making the point early here in their note that they do not view Disney Plus as a substitute for Netflix. And that's kind of the call you have to make right now if you want to be bullish on Netflix going into the fall. And Cowen putting that in their second paragraph. They also believe that it's not a zero-sum game, that there can be multiple players here. And even if you look at that, the percentages that we had up there, it's like, well, people still are watching TV. Netflix is number one, but it's not like nobody's watching basic cable. So we can get some people coming in here to watch Disney Plus as well.
Well, it's interesting, you guys. I mean, I was just pondering that high penetration rate, maybe a little bit higher than people would have anticipated. And just a quick anecdote before I get back to the point that I was going to make, which is I was in Australia recently, as you guys know, and someone asked this audience of about 250 executives or business people, how many people had a Netflix account. And I was like, Australia. 85% of the people in the room. I was shocked. Now, getting back to my point, the penetration rate's either a good thing or a bad thing, right?
Peak, they've saturated.
Right? Well, the good thing, the bad thing is like, oh my God, there's no more growth.
Yeah.
The good thing is they've got this growth, now they can take it to the next, they have this market, now the market share, now they can take it to the next level. Like, I'm waiting for Netflix to get into sports. I'm waiting for them to get into gaming. And when they do that, I mean, they've got to make some other move here. Like this whole just gathering thing is kind of over now. And now getting back to this quarter, it's going to be really critical to see whether there's churn is a problem, because I want it to be stable, and then I want to hear about the next leg.
My only thing with the inability for them to continue to gather more subscribers is I think it's actually most analogous to what we've seen with Apple over the last several years, where it said, well, how many more people can buy iPhones? And I mean, I know it's not exactly right because your iPhone dies and you have to buy a new one, and Netflix subscription is just the same. But those companies have both overcome that exact same narrative. And I saw a number of people over the last couple of days dredging up 2010, 2011 era headlines that were essentially, how much bigger could Netflix get? And now it's 6 or 7 times as large. And so I do wonder, are we understating still, because it happens in slow motion, the migration of people away from cable and towards Netflix, and we don't appreciate how many households there are?
You were kind of referencing another point that we make sometimes, which is the CEO magic factor. Okay, and we were talking about that with Jamie Dimon with regard to JPM just the other day. There's something there with Reed Hastings and Netflix, and when you're talking about those other demarcation points, oh, it's over, and it's like, boom, pulled a rabbit out of a hat. There's another rabbit. Might be a giant rabbit, a puka, a 6-foot invisible rabbit, if you remember Jimmy Stewart. So, I don't know, but he needs something, a plan, rather than just like, oh, we're back in the black a little bit.
Now, speaking of the actual stuff that is on Netflix, Andy, you sat down with TV writer and producer David Simon as part of the Influencers series, and he had an interesting take on Netflix itself. He has not worked with them before, so what's Simon's view there?
Yeah, so it was kind of intriguing to hear him talk about it. He's an HBO guy, but obviously knows this world. This is his world writ large, if you consider it that way. And, I asked him about peak content and all the shows. And specifically when it came to Netflix, he sort of had this take where it was, how does this work? Take a listen.
They're flooding the market with content. And I don't understand the model. But that's not a rap on them. I don't understand the model. A long time ago, I went into journalism and I was a police reporter from Baltimore. So that I don't understand a mass communications model in the digital age is no great insult to anybody. But I don't know, the revenue stream and how you get people to watch your content overall and where the money comes from eludes me. And in some respects, it's not just Netflix, it does in every sense. I mean, I understood cable bundling. When I get to HBO, that seemed to be the lion's share of what they're doing. Now everyone's got their own platform, and how you pull people to that platform is either library or buzz or having a hit. And in some respects, Netflix is trying to do, I think, really rely on the library model. And maybe they're right, but it seems like it's an incredible amount of production in terms of money. I'm astounded by how much they're spending on content.
A little bit later, you guys, he talked about, shows on HBO get promoted, but when shows on Netflix happen, they just drop. Yeah. And he goes just into the ether, and you hear about some hits, but there's just this huge, giant iceberg of content that they make that you never even talk about, hear about. It's just there.
That was in another note today, the Piper note, just how many hours they've put out in the last quarter. But they think that's bullish because there's so many people to watch different things, I guess.
It's a long tail. They've got all kinds of algorithms. I guess it works. Maybe they'll change. All the rest.
Welcome to the internet.
Yeah.
Here we are. Still ahead, the drug pricing debate heating up on Capitol Hill. We've got a former Pfizer executive weighing in on the issue and why the new drug pricing bill could seriously hurt investors. As we go to break, let's check out how some of the big pharma names are trading in today's market action. For all the polarization in American politics, one thing both sides of the aisle seem to agree on: prescription drug prices are just too high. Our next guest is a former Pfizer executive, now a visiting fellow at the American Enterprise Institute. And she says the current system is flawed, but that the proposed legislation from Democrats working its way through Congress will curtail investment in new therapies. Kirsten Axelson joins us now. So diving in here on this plan that's going through Congress, House Democrats are trying to figure out how to basically let the government negotiate with drug makers over prices. And as somebody that pays high drug prices, that sounds like a good idea. What's wrong with it?
Yeah. This legislation would exactly do that, allow the federal government to negotiate the price of up to 250 drugs in Medicare Part D. And it would tie those prices to 1.2 times the price paid in several other major industrialized countries. The drug prices actually already are negotiated in Medicare. They're negotiated by the major health plans.
many of whom have more members in them than these industrialized countries. They have more members than France has people in their healthcare system, for example. The difference between what a private insurer does and what another country does is they are not unwilling to deny access to the drug. These other countries get low prices because they're willing to deny their population access to a drug if they think it's too expensive. Ultimately, in many cases, they do end up negotiating a price, but these life-saving drugs are delayed by months or weeks or years for people. Now, as many of us know, if you're someone with cancer and a new cancer medicine comes on, years of delay can mean the difference between living and dying. And so that's really the trade-off that you make with centralized negotiation versus private negotiation.
Can I ask just like a dumb question? Why are drug prices so high in general?
So most drugs are actually very cheap. 90% of all drugs are generic. And the drugs that treat some of the widest spread diseases, such as heart disease, are broadly generic, and still we see more than 50% of people quitting taking these medicines. So it's more than price that's going into the problems we have with prevention and treatment in this country. Now, the new medicines that are being developed, many of them are targeted, many of them are cell therapies, many of them are in areas where there have not been a treatment before, and they represent a significant advancement in treatment. Those drugs are expensive. They're used by a small number of people, but they're expensive the same way open heart surgery is expensive. And they have a similar type of result. They have life-saving benefits. And to set the prices of those drugs, drug makers go out and they speak with doctors, they speak with health plans, they look at what the cost is of other interventions, and they basically set the price to reflect the benefit of that drug relative to what other interventions would do.
But isn't it still the case, Kirsten, that the U.S. market subsidizes the global marketplace? And why should we do that, to say sort of one political perspective?
It is absolutely the case that the U.S. subsidizes the world's health and the world's innovation.
Why should we do that? How can we stop doing that? Should we legislate that the drug companies don't do that anymore?
If you did, you wouldn't have innovation. The other countries have shown a willingness to deny their populations access to new treatments. So the U.S. could make a decision, this is not fair, they're free riding, just the way you can make a decision that the U.S. subsidizes the world's defense. We could decide to stop doing that. It may be unfair, it may be sort of viscerally make us angry, but if you stop doing that, you would definitely see fewer new medicines on the market, and you'd see fewer new medicines for the diseases of the developed world.
What if we did stop doing that, though? Would there be, would somebody else step into this innovation vacuum that we might create?
The Chinese, yes. So there are a lot of clinical trials going on in China. The Chinese government has invested heavily in developing the innovative medicine sector in China. Chinese people tend to enroll in clinical trials. One of the longest, slowest parts of drug development is the lack of enrollment in clinical trials in the U.S. So yes, we could see, for example, China overtaking the U.S. as the leader in providing the world's innovative medicines. Now you would have to say, would those medicines be tailored to the diseases of this world, of the U.S. and the U.S. consumer versus the Chinese consumer, and will we want to necessarily embrace that science? I think there are still questions about whether we'd be okay with Chinese science and Chinese approval processes being the medicines that we have in these countries.
So when you look at the political landscape right now, there are a variety of proposals that a variety of politicians have on what to do about drug pricing. As we head towards an election year, is there anything that you find constructive at this stage?
Compelling.
Even. The vast majority of the proposals are sort of grounded in some Medicare for All construct. And the problem with the Medicare for All construct, whether you're talking about drugs or other types of services, is it puts more people into a system that is really broken. Right? We still largely have fee-for-service. We're paying people to deliver volume of care. We're not paying people to deliver better health or longer life. If you wanted to really work on improving the system, you could put all services under one umbrella, and you could have something like premium support where the government says, I'm only going to pay X $1,000 per person, and it's going to grow at X% per year. And then within that, you can make the trade-offs. Maybe what we should be doing is spending more on drugs and less on emergency rooms, or whatever the case may be, more on alternative types of therapies. But right now, just cramming more people into this broken system is not going to solve the healthcare growth problem or the health problem.
Whew.
Yeah.
We all got a lot to work out.
Well, you're currently sick, so
I am currently sick. I will tell you that I did get I think my antibiotics were only $4 though.
Oh, great.
So there you go. A lot of drugs are cheap, and the Sudafed.
I just got a flu shot. Just half an hour ago. Free, by the way. It was free. Subsidized by somebody.
Verizon.
Right.
That's whom.
Yeah, I guess.
Exactly.
Yeah, the Flonase was more expensive than anything else. Kirsten Axelson, thank you so much.
Thank you.
All right, and coming up here on the final round, cameras are the latest weapon in the smartphone war. Google Pixel 4 versus iPhone 11. Yahoo Finance's Dan Howley stops by to break down which we like better. But first, let's check out how some big tech names are trading in today's market. Miles Eldon here in New York. This is the final round on Yahoo Finance stocks. A little bit lower here. Surprisingly weak retail sales offset upbeat earnings and a strong read from the housing sector. We'll have more on all the market action coming up in just a bit. Plus, get ready for Netflix earnings. We'll have the numbers for you live when they cross right after the closing bell. And 2020 Watch, what all the campaign promises could mean for investors. Plus, Google and Apple going head-to-head with their brand new phones. Dan Howley stops by to tell us which one has a better camera. A lively debate will certainly ensue after that. Joining me now, as always, my co-host, Jen Rogers, and Yahoo Finance editor-in-chief, Andy Serwer. So with 27 minutes to go in the session, let's take a quick look at where we stand right now. All three majors in the red. The Dow, the S&P, not a whole lot doing. The NASDAQ, I think, actually papering over some of the more ugly stuff going on in the tech names. We were talking earlier about what's happening with some of these software plays. Coupa, Trade Desk, Okta all down more than 7%. Workday down 11%. The rotation that we've looked at for so long, really since I think mid-July or so, continues apace in this market. Red on the screen there, but strong report out of Bank of America. Johnny John leading the Dow once again, and it looks like an okay day on the surface. For more on today's market action, though, let's go to Scott Gammies live on the floor of the New York Stock Exchange. Scott.
Well, Miles, we have to talk about Boeing because there's been a lot of volatility in the stock today. It opened flat, then surged midday. It was up about 2%, making it at one point the second best performing Dow stock today. And since then, it has really given up almost all of that gain and is now just slightly in the green. There's been a lot of course, reporting about the 737 MAX jet. Yesterday, we heard from the Southwest Airlines Pilots Union saying that the plane won't return to the schedule until February of 2020. Air Canada, which also flies the MAX jet, came out today and said the same thing with a February 2020 timetable. And then we heard from United Airlines, that CEO, Oscar Munoz, was on CNBC saying that no one knows when the plane is going to come back. So a lot of uncertainty there. And of course, Boeing shares are volatile today. Now, because of all of the strong earnings reports that we've seen this week, that has exacerbated this rotation that we're seeing across the market. Now, within the Dow Jones Industrial Average yesterday, that rotation came at the expense of Procter & Gamble, which was the worst performing Dow stock. It was down over 2%, and we know P&G has been a high-flying stock so far this year and over the past 12 months. It's hit numerous record highs over the past couple of weeks. But today, the rotation comes at the expense of some of the energy names, especially within the Dow. You've got names like ExxonMobil leading us to the downside. It's down about 1.5%. Chevron shares are also down today. And then the energy sector is the worst performing sector in the S&P 500 today. And oil prices, at least for West Texas Intermediate, are up about 1% today, but they're still below some of those key technical levels that we like to look at, right? $55 a barrel and $54 a barrel. Right now, we're just above 53, Miles.
All right, Scott Gann, we'll talk to you after the closing bell.
Google is the latest smartphone manufacturer working to provide users with the most top-notch pictures. But can their new Pixel 4 beat the new camera system for Apple's iPhone 11? Yahoo Finance's Dan Howley is here with his review and what camera worked best for him. Dan,
Smackdown.
I just bought the 11.
Here we go.
So
Me too. Look at this, some 11 power
I have
over
it,
here.
11 power, but you're all right. So I don't know.
Smackdown.
I
got them both.
You got them. Oh, that's the 11 Pro. This
is the Pro.
That's the 3
Watch
cameras.
yourself,
I see
watch
that.
yourself.
It has 3 on the back. Does that Google one have 3
Google's
on the back?
got Dose, not
Oh.
Trace. So
Okay.
Google's falling behind there. It's not.
Strike one.
It wasn't a smart move. They went with a telephoto. Apple went with a telephoto and an ultra wide. Between the two, I gotta say, Google, when you're taking low light photos, notches just above the iPhone.
1 and 1.
1 and 1. We also, so I took a couple of pictures. One was the low light photo. Another was a selfie of moi.
That's you.
You could see here. So
Are you on the left or the right?
I'm on the right. I don't know who's
Yeah,
on the
that's right,
left.
you are.
But I don't know, like the difference here really is the coloring. It doesn't do quite a great job, the Pixel, of picking up my actual skin
There's
tone.
a different depth of field on the Pixel.
Yeah. Well, they both have the depth of field feature on. That's
Oh,
the
okay.
portrait mode that's going on. But you can see the shirt's a different color. These are just wildly different cameras as far as the coloring goes.
So different.
But this is just the front camera. The rear camera, I took a couple of pictures, and I have one of I want to show this gorgeous yellow flower that I took a picture of. And basically, I wanted to show how the two phones handle color. And in one of them, the iPhone is able to get the coloring right, but the Pixel is a little bit better. The iPhone's sharper. This is where I'm adjusting the light. So you can kind of change the brightness and the darkness on the Pixel, which is a great feature. On the iPhone, you can't. You can only adjust the white balance. So you can see how it washes out. With the Pixel on the left, I made it look kind of almost radioactive. And then you could see the difference between the shots there. So really, my big takeaway from the two is the Pixel captures great colors and has a wider range of colors, but because of that, some photos look darker. So really it comes down to whether or not you want real rich color or whether you want them to look a little bit on the brighter side. I think when it comes down to low light shots, that's like really where the battleground is. Google is beating out Apple still. And then there was a feature on here where you can zoom in. Now they don't typically look good photos when you zoom in like 100%.
Yeah.
Google here, you can see the Pixel on the far left. It blows away Apple's. Apple's looks pixelated and kind of just artifacty, whereas the Pixel 4 still looks clear. I think that's really impressive, and that's part of their computational photography feature set that Google is pushing. They're really all about the software. When they debuted this phone, they basically said jack squat about the actual cameras themselves. They were all about the software.
So this is obviously the Arch in Washington Square Park. So is Google using like its bank of pictures of that object,
No.
of which it has many, to create that?
It's basically, so what it does is it's able to, this is wild, it's able to see that your hand is moving if your hand is moving when you take it, which it naturally does.
Sure.
And then it takes pictures, bursts, as your hand moves. And because it's getting multiple pictures, it's able to layer all of those together to get the details to be more accurate, because it's just piling more information on more information on more information. Cooler, if you put it on a tripod, the freaking camera moves itself inside. And then that way, it's able to capture the images from different locations so that it can layer them on top of you. It's wild. You can actually see the camera move.
And yet there's never been more homelessness in the city of San Francisco.
Yes,
I'm
but
sorry.
they will make better cameras.
I was also going to say, I mean, nice job and all your hard work, but no one's switching phones.
I know.
So it doesn't really matter.
Not until
Like,
iMessage goes on
yeah,
Android.
I mean,
It's a big
until
problem.
it's no one switching phone. It'd be like switching religion.
It
I'd have to
really
marry somebody that had an Android.
You have an Apple
You could
Watch?
convert.
Wow.
I could convert, but I would need to. I'm saying if I married somebody that had
already
an
married.
Android, then maybe I would
I'm not going to
change.
say it again.
You have an Apple Watch? You have AirPods? There's no way you're going to go to
Yeah.
Android.
If that camera would
When
have
are they
to.
going to do that? Is
I don't
people
know.
gonna have AirPods?
Make
They
me-
have them.
Oh,
Not have
okay.
to
That's
put
for
on
another
makeup.
segment?
Yes.
Dan Howley, we'll talk to you tomorrow.
Thank you.
All right, coming up here on the final round, Democratic hopefuls squared off last night on everything from taxes to health care. But what would their policy mean for Wall Street investors? We'll discuss with EventShares CIO Ben Phillips right after the break. First, let's check out some of the most active tickers today right here on Yahoo Finance.
Let's take a look at some of today's winners and losers. Stocks in the red include Interactive Brokers after the electronic brokerage firm missed on earnings and revenue estimates, despite a 12% year-over-year increase in its commission.
Funny about those commissions, though. Guess what? They went to
going
zero.
away.
You called this, I
That's
think.
the next quarter.
Called it.
That's this quarter. That's next time. MGM Resorts shares of the casino giant are dipping after announcing it will sell 2 of its properties on the Las Vegas Strip, including its landmark Bellagio property. Yeah, is that the one with the waterfalls? Like
The Frank Sinatra one?
I think so. Those are in separate real estate deals. Stocks in the green include Bank of America, though the bank reported a decline in profits on Wednesday. It still came in ahead of expectations. Results were supported by a 27% increase in investment banking fees and strong growth in consumer banking. AmerisourceBergen shares are climbing today alongside rivals McKesson, also Cardinal Health moving higher. The Wall Street Journal reporting that the drug distributors are in talks to settle opioid-related lawsuits for a staggering $18 billion.
You know, those fountains aren't that great. I was just thinking about it.
At the time, they were amazing.
I know. You see, you know what we're talking about.
Yeah, I do.
Yeah.
Well, the problem, you're right. The problem is you build the fountains and someone builds a better fountain next year.
When they first opened, they were
always a better fountain out there. All right,
fountain inflation.
The latest Democratic debate is in the books. Joining us now to talk about how investors need to be thinking about next year's election is Ben Phillips, CIO at EventShares. So Ben, let's just kind of start big picture here. What'd you make of the debate last night from a policy perspective? That we got the sense that Warren was viewed as the clear front runner, and I think a big part of her likely policy agenda would be some sort of Medicare for All package.
Yeah, I think that's right. And it's good that we're going to focus in on the Medicare for All right away. I think Warren was, she is the front runner. She's also the target, though. And I think people maybe saw last night that some of the ideas are fairly radical. And there's also big questions on how she's going to pay for them. So that's always an issue. We have this politics versus policy, and that's what we try to separate. So let's talk about the healthcare policy. It's healthcare, Medicare for All is very, very low probability in our view. It's going to need congressional support, and there's really not a lot there. If we look at the ACA repeal and replace the Republicans tried, that was politically toxic and caused a lot of pain for the Republican Party. So I don't think the Democrats want to touch that stove that the Republicans just burned themselves on in the first year of Trump's presidency.
Well, maybe not Medicare for All, but something on healthcare. I mean, we just had a guest here that used to work at Pfizer, is with American Enterprise now. And basically, there is bipartisan support for trying to do something about drug prices. And those could be hits to a lot of these, big pharma names. You think healthcare valuations look attractive right now?
Yeah, that's right.
I mean, so give it what names and what areas, because I know healthcare, it's pretty spread out.
It's a massive sector, so you do have to parse it. And totally fair point. I think PBMs and pharmaceuticals as well as biotech are at risk, and those are probably valuation-wise too from the biotech side. But the PBM and the pharma are really at risk from a policy perspective. So yeah, we are largely avoiding that space, but we are looking at managed care providers. So you think some of the Medicare, Medicaid expanded names such as Humana, Centene, some of the others there, and then health tech. Health tech is really focused on value-based reimbursement, lowering the cost for the system, improving efficiencies, and really driving better outcomes in healthcare. So we're definitely looking at health tech a lot as well.
Hey, Ben, you mentioned Congress, and I want to get your take on where you think things are going to land after the 2020 election and how that would implicate, say, not only healthcare, but the markets generally.
Yeah, Andy, and we're 13 months away just about from the outcome there. So a lot can change between now and then. So I'll qualify it with that. I think our current expectation is that Senate stays Republican. That's the most likely base case for us. House is, I think, still a coin toss. We'll see. But as long as the Senate stays Republican, even if there's a Democratic president, that's going to make it very hard to push through some of these more radical agenda items that are being talked about. And again, we think it's more political campaigning versus actual policy trends. We're looking for those long-term policy trends to invest in.
So, Ben, a trend that we've talked a lot with you about over the last couple of years, I mean, I almost joke about it, but it's actually a real area. That would be infrastructure. Is there any kind of outlook, I guess, as we now look to, I think right now, with impeachment going on, everyone who is in office is really not thinking about doing things now. So let's roll it forward 18 months or so. Everyone agrees, again, to Jen's point about lowering drug prices. Everyone agrees on that. Everyone also agrees we need to invest in infrastructure. Would there be a renewed view from the next administration, next group that comes in there to try and make something happen there? Is that an area you're looking at?
Yes, absolutely. We're very constructive on infrastructure, and I totally agree with your point. And the federal government's not going to do anything until 2021 at the earliest. But what I think people are missing with the infrastructure story is the states are spending. So we've had 30 states now, I think with the addition of Illinois recently this year, 30 states have increased fuel taxes or vehicle registration taxes to pay for transportation infrastructure. So people are missing that. That is really going to start showing up. In our infrastructure basket, our stocks are up over 30% year to date. So it's being picked up. We're going to see it more in the earnings here in the back half of the year. We think we're going to see it, this quarter's earnings as well as Q4 earnings early next year. And then if you talk about it, it's really setting up for that multi-year trend where the states are spending now. And then if we see a federal package, you're talking about a 5-year, 6-year infrastructure boom potentially if the federal package comes in.
Ben, just looking forward, you think that 2020 takes effect, 1/1/2020. We're going to be started. We're there. We're almost there. It's, we're in the last quarter right now. When during the campaign, will you make adjustments to your ETF? Like how do things need to unfold for you to make changes?
Yeah, it's a fair question. Typically, what we're doing is we're looking where there's already an established trend underway. So you wouldn't see us making speculative positioning or making any trades based on a potential outcome of, let's say, a Democratic president. I'd say the only case if it were a complete slam dunk and there was maybe impeachment going on, it looked like there was no way Trump was getting reelected. But I would say right now, if we were to hold status quo and say the election was in 3 weeks, you would see us change the portfolio in the following weeks and months after the event, after that election day.
All right, Ben Phillips with the U.S. Legislative Opportunities ETF at Event Shares. Thanks for joining us. Talk to you soon.
Thanks.
Up next, Disney, Apple, Amazon, Comcast. The streaming space is getting crowded and the pressure, extremier. The war is on for Netflix to outshine the competition. Do they have what it takes to win viewers and investors? We discuss straight ahead. Right now, take a look at some of the tickers trending on Yahoo Finance. Market's relatively unchanged. All eyes are going to be on Netflix, though, after the bell as the company reports third quarter results. Wall Street is estimating that Netflix will report a third quarter adjusted earnings of $1.23 per share. That's on $5.25 billion in revenue. The options market here is implying an 11% move in either direction following results. Netflix can be incredibly volatile. After the bell and the day following results. We have seen that repeatedly here. Obviously, I mean, hey, last one out of the gate was not great.
Right.
What's the one thing that we need to be paying attention to?
Yeah, I think it's the growth or the lack thereof, which they exhibited last quarter, and they have to turn that around. It's pretty simple. I mean, they're going to do there's two parts to this report. It's going to be that headline number, which is really critical. Yep. I mean, it really is, because 2 times a trend doth make. I know it's usually 3, but come on here, right? And then there'll be a lot of
allows it.
Yes, thank you. Especially with the doth. Yeah. But then there'll be some drill down after that. Yeah. And it's very volatile this way. It's a baby Amazon.
Well, and Jen, you know why I love Netflix earnings? Because they put out a great investor letter that has all kinds of other information.
Pictures in it, too.
They have pictures, they have commentary. So, of course, I think how Reed Hastings chooses to address the elephant in the room, the elephant being Bob Iger and what's happening over at Disney, will be constructive, right? I mean, he's probably going to say, we always welcome competition and we're excited to see more entrants to legitimize our space, something along those lines, but he obviously needs to address it.
I bet he'll say something more fun than that.
Okay.
Because that occurred.
I hope he does.
Right, I think he will. And, I think the troika of Apple, Disney, and Netflix is so interesting, and something's going to happen there, in the next 3 years, 5 years. And will Apple acquire one of the two, for instance, just to put it right out there? Either one. Right.
Well, is it the other player down here? It's like your Roku or whatever that somebody needs because Apple already has hardware. So does somebody else need to make a play for something to get into hardware? Does what's happening to HBO Max in here? There's so many moving pieces.
Obvious thing is that Netflix needs to go somewhere else beyond what they're doing right now. I mean, they need to get bigger somehow. I just don't think they can go through life 3 years hence and say, we're just going to keep doing the same thing. I don't think so.
My only reason why I think Netflix might sit there at night and say, I think our strategy as it stands works, is because a lot of the other players coming into their space, they're going to fail. Like the people around them
afford to fail.
Well, the people around them, but the thing is, can Warner Media really afford to fail 3 times in streaming?
Well,
I don't think so.
Right. They won't. I mean, that's an existential thing for them. I'm talking about the big. I'm talking about the other two.
Yeah.
Right.
I actually think Apple will fail.
Yeah, I think they might fail, but then my point is that I don't think.
Yeah, the money doesn't matter. I know what you're saying.
But no, I'll bet you that within 3 years, Netflix is definitely doing something different.
Interesting.
As part of the business. Has to. I just think they have
Live or a movie theater.
Well, like I said, it could just be sports or.
I mean, the thing is, look, they are
Alamo Draft House.
They're charging twice as much as Disney is coming in, right? Think about they've got all those subs giving them money month after month after month. It's not a terrible business.
No, it's not.
Not terrible.
But you know what Wall Street wants? What have you done for me lately?
Yeah, more. Yahoo Finance Editor-in-Chief Andy Serwer, have a great evening.
All right, coming up here on the final round, you just heard us talking about it. We'll have Netflix earnings. That's coming up after the closing bell. Keep it right here on Yahoo Finance. We're back in 2 minutes.
Welcome back to the final round on Yahoo Finance. I'm Jen Rogers with Miles Udlin, and Dan Roberts is joining us. We're just moments away from the closing bell on Wall Street right now, and I believe I got to make it exciting. The S&P just lost 29.90.
Exciting. Yeah,
29.90.
Yeah, yesterday.
There you go.
Yesterday we had 3,000 for a minute. We closed right at 29.95, so 29.89. You know.
Yep.
Slow bleed. Next stop zero, Jen.
But B of A, come on.
Yeah.
B of A,
Positive earnings.
the home builders.
Hooray.
Darn those retail
There it
sales.
is.
We'll get to that later. Live pictures of the New York Stock Exchange and the NASDAQ market site on a pretty slow, tight trading range, choppy. Just in terms of the broader indexes, that's what you got today. Dig down a little deeper, though. You're going to see some momentum names feeling the pain and some financial names doing pretty well.
Mm-hmm.
There we go. Red across the board.
We regained 29.90, Jen.
Oh, man, there goes my whole narrative for the day.
Or how about this? We held 27,000 on the Dow.
Wow, okay.
Nice job.
There
Great
we
job,
go.
team.
There we go.
Great job,
At
team.
least I have that to write home about.
Could have been worse, given some of the data we got today.
All right, so retail sales.
Yeah,
That's,
I mean, it's
that's what the
unfortunate
problem
now.
is.
Well, people are saying, well, maybe it's just 1 month. You know, let's give it another month. Let's
Well,
see
it is just 1 month.
Well, right, but I mean, like, maybe it was just 1 month that we'll have disappointing numbers like that. Maybe it's an anomaly. I was saying earlier on the move, remember when the yield curve became inverted and everyone said, oh, signal of a recession, signal of a recession. But others are saying, no, only if it lasts for a sustained amount of time. Well, similarly, maybe we don't freak out yet about the consumer and about spending based on just the September numbers.
I mean, in the second quarter, annualized retail sales were up 7.9%. In the third quarter, annualized retail sales were up 7.3%. So I think I'm fine. I'm comfortable with the three.
This is like the
3 times
take
decline.
of the economy could add just 30,000 jobs every
Exactly.
time. And
They're
it's
still
okay.
adding jobs.
Right. How about that?
Not a contraction.
Focus on the positive. I like it.
You like it?
But it didn't work today.
I think it. I mean, just to that point though, like thinking, what does the data tell us? I so firmly believe that like recessions aren't that hard to identify. Right, we don't really have to torture the data to get a sense of whether the economy is turning south. I mean, the economy right now is very obviously doing one thing: growing at a slower pace. An overall downturn,
Which is like slowing. It's
Right.
slowing, it's growing. But yes,
it's growing slower.
slowly. Yeah.
growing slower.
Or it's slowly growing.
Right.
But it's
growing less quickly.
The point is, if the economy was really rolling over, people en masse would be losing their jobs, and it would not take a genius to sit there and say, I think things are bad. So that's all.
I agree with you, and I do think it has to do with the labor market, and you start to feel. But, okay, how you always say that people are just thinking about the last recession and how
That's
bad
right.
it was,
Yeah.
I think that this might be formed a little bit by that, because
I see.
that's
Meaning
what
fear begets fear.
that's what last time was like.
Right.
We knew it when we saw
Jen
it.
saying that this time it might be more.
Given my wisdom and years,
Yes. I have seen two cycles, not just
Well,
one.
one could say people aren't shook enough from 08, 09.
And so it sometimes maybe creeps up on you. And you're like, is this a recession? And you're waiting for the NEVR to tell you.
Well, and
like,
we aren't.
You don't always know.
Well, and you don't always have a giant bellwether event like banks going under. Hello.
Although I agree with you.
But I mean, to counter your point, the one before that was also an extremely obvious tech bubble. I mean, that was also not hard
When
to
we
see.
were in it, we didn't think that. We thought.
Wait a minute. Maybe in 2 years, after the recession that will happen 6 months from now, we look back and we say, well, there was an extremely obvious tech bubble again.
Of course.
Uber,
but you only see it
Lyft.
afterwards.
We were canceled.
Oh boy. I know. This is all good stuff.
When you're in it, it's
scrap
very
the show.
hard.
Let's scrap the show and just keep going on this.
Let's just play rhetorical word games about whether we're in recession or whether the economy is growing.
More slowly.
We are waiting for Netflix results to come out. Of course, this is the first big tech name to be reporting after the Bell financial results, or before the Bell, because all we've really had are those banks, and they tell us a little bit, but they are not as volatile. And in terms of the direction of what we might see, they are out. Let's go to Heidi Chung in the newsroom. Heidi.
Hey, Jen. Yeah, so Netflix shares are higher by about 3% in after-hours trade. What we're seeing here for the third quarter for Netflix, they did miss slightly in revenue, totaling $5.24 billion versus the $5.25 billion that was expected on the street. Earnings per share higher than expectations at $1.47 per share. Expectations were for $1.05 per share. Now, domestic paid subscribers in the third quarter, disappointing estimates. They had about 500,000 10,000 during the quarter, and it was about 800,000 that was expected on the street. International paid subscribers were better than expected at 6.3 million. Analysts were predicting about 6.2 million paid international subscribers. I am going through the rest of the numbers here, but the shares are higher in after-hours trade.
Heidi Chung in the newsroom. We are watching Netflix shares up just about 1.5% right now. Going through the shareholder letter here, calling out the variety, the diversity, the quality of our content slate. We all know how much they are spending on content right now. Looking for, is there any sort of color here on all the competition that's coming out? Has anybody gotten to that yet?
They haven't traditionally been enjoying talking about it. Of course, they'll be forced in the earnings call with the Q&A. But yeah, I'm glad we were highlighting final quarter before Disney Plus and Apple TV Plus launch.
Yeah, just on that point about the competition, the launch of these new services will be noisy.
It made it in.
Netflix, yeah. Maybe some modest headwinds to our near-term growth. We have tried to factor that into our guidance. The long term, we expect will continue to grow nicely with the strength of our service and the large market opportunity. They talk about Canada, where Hulu doesn't exist, comparing that to the US. Quite a lengthy discussion here of sort of all that competition, but I think they're essentially giving what I would call soft guidance here, saying that near-term growth could be impacted, a modest headwind in the language of Netflix, that they're going to be facing from that competition. I mean, it shouldn't be a total surprise that they characterize it that way, because Disney did come in and undercut them on price by about 50%.
Yeah.
So certainly that is going to increase competition. And also, Netflix includes that net paid ads relative to their forecast. We now have 2 quarters in a row where Netflix is missing their own forecast. They bring that chart back to the beginning of 2016. They have never had 2 quarters in a row where they came up short of their forecast. So I think definitely a different phase for Netflix's subscriber growth. We discussed earlier in the program, the stock price has reflected that over the last few months. So today up a little bit after hours, but it does feel like a company that's entering a new era, as it were.
A little bit more on the competition front here, just saying that with so many firms now looking to provide premium video content, it's a great time to be a creator of content. Amazing content can be expensive, though. Netflix saying we don't shy away from taking bold swings if we think the business impact will also be amazing. We don't close every deal we chase. We don't chase every deal on the table. And say they're going to learn as they're doing this, basically getting disciplined by assessing each opportunity and trying to improve their free cash flow through it. But I think the competition is obviously on their minds.
We don't shy away from spending. We already know that. No problem spending and throwing money at the wall. Look, in terms of competition, what's been fun, I think, over the last year, it's already been a year that we've been talking about it, is going back and forth and tracking how the narrative has shifted from Netflix doesn't need to worry about Disney Plus and Apple TV Plus to, oh, look how cheaply priced these 2 new offerings are, so maybe Netflix does need to worry, to, well, rising tide lifts all boats / for a while we can all compete. The pie's big enough that for a while we'll be okay. And now I think you're starting to really see people split between, maybe it is a real threat to Netflix. Others saying, at least for a while, people are still willing to add more subs rather than cut. But man, as we mentioned, last quarter, first time Netflix lost subscribers in the US. I don't know if you can really chalk that up to competition yet, because you didn't have these things. It's not that people were cutting one for the other. But I think that it seems to me like the current temperature, more analysts and more experts and more people we talk to are landing on the side of Disney Plus is a threat to Netflix. Apple TV Plus, not so. Apple TV Plus, Disney and Netflix both have a kitchen sink approach right now.
Yeah.
Apple TV Plus, it's only got 6 shows, and it's so cheap. I mean, they're giving the thing away.
Basically. I got my new phone. One more thing in here. They're going to change some of their guidance going forward, finding that U.S. versus international segment contribution margin reporting is becoming less useful internally. They're going to stop reporting that January 2020 as they continue to focus on global operating margin. That's going to be their primary profitability metric. Always interesting to see when companies sometimes take away data points from us. Let's bring in Lee Drogan, Estimize CEO, joining us via Skype to discuss Netflix results coming out here. Your takeaway, having had a chance to look through these.
Yeah, look, the numbers are basically in line with what the Estimize consensus was expecting. The issue here is going to be the forward guidance. And I want to point out back in 2014, a conference that I was at, there was a Goldman Sachs conference out in California where Reed Hastings was speaking. And I left that conference so surprised at the fact that when he spoke, he was so open about the fact that they had been losing a lot of money at the time, and there were so many variables up in the air even at that point regarding their business. And he basically said, look, we're going to figure this out. And the crowd there left, and the next day the stock rose significantly after he gave that speech. And I think we're at another crossroads similar to that for Netflix, where he has to deal with basically a slowing subscriber growth number, as well as barbarians at the door of his business. The thing is, he's done this several times, and you can see in the guidance, the way he's speaking about it, they're not shying away from the fact that they have to figure this out. And he's figured it out several times before, so it's not something that I would necessarily bet against.
And so when you look at that future path then for Netflix, so we can all identify, I guess, that Reed Hastings sees he has a challenge ahead of him. As you think about their business today, I mean, what kind of tweaks do you think they might be looking at making? I mean, the amount that they're spending on content is much discussed. I think the actual way that they're able to use that content over a longer period of time is less discussed, right? And on that basis, it might not be a terrible deal. But when you think about where Netflix evolves over the next couple of years, what do you see for them?
Look, at the end of the day, I think, it all does come down to what is the unique nature of the content on your platform, and why am I signing up for a subscription? To me, the big opportunity here is still international, and you do see them adding a significant amount of international content that is unique, in those geographies. I doubt that their selling point is going to be the incremental subscriber in the United States based on one more really great TV show that they put up on that platform. It's going to be about international. They do have the relationships in order to do that. And Reed has just basically thrown down the gauntlet that they are willing to spend all the money possible in order to do that. They put up a really good EPS number here this quarter, even though the revenue number was right in line with Estimize and below their guidance number, which is interesting. So he's going to have to push on that specific lever, the international lever, more and more. And the question is, how expensive does it get to acquire those users in those other geographies relative to kind of the more viral nature of the domestic, geography here, and the cost of acquisition of a user in the U.S. But certainly, I think if you believe that the addressable market for Netflix overseas has been tapped out, I would bet on the other side of that. I would bet that there's a much larger market for them to continually go after. It's just a question of what it's going to cost for them to acquire those users.
Lee, Dan Roberts here. Since we're talking about the spending on original content, and Netflix obviously willing to spend so much, it's already been maybe criticized a little bit in the past, and now this letter sounds like, well, we're going to spend more. All that said, can we frame the conversation specifically around Netflix originals versus licensed shows that come from somewhere else that Netflix pays to have on its platform? Because a lot was made about the fact that eventually it's going to lose Friends, going to lose The Office. Has that been overstated? But especially when we talk about competition from Disney Plus, which has so much stuff, and then Apple TV Plus going for more of a premium, just a few shows, but all originals, all expensive originals. What do you make of that divide?
Yeah, I don't see the issue being the non-original content disappearing from the platform. Again, think about what their attrition rate is relative to the additional subscriber that they may be able to acquire, and why that subscriber is going to be subscribing to Netflix in the future. It's going to be because of the original content. Now, the question is, at what point does the consumer just get so tapped out that they say, I'm not subscribing to Disney and Hulu and Netflix and ESPN and so, that's the point at which, if I was Reed, I'd be scared of, it had nothing to do with my business, just the general competitive marketplace and the saturation there amongst all of my potential subscribers. But I don't get the feeling that the non-original content is going to be an attrition issue or a non-subscriber growth issue for them.
Lee Drogan, thanks for the insights. Estimize founder and CEO.
All right, for more on today's market action, let's go to Scott Gamey. He's live on the floor of the New York Stock Exchange. Scott, obviously investors focusing on Netflix move after the bell, but returning to the regular session, what stood out to you down there on the floor?
Yeah, not a whole lot for the broader market. We were down slightly, but still held on to the bulk of yesterday's gain, and it is of course natural for stocks to take a breather a day after a big up move like we saw yesterday. But for today's session, the best performing Dow stocks were Johnson & Johnson, Cisco, Disney, McDonald's, and Goldman Sachs. By the way, Johnson & Johnson and Goldman Sachs both reported earnings yesterday. The stocks rose yesterday and are of course up again today. The laggards were ExxonMobil, Chevron, and Microsoft. We know there's been this rotation today out of the energy sector, and some of those names are not surprising that they were down today because, of course, energy and tech were the two worst performing sectors in the S&P 500. And then we were also watching GM shares today. The stock ended the session above, with a gain over 1%, of course, amid reports that the UAW and GM have reached a tentative deal to end that strike that's been going on for the past month, Miles.
All right, Scott Gamey, we'll talk to you tomorrow.
Up next, we'll have more on Netflix earnings. Plus, one Wall Street bank says China will overtake the U.S. on digital currencies if Facebook's Libra project dies. It's our call of the day. We're back in 2 minutes. Let's head back to Heidi in our newsroom for a recap on Netflix earnings. Heidi.
Hi, Jen. Yeah, so investors are really loving this report out of Netflix, the Q3 report, saying that revenue climbed 31% from last year to $5.24 billion, though analysts were expecting about $5.25 billion for the quarter. Earnings per share about $1.47 per share, beating estimates of $1.05 per share. So total paid sub additions in the third quarter, about 6.8 million additions. Domestic paid subs here in the U.S. totaling about 500,000, missing expectations for about 800,000. International paid subscribers during the quarter, 6.3 million versus the 6.2 million that was expected. But looking to the fourth quarter and guidance that the company provided, Netflix expects to add about 600,000 paid subs here in the U.S., which was a little lighter than what the expectations were for about 1.28 million U.S. sub adds. And in the fourth quarter, Netflix expects to add about 7 million paid subscribers internationally, and analysts expected about 8.04 million. Now, starting in the fourth quarter of starting with their fourth quarter earnings report in January of 2020. Like you mentioned earlier, Jen, Netflix plans to disclose revenue and membership by region instead of the way they have been doing it up until now, which was U.S. versus international. Now, the company also reiterating expectations to burn through about $3.5 billion in cash for this year. Now, spending is slated to hit about $15 billion in 2019, which would be a record for the company, but Netflix saying that it expects free cash flow to improve in 2020 compared to 2019. Of course, they mentioned Stranger Things Season 3, which did launch at the beginning of the third quarter, and the company is saying it was the most watched season to date with 64 million member households in its first 4 weeks. The company also talking a bit about competition, saying, quote, "The launch of these new services will be noisy. There may be some modest headwind to our near-term growth, and we have tried to factor that into our guidance. In the long term, though, we expect we'll continue to grow nicely given the strength of our service and the large market opportunity." Netflix also giving themselves a pat on the back for being quite accurate with their previous guidance for the third quarter this time around. Shares, though, are down about 22% from the previous report, not including this after-hours move. But leading up to this report, the options market was implying about 11% move in either direction, and it looks like it was spot on, you guys. The conference call is kicking off at 6 p.m. Eastern, but like it always is, it's usually a pre-recorded webcast, so we can expect to hear some more information from management on the upcoming competition ahead.
Heidi, just very quickly, it's interesting because typically it's thought that the most important number in Netflix earnings is the sub ads. And as you mentioned, shareholders loving the report. It's up 10% right now after hours. And yet it was a miss on subs, a miss on revenue, just a beat on earnings.
Yeah, so it was a beat on earnings and it was a slight miss. You can say it was roughly in line when it comes to revenue, but I think overall analysts and investors were actually expecting much worse in terms of paid sub additions. Internationally, they came roughly in line, if not a little better than expectations here. And I think the consensus has been that the US paid subscribers were starting to decelerate anyways. So this number, though it wasn't the best, for now it seems as if because the competition hasn't necessarily hit the market yet, investors are kind of shrugging this off and waiting to see how it goes next quarter.
Heidi Chung in our newsroom. Thank you.
All right, time now for our call of the day. Today we got Dan Roberts, so we're talking a little bit of crypto. RBC out in a note saying that should the U.S. fail to create regulation that encourages growth in the crypto space and thus dismiss Libra, which is kind of falling apart on its own, RBC warns that China could be positioned as the leading global digital currency economy. So I think this kind of fits a number of buckets here that everyone has when it comes to broad worries. Mm-hmm. One being, how does China emerge as a leading economy? Do they become the leader in the crypto space? I'm not exactly sure, Dan, how closely that is tied to the fate of Libra, considering the Libra Association is based in Geneva. They don't seem to have agreement with their members in the first place. But I wouldn't also rule out that a more centrally planned economy like China could end up being the leader. It's just not clear what that leadership role would mean.
Well, given everything going on right now, politically, macroeconomically, I don't see how it would be China. So there are a lot of leaps taken in this note. And in fact, right away off the top, we have a pretty big contradiction that we're sort of getting into. So let's actually dive deeper here. Okay, so the prediction that you could see China's central bank digital currency grow, and then it says, especially if U.S. regulators dismiss Libra completely and do not draft new regulation to encourage crypto innovation. By the way, I don't think we're going to see new U.S. regulation specifically to increase crypto innovation. But then to say that if that doesn't happen, China could fill that gap. But then it says, or then RBC says, regardless of Libra's regulatory scrutiny, we believe Facebook will continue to pursue crypto. So, well, wait a minute. I mean, there's sort of a couple big ifs there. Yeah. And I do think that Libra is going to continue to face regulatory hurdles, but I don't think that there's any way that it is going to be completely halted. Lawmakers can send letters to partners, which they did, and in some cases, it worked. And Visa and MasterCard and Stripe dropped out. Fine, those companies say the heat is too much for us. But I do think this thing is going to launch. Now, maybe it won't be a huge success. Maybe it won't get huge adoption. Some people will tell you that because of Facebook's scale, even if only a small portion of Facebook users buy some Libra coin, it'll be huge because Facebook has a huge number of users. But
I do think it'll launch. Maybe it won't look quite how Facebook dreamt it would look a year ago because of all the heat. But boy, to say that China has the opportunity to be and establish the leading kind of government-backed crypto, I don't think so, because I don't think you'd get places outside of China to embrace that.
I guess, right. I mean, my thing is, are we even sure that would amount to anything? I guess the other thing, too, is this all is sort of under a working assumption that the dollar's primacy can't last, and yet every time we see stress in the global economy, people want to acquire more dollars. So
Fiat's doing fine.
But not just fiat, the dollar, right? Is the
Our
U.S.
fiat.
dollar, our fiat, right? That we issue, we can create as much.
We like
money. So I still feel like we're grasping at some sort of future here.
Although we're kind of behind emerging economies. We've seen that with Alipay, WeChat, how they used, and BitPesa when we were doing all sorts of other stuff. So maybe there's a place.
Well, let's
for
be clear.
somebody
These
else.
things are huge in China, but not necessarily used outside of China.
Stay with us. We're going to have a look ahead at some of the stories making headlines tomorrow. We're also going to tell you who the most powerful people in entertainment
You won't believe it, guys.
Yeah, here's a hint. Walt Disney would be proud.
He's got a book out.
They all have books out.
Especially I.
And now here's Miles with a look ahead at what will be making headlines on Thursday.
Wednesday was another day and another perfect example of what 2019 has been all about. And really, honestly, the whole decade has kind of been about this for investors. So on Wednesday, economic data was fine. Home builders, they feel pretty good. The Fed's Beige Book showed that the labor market remains pretty strong, but there is caution about what happens next year. And then in September, retail sales showed the economy is clearly growing at a slower pace. When the market closed, stocks were a little changed. The rotation into value and out of some cyclical names continued. Software, for example, got slammed, and material stocks, they rallied. So everyone gets to go home feeling worried about what the future holds, and the R word remains top of mind for many. Meanwhile, the S&P 500, it's up 19% so far this year. And yes, obviously the calendar is sort of arbitrary, and over the last 52 weeks, the market's up a more modest 6%. So there is a lot to not like in this market, but we're just a few weeks away from talking about a year in which the benchmark index more than doubled its average annual gain, and everyone was kind of pissed about it. We're about to cap off a decade where we had no recession, the labor market's at a 50-year low, and the only thing you seem to hear is how terrible everything is, which I think kind of just says it all. Now, turning to the calendar for Thursday, on the earnings side, Morgan Stanley, Philip Morris, PPG, Textron, E-Trade, and Honeywell are among the notable companies set to report their quarterly results. Then on the data front, we'll get the weekly report on initial jobless claims, we'll get housing starts, and the Fed's latest read on industrial production.
Cheer up, people.
That's what I say. I'm not
Be
even
happy.
optimistic. I cut a line from there. I was like, I'm not even an optimist, but even I know this is ridiculous.
One big thing, don't be pissed. Things
Exactly.
are good.
There you go.
Don't worry.
I like that. I see the reference. I get it.
The Hollywood Reporter released its annual list of the entertainment industry's most powerful people, and this year it's all about Disney. Yep, the list top 10
Where did
most
Abigail Disney
powerful
rank?
individuals. She did not make the list. Included the likes we've got Netflix CEO Reed Hastings, NBC Steve Burke, Viacom CBS Shari Redstone. But rounding up the top 10 were 5 Disney executives.
Oh, wow.
CEO Bob Iger took the #1 spot himself for the 4th consecutive year, with the magazine writing that not unlike Simba in The Lion King, nearly everything the light touches is Iger's kingdom.
Okay, and Kevin Feige, we're considering a Disney exec, that's fine. Head of Marvel Studios, extremely influential, deserves a lot of credit. I'm glad you read that specific quote, because THR, the Hollywood Reporter, is a huge Bob Iger stan. Now, maybe deservingly so, and we remember the debate over CEO pay that Abigail Disney launched. Abigail Disney, no official role with the company, but the heir of Disney, saying Bob Iger's a good example of someone who's overpaid. But many people, including our guest, our friend who came on,
Mario Gabelli.
Thank you, Mario Gabelli, saying, guess what? He's underpaid. Look at the stock price. Look at the performance of the business, specifically the diversification over the last 10 years. Look at the move from parks being the focus to movies and entertainment and now into streaming. I mean, Iger deserves what has come to him. He has a book out right now. I think it's sort of, is it fair to say, the average person may not realize that he's been CEO for 15 years already. They keep extending him because he can't leave. I mean, he's the guy, and Disney just can do no wrong in terms of its IP portfolio, its blockbuster status, its box office, its streaming. I'm very bullish on Disney Plus, but look, we have to see what happens with things like Lucasfilm post the Skywalker trilogy, which is coming to an end.
So if Bob Iger is Simba, got a couple questions.
I don't think he is Simba. I think he's Mufasa.
You think he's Mufasa?
Because soon he's going to die. No, I don't mean literally, but I mean he's going to step down.
So then the obvious questions. Okay, who is Simba?
Figuratively die as CEO.
Who is Simba?
Nala?
Who is Scar? Who's Zazu?
Is it Nala the girl?
Yeah.
Okay,
And then
got it.
that's Simba's friend. We haven't identified Simba. We can't identify Nala.
There are no women on that list. Where was Nala?
Wow.
They all look the same.
You mean
Put
to
that
tell me
whole
that a
put
list of
that
Hollywood
list up
power
again,
players
please.
was all
That's why.
men?
Where's Nala?
Shocking.
Where is Nala?
Simba is Kevin Feige or whomever will be the next Iger, the next Disney CEO.
Jimmy Pitaro?
And the laughing hyenas are Fox.
Yeah,
the parts of Fox that they didn't.
You guys, can I just tell you, the Obamas are on this list.
Are on the list.
They're
Deal with
number
Netflix.
50.
Even though that has that borne fruit yet? The Netflix Obama deal?
Look, when you make a list of powerful people,
Just
you
throw
put
them
the last
in.
president on there. You put the last first family on there.
We like him and he's in entertainment now.
He's in. He's number 50, just so you know.
I actually can't believe that
Oh,
Obama...
50, that's the insult slot.
Oh, really?
No, seriously. I know from when we made lists at Fortune,
Oh.
that's the person where you say, we'll put him on, but we'll prove a point by being like, dead last.
Well, no. There's 100 on the list.
Oh,
I know.
100 is 40, is 60 too many.
That's right.
For a list.
Did you know, Dan, integral part of 40 under 40 back at Fortune. Do you think about that? Like you have 10 years left to make the list?
It's just, no, that's not happening. But it's just a useful touchstone when we talk about rankings and business. And I always see sort of zombie-like people that we would vet for that 40 under 40 list coming back now. Now they're over 40, but doing new business ventures. The Max Levchins of the world.
Right. Yeah. Speaking, as it were.
Dan Roberts, we'll see you tomorrow on Wi-Fi AM. I hope by then we will have the whole Lion Kingdom worked out.
Right.
Please, on your train ride
There's
home.
work
think
to
more
do.
about that.
There's more ahead on the final round, including our top take on one of the biggest stories of the day. Plus, we hear from the president of the Get in Touch Foundation to find out how important education is in the fight against breast cancer.
final round here on Yahoo Finance. Miles Allen with you in New York. I'm joined as always by my co-host Jen Rogers. Let's take a quick look at where the market settled on this Wednesday. Not a whole lot going on here during the regular session. We had the NASDAQ, the biggest loser, off 30 basis points, but that was the largest move among the four majors. Kind of papers over some big losses we saw out of some of those software names, would have been the hot stocks earlier this year. They continue to sell off, but all things considered, a fine day here. The Dow holding 27,000, the S&P 2989. Some after-hours action here. I want to check on shares of IBM, the tech giant, falling in after-hours trade, reporting weaker than expected revenue for the third quarter. Revenue fell for the fifth quarter in a row. Now, the beginning of that streak, the recent five, Jen, I believe, was cracking a 22-quarter streak of revenue decline. So IBM had it together there for a second, and now kind of back to the old.
Felt like a reset.
Yeah, same old
Red
story
Hat
here.
did okay in here. I think they were still up some 20%, but obviously not enough.
Yeah, cloud revenue up 11% for IBM in its most recent quarter. That stock down 3%. And then, of course, Netflix shares up about 10% following their most recent quarterly report. Let's turn now to our top take stories we're watching in today's market. Didn't really talk about it all that much today, Jen. That was the surprising drop in retail sales in September. So they declined 0.3 percentage point last month. That was a double, basically, what was expected. So we were looking for a 0.3% increase in sales, but then we got that same amount on the opposite side. Now, in fairness, August's numbers were revised higher.
Yep.
Mentioned earlier in the program, annualized sales for the second and third quarter, both north of 7%. But I do think in an environment when we're looking at things like a yield curve that had previously been inverted, we're thinking about where does the global economy go from here. People are going to be very sensitive to a negative retail sales print.
Very sensitive, but I'm actually encouraged by the broader market's reaction to it because it's like 1 month, and we did this in February. Do you remember when we had that big number come out?
It was the biggest drop since February.
And
Funny you should mention.
I really latched on to that number, and I thought, oh boy, this is going to be a rough road. And look, nothing has really happened. I think these numbers are, I don't like to attack the data, but it is.
Data didn't do anything wrong here.
It's however they get these, Labor Day was early, a lot of auto and gas price noise in this as well. So I think I'm actually really encouraged by the reaction, and I think we need to realize, we get these.
I
agree. As long as you're not getting 2, 3, 4 in a month, then just go on. Keep doing what you're doing. I think that's what the market did today.
Live your life, Jen
yes,
Rogers.
Yes, that's it. The market listened. October marks National Breast Cancer Awareness Month, a time for individuals and businesses nationwide to reflect on the impacts of the disease and how to support those living with us. And joining us now to discuss how her organization is fighting breast cancer through education is Betsy Nyland. She's the president of the Get in Touch Foundation. So, Betsy, tell us about how you started to work with Get in Touch.
Thanks so much for having me, first of all. So the Get in Touch Foundation is a global breast health nonprofit. And what we do is we educate everyone on how to do breast self-exams and make them simple, appropriate, and routine for everyone. So my mom founded the organization about 14 years ago. And unfortunately, in 2016, she passed away, and I stepped into her role and have been educating everyone on how to take charge of their health through breast self-exams ever since.
Now, you guys have an app, I believe, for this. So what are you guys trying to do there in terms of, educating likely a younger set of women on what they need to know about breast health as they get older?
Yeah, so we originally had our Daisy Wheel program, and this is our Daisy Wheel, and it has the 8 steps on how to do breast self-exam. So we provide it free to schools, grades 5 through 12, and realized that we had such a demand, reaching over 1 million students, that we needed to make it more accessible and free for everyone. So we launched this app in June, and now everyone can have access to it. And we do find that it's a younger generation that can, have this accessible at all times. We send a push notification as a reminder that syncs with your calendar. So that's been an amazing thing for the organization.
So talk about technology's role here, because, look, with what's happening with mammograms, that we're finding smaller and smaller, bits of cancer to start. Is it a high-tech solution, or is it something like this that can make a difference? Like, why self-exams still in the mix?
So the reason we started the organization was because my mom had been performing breast self-exams her entire life. And then one day she went to the doctor after she found a really, really small lump that wasn't there the last time she had done a breast self-exam. And the doctor said, don't worry about it, come back in a year, it's probably nothing. But because my mom knew her body and she knew what was normal, she was able to speak from a place of confidence, and went to a different doctor and found out she had breast cancer in both breasts. So she wanted to teach me what was normal and healthy for my body, so taught me how to do a breast self-exam because there was no program that existed that taught this in schools.
So the daisy wheel concept, breast self-exams in general, I mean, sometimes there is some criticism around them. What is your take on that and your stance?
So we just want to educate everyone on what is normal and healthy for your body and encourage people to be their own health advocates and speak up if anyone noticed any changes. So there's lots of organizations out there that do not recommend breast self-exams, but we have a whole medical community and a medical advisory board that created our daisy wheel because there are medical professionals that encourage women to do breast self-exams. So it is kind of controversial. And I hear from survivors every day who say, I found breast cancer through doing a breast self-exam. Thank God I knew my body. And even organizations that do recommend to know your body, that don't recommend breast self-exams, they still want you to know what your normal and healthy breast tissue look and feels like. So why not just do a breast self-exam?
Now, you guys have also partnered with Third Love. Talk a little bit about that partnership.
Yeah, so we're really excited for Breast Health Awareness Month that we have this amazing partnership with Third Love. So between now and October 23rd, 10% of sales for the Stronger in Pink collection will be donated to the Get in Touch Foundation. So there's 3 different pink bras, and you can purchase them between now and next week, and it will help us continue educating everyone on breast self-exams.
All right. Well, October does mark National Breast Cancer Awareness Month. You are the president of the Get in Touch Foundation. Betsy Nyland, thank you so much for coming in.
Thank you so much for having me.
All right, and still ahead here on the final round, we'll have what you missed today on a busy day here on Yahoo Finance. That's coming up right after the break. Time now for all the best moments that you missed today right here on Yahoo Finance.
There were some good numbers in terms of spending on clothing stores. That might be people spending before the tariffs hit. There were some encouraging data on the online sales front. So overall, consumers are still spending. They're just going to be spending at a slower clip than they were, say, a year to 18 months ago.
It's the Premier, it's the Mercedes-Benz, it's the Rolex, right, of the streaming video service. And, you know, the key really for me when I look at this is obviously content, right? And you look at Netflix, you guys have talked about it before. This year they'll probably do $15 billion spend rate on content.
Anytime is a good time to invest if you want to get ahead in life, financially speaking, if you want to improve your wealth factors. Anytime really is. You look back over the last 100 years, and I suspect the next 100 years, the same thing. You have to get in, and you have to remain in.
The pay and benefits, opportunities, marketing, et cetera, are not equal to that of the men's, and that it just needs to be upscaled and reviewed, and let's get on with it. That's kind of my thought, is what's holding us up.
There's no such thing as a free lunch. Someone's got to pay for it. And you can't keep saying the top 1% is going to pay for everything, or there'll be no top 1% anymore, or we'll keep reducing the value of those who have 1%. It costs money.
In the greater context, if you look at companies in general, you need regulation, because there really isn't a cop up there. There's not somebody who's going to say, hey, you need to have everybody applying the same rules. And those are nation states, so the US, the UK, and other launch countries have to really regulate this.
Medicare for All is very, very low probability in our view. It's going to need congressional support, and there's really not a lot there. If we look at the ACA repeal and replace the Republicans tried, that was politically toxic and caused a lot of pain for the Republican Party. So I don't think the Democrats want to touch that stove that the Republicans just burned themselves on in the first year of Trump's presidency.
Coming up, Charles Schwab on why no one should ever miss an opportunity to invest. He'll also share stories from his new book. That's coming up in 2 minutes.
All right, Charles Schwab, the founder of the brokerage firm with the same name, joined Yahoo Finance earlier today to share his thoughts about investing, market volatility, and advice from his new book, Invested. Adam Shapiro started out by asking Schwab how smaller investors can make sure they're getting the best prices when they're ready to make a move.
Well, you certainly want to do business with somebody you trust, someone who's been around for a good period of time. And we sort of report to our clients about payment for order flow as well as price improvement, which is something we try to also disclose in every trade, tell people what's the price improvement over the trade, given the bid and the ask of the particular stock trading at that moment. So it's all about information and being full disclosed.
When you look at the arc of your career, and of course you have been a pioneer in the discount brokerage industry, we have seen U.S. investing in the market pretty much stay around stable at around half of the U.S. adult population. Do you think that this is the best time for an investor to invest in terms of the ease of trading, the cost of trading, et cetera, over your career?
Well, I think it's any time is a good time to invest if you want to get ahead in life, financially speaking, if you want to improve your wealth factors. Any time really is. You look back over the last 100 years, and I suspect the next 100 years, the same thing. You have to get in, and you have to remain in. You can't be in and out all the time.
Is what you're doing here with cutting fees to zero, is that maybe the Facebook model, right? Try to grow your user base and then maybe monetize on the back end via the order flow dynamic that Adam just talked about?
Well, when we reduced commissions recently to zero, the book talks about the whole history. It took me 40 years to take the company from what it was very beginning with 4 people. Commissions then were half of what Merrill Lynch charged when it went to deregulation back in the 70s, and took all these years to go from that price down to zero, and how we built the infrastructure to be able to do that. So it impacts our revenues negatively about 4% by this move, because we do so many other things at Schwab in terms of wealth management. We help people if they need information or need advice about, we help them also. We charge them a little fee for that too. But transactions, free.
You know, when you talk about the book though, and I haven't read the whole book, but I've scanned different chapters, and you talk about the experience, the phone call you had with Hank Paulson during the financial crisis, when one of what was the first one, the Reserve Primary Fund broke the buck.
That was not fun.
Right, it's not fun, but to Julie's question about roughly 50% of the population has something in the stock market, whether it's through a 401k. How do you reinforce faith in this system when something like what we went through in 2007, 2008 required the U.S. government to step in to essentially save so many of the institutions?
Well, it wasn't a matter of saving, and what they did is return confidence to people that there wasn't going to be a run on money market funds that particular time. And so it stemmed the fear factor. And always it comes about in down markets, I've been through many in my career, the fear factor comes in, people struggle up and sort of, oh, I better sell. That's their knee-jerk reaction. Mm-hmm. You don't want to do that. As you look back over time, that is the moment in time when you should actually be doing just the reverse, like buying. Certainly you don't want to be selling. You want to be at least holding, because right on the next few years, what happened after what you're talking about now, the market went up, 100% later on. Wouldn't you feel a little bit bad that you missed that, bailed out, paid your taxes at that time? So people have to learn how to deal with the volatility of free markets. And that's what this is. You wouldn't want to have a controlled market. You would have free markets. And free markets go up and down, whether it's interest rates, stocks, commodities, you name it.
We've been talking about technology as a good thing for consumers, right? Eliminating the fees for trading. But isn't there a downside to technology? We certainly learned last night at the presidential debate the rise of automation and how that might be a threat to work. So how do I save for retirement if I might lose my job to a robot in 10 years or 20 years? Are you worried about this?
I'm not worried about it. I think the one thing that American economy is fundamentally based upon is our improvements, our innovation. And technology is a critical element to get us to where we are today, whether it's medical science or whether it's stocks and bonds or whether it's industrial situation. Technology is the backbone of what's going to get us there. And thank goodness it's happened. In our case, our cost of doing business has gone down dramatically over the last 20 years because of technology. We're down to 15 basis points. We're probably the lowest cost provider of stocks and information and things of that nature, which puts us very competitive, being a low-cost provider. So technology, thank you very much. We would like more of it.
You stated a few moments ago that down market cycles are inevitable. They are. And in this age where passive investing seems to be predominating, how do you think about the job of focusing the investor on decades instead of quarters or months, particularly with regard to your advisory
Well,
business?
Julian, I think basically we've got to get more education into our high schools, into our colleges. Financial literacy is still at a very low component right now. We need to do better about that, to let people know how markets function, whether it's stock markets and whatever mentioned, or even how to use credit cards, what interest rates are and what they are and how you get taken disadvantage of if you have too many credit card things. There's just so much education that people don't have, and we need to do a better job of that.
People probably want to listen to you. And
Taking a final look right now where the markets finished for the day. It was lower pretty much across the board. Big mover after hours, though. Netflix. That is going to definitely set the stage for what happens tomorrow. Netflix coming out with earnings. We had the implied volatility was 11%. As Heidi mentioned, pretty on target here, up almost 10%. It was, in fact, a mixed bag. I mean, they beat on EPS, revenue in line, domestic subs were a little light, international subs heavy, but a narrative in here about how they see themselves in the streaming wars. And I would say they see themselves as well positioned.
I would imagine that most companies believe they're well positioned.
Well,
but
they're taking the challenge on and addressing it in there.
We had Lee Drogan on from SMIs to discuss this about 40 minutes ago, and I think I made an interesting point where this is not the first time that Netflix has had to basically come out and say, we think we're well positioned. It's not the first time, and the company's only 15 years old or so, that they've had to come out and basically say, you know what, trust us, we're going to be fine. And Reed Hastings has seen investors through those periods before. And so coming off of a quarter or two where the stock has really been a disappointing performer in this market. I mean, the FANG basket broke down mostly because Netflix stopped going up all the time. I think a very crucial moment here for Netflix over the next 3 to 5 years. I think the quarters are going to be what they're going to be. Certainly a different trajectory, but the next couple of years will be interesting.
And also just in terms of what they're going to be revealing now in their financial statements, breaking out the international segments from each other. Because international, I think they're telegraphing to us, is really where it's at for this company. And you can see that in the market kind of shrugging off the U.S. subs coming in light, but international, nice beat there. That's all for now from New York. I'm Jen Rogers with Miles Edlin. This is The Final Round on Yahoo Finance.